In today's fast-changing world, financial management is one of the most crucial components for individuals and enterprises. It's no longer about putting your money aside, but it's more about managing and expanding it. A good understanding of financial accounting and management is required to run a firm efficiently and successfully and to achieve business goals. Financial market encompasses any marketplace where securities are traded, such as the stock market, bond market, forex market, and derivatives market, among others. As a result, when financial market collapse, economic disruption can occur, including recession and unemployment. Because of their importance, having a basic understanding of financial market is crucial. And that is why, to help you out and enlighten you about the same, we have come up with this course where you can learn the basic of finance. So why wait? Let's get started right away. If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions, and I will respond to your comments. Now, very quickly, let me walk you through the agenda for today's course. In today's course, we are going to discuss Introduction to Finance Management, Business Finance Foundation, Time Value of Money, Financial Market, Stock Market, Asset Management, Working Capital Management, and Capital Budgeting Techniques.
Hi. Financial management is one of the most sought after course in the area of economics. In fact, for those who are aspiring for the career in the area of banking and finance, financial management is a must-learn area. Well, money is something that we quickly recall for the discussions on finance or financial management. Of course, we're not wrong. In fact, the entire domain of financial management revolving around on money. I'm very sure at individual level, we all know what is finance, how finance works in real time. But with the help of this course, let's try to put our understanding of financial management into a perspective so that your journey of understanding financial management in the advanced levels would be smoother. So why delay? Let's begin our journey. Welcome to the course on Introduction to Financial Management. My name is Pawan Kumar Chandrapa. So in this course, we will be discussing the concept of finance, the definition of financial management in business, the goals of financial management. We also discuss the scope of financial management, the functions of finance manager, the agency relationship is one of the most important topic to be discussed in the area of financial management. We discuss about it, the agent and principal relationship. And we also talk about the financial system. We talk about the entire ecosystem of financial system and how each component in the financial system are interconnected. And we also talk about the safety of investments in business. Well, we have a lot to understand. Let's begin our journey with the first topic, the concept of finance. The concept of finance is basically originated from economics. So, what is economics? How an individual or a business or a government making use of these limited resources to fulfill the unlimited dreams or unlimited desires is all about economics. So, that's the underlying principle of economics. So, the concept of finance is derived from these notions. So basically, when we talk about finance, we talk about cash, we talk about banks, investments, loans, funds, and we talk about forecasting. So forecasting the need for money. We talk about borrowings, where to borrow, how much to borrow. We talk about investments, and we also talk about budgeting. So what is budgeting? So budgeting is all about choosing an investment alternative. There are so many investment alternatives. Which one is the best project? Which is the best project to invest in? So choosing the best alternative. So this discusses about budgeting as well. Basically, finance is an art or science of money. We said money is the epicenter of this entire discussion of financial management, of course. Well, when we say finance is all about money, we need to understand finance is also, it's an art of managing money. It's a science of managing money. So why we call finance is the science? We call the finance as science because finance dependent on certain principles for deriving the results. For example, when we talk about the time value of money, we dependent on a compounding or discounting principle, right? We talk about conversion of present value of money into future value, or we talk about conversion of future value of money into present value. So there are certain principles on which the finance is actually dependent. So that's the reason we call finance is the science, because there are certain procedures to be followed to calculate the values. So that's why we call finance is the science. At the same time, we claim that the finance is also an art. Why finance is an art? Because when we are doing a calculations, when we are analyzing the money, we need to, we need to understand it is purely based on the skills and abilities of an individual, how to analyze the financial transactions and how to interpret them, how to report them. So it is an art. So it is completely dependent on the individual who is actually conducting this analysis of the financial results or the concepts that are related to finance. So that's the reason we call finance is also an art. Let's jump into the next level of discussion. What are the broad areas of finance? Basically, the finance can be discussed under three important categories: personal finance, business finance, and then public finance. So these are the categories in which we discuss the area of finance. What is personal finance? Is it something related to an individual? Yes. Personal finance is about how an individual earns some money, how an individual is earning money, how income is coming to him or her, what are the sources from which an individual is earning their money. For example, when we talk about personal income, there are 5 different heads, right? So 5 important heads: income from salary, income from house property, income from business or profession, or income from capital gain, income from other sources. So these are the sources from which an individual is earning money. Now, these are the sources of income. Finance talks about how an individual is actually earning from these sources, how money is flowing to his bank accounts. The next thing is spending. How an individual is spending. Let's say he has earned 1 lakh and how is spending 1 lakh, right? So spending on, for what reasons he's spending. Is he spending for medical expenses, or is he spending for investments, or is he spending for daily cash requirements, or is he spending for to buy any long-term assets? So that is the spending pattern that we analyze in finance, in personal finance. Well, we understood there is an income, there is a spending. Now, let's assume the income is more than spendings. Let's say he's earning 1 lakh and he's spending, say, 80,000. So 20,000 is something that is called saving. This is the surplus. Now, with the surplus, what is he doing, or what is he or she is doing? Is he or is she saving this money and keeping it in the bank deposits, or how she is making use of that money? Is she investing this money, or is she buying some long-term assets? This all is discussed under personal finance. Now, let's say the income is lesser than the spendings, right? So let's say the income is 80,000, the spendings are 1 lakh. Absolutely, there is a deficit, right? There is a deficit of 20,000. So how an individual is matching this deficit? From where he is bringing that money, right? He may have to go for borrowings, right? He may have to borrow money from the other sources to fill this, to bridge this gap of income. Earning is 80,000, spending is 1 lakh. So 20,000 is the deficit. So that is the discussion of personal finance. So how an individual is managing these deficits is the discussion of personal finance. Well, when there is an income, when an individual is earning cash, he need to pay the tax. Every individual is supposed to pay the tax. So how much of taxes he is paying, on what areas he is actually paying taxes? Is he paying income tax, or is he paying business taxes, or is he paying sales tax, or is he paying any other taxes or gift tax or whatever? So that is the part of discussion in personal finance. Again, there is something called a retirement. Again, for every individual there will be a retirement, right? So how an individual is planning for the retirement? Is he spending everything he's earning, or is he saving some money for his retirement? So that is the discussion of personal finance. So retirement planning, is he investing in long-term investment options, where he's investing in bonds or debentures, or is investing in long-term assets to earn the long-term returns? So that is the discussion of personal finance. That is part of personal finance. Well, so these are the things that we discuss when it comes to personal finance. Now, business finance. As the term business finance reflecting business, how a business is dealing with finance, how the business is handling the financial aspects. Well, every business will have cash flows, cash inflows, and cash outflows. So what is cash inflow? The sources of money. So what are the sources from which a business is earning money? Or what are the sources from which the business is borrowing? Let's say when the business is good, the business may be making profits, and these are the cash inflows. These are the positive cash inflows, right? So when the business is expanding, how a business is catering the needs, the financial needs of the business, right? So from what are the sources the business is borrowing? So that is the discussion of a business finance. So what are the sources of finance? So what are the applications of finance? So how the business is borrowing money, how the business is getting cash flows, and how business is making use of those cash flows. Financial decisions, right? So how to bring money, what are the financing decisions? Let us say the business has some money, the excess money, how business is investing that money in the market, for what rate the business is investing money in the market. So that is very important area of discussions in business finance. The dividend decisions. These are some of the very critical decisions for a business. So how to pay dividend, how much to pay, at what intervals the dividend needs to be paid. Of course, there will be regulations in each country at what intervals they need to pay the dividend, but it is up to the decisions of a company to pay or not to pay the dividends. Taxes. Every company is paying the taxes, right? So there is no exception for any business. At least in India, businesses are paying taxes. There is a separate corporate tax which they're supposed to pay, and it will be revised every year. So that is the discussion of business finance. So operating and marketing decisions of a company. So what are the operating decisions? What are the operational aspects of the business? And we talk about the marketing aspects, how money is required for marketing activities. And also the accounting aspects are very much part of the business finance. CSR. Corporate social responsibility. So business, it is not just about earning profit. They also have certain social responsibilities, social obligations. For example, taking care of children's education in the poor societies, or to take care of the parks or the roads or the bridges, the construction or maintenance of those, or to take care of orphanage houses, or to take care of any social activities which are at the larger cause for the society. So that is also part of the discussions in business finance. Well, the third important area in finance is the discussions on public finance. So what is public finance? How a particular country is managing the money, how the country is managing its financials, right? How a country is handling the demand side of the economics or the supply side of the economics, how the prices are managed. Because we all know price is the intersection of demand and supply. So how a country is managing these aspects, how a country is managing inflation. So what is the inflation level in the country, and what is the healthy inflation rate that is required for a country to grow consistently. So that is also part of the discussions in public finance. So with inflation, there is also discussions on GDP, the gross domestic product, the budgeting, the forex, foreign trades, and reserves. These are also part of the discussions in public finance. Now, financial management in business. So we have understood how financial management of finance works in individual's life or in aspect of country, but we'll dive deep into understand what is financial management in business. Basically, financial management in business is it's an application of management principles in financial activities. It is an art or science of managing money to meet the predefined objectives. So basically, it is the process of planning, organizing, controlling, monitoring financial resources with a view to achieve organizational goals and objectives. So every organization will have certain set of objectives, and to achieve those objectives, there is a need for financial resources. So how a business is handling these financial resources to meet those objectives is the discussion of financial management in business. In business, financial management is the process of handling a company's finances in a way that generates value for the overall business. Remember, financial management is a organic function in every business. There will be a dedicated department to take care of the financial aspects of a business. So they take care of all transactions. They analyze all the transactions. They do projections for the business. They analyze the requirement for financial resources, right? And the person who is responsible to take care of the financial activities is generally called as a financial manager. Of course, there are different dimensions to see the financial manager. There are various titles in which we can call the financial manager, of course, but the roles and responsibilities of finance department is all about taking care of cash inflows and cash outflows. At strategic level, financial management is all about planning cash inflows and cash outflows. How company or a business is planning the cash inflows and cash outflows is the discussion at strategic levels. At tactical levels, financial manager or the people who are responsible to take care of financial aspects at the ground level or the entry level is to record the transactions, business transactions, analyze and produce the report for in front of the management to take strategic decisions that are related to the business. So that is at two different levels we can see in an organization. Now, it's very important to understand what are the goals of financial management. There are three important goals for financial management: profit maximization, wealth maximization, and improving market share. Of course, there are a series of goals for financial management, but ultimately, all those things will boil down to these three important goals: profit maximization, wealth maximization, and improving the market share of the business. So, what is profit maximization? Profit maximization. You all know a business is an economic entity which is running to make profits. There is no business on the planet Earth which is running for charity, right? If it is purely running for charity, then it is not called as business, it is a charitable organization. When it is a business, they need to earn profit. Why they need to earn profit? There are various reasons why they need profit. So, what is the profit in business? It is simple. Revenues. What is the revenue? What is the excess of revenue that business is earning over the cost? Let us consider a business is generating 10 lakhs of revenues for this year, 2022. The cost of producing that product or service is, let's say, 6 lakhs. The remaining 4 lakhs is the profit for a company. Now, this 4 lakhs, what is the kind of profit it is a different discussion altogether, right? It may be profit before tax, right? PBT, right? This is profit before tax, profit after tax, earning before interest and tax, earning before tax, depreciation and amortizations. So what is profit before tax? This is the tax. This is the profit before deducting the taxes, because every business is liable to pay the taxes to the government. So before deducting taxes, what is that company has is profit before tax. What is profit after tax? It is, of course, it's a self-explanatory. Profit after paying the taxes to the government. Earning before interest and tax. Remember, every business will have financial obligations. Let us say when the business has borrowed some money on interest basis, they're supposed to pay the interest. So what is the revenue? What is the earnings before paying interest and taxes? That is EBIT, earning before interest and taxes. EBITDA, earning before tax, depreciation and amortizations. Remember, if it is a tangible asset, a business apply depreciation. If it is intangible asset like copyright, patent, they'll apply amortization. So depreciation and amortizations are most common in any business, right? So what is the earnings before tax, before depreciation or before amortization? So that is earning before tax, depreciation and amortization. So it's need to be very clear what is the profit that we are talking about. Now, how a business can increase the profit? A very important term, profit. By increasing the units sold, by increasing the number of units sold, increasing the price per unit, price per product, price per service, cost minimization, reducing the cost, or maybe locating new investment opportunities, or maybe acquiring new business ventures in the same line of business, or maybe from the different line of businesses. Or it may be an expansion business, expansion of an existing business. So there are various other ways to earn profit. Well, the theory of profit maximization is appreciated by many scholars. At the same time, there are criticisms too. So what are those appreciations? What are those favor towards profit maximization discussions? There are certain arguments that says, yes, profit is important for a business. At the same time, there are criticisms which we will see a little later, right? So now, what are the arguments that are in favor of profit maximization theory? The very reason why business exists is for profit. The basic purpose of business is to earn profit. In fact, profit is considered as the meter for determining the success, right? So with profit, the business is considered successful and on track. And if the profits are not there, business is considered is a curse, is a sin for the society, right? Many times, profit is essential for the survival of a business. Only when the business is able to make profits, they can survive the competition, they can survive in the dynamic business world. Only profit-making business can think of tomorrow. Only profit-making company can create future, right? That is the reason profit maximization is very important. And also, we need to understand profit is accepted by the society as long as the profit is earned in a legitimate way. For example, the profits are earned with legal routes. It is accepted. The society is okay as long as it is win-win for the society, win-win for the business, for the employees, for the stakeholders, to the customers, right? For everyone. So there is no problem earning the profit. It is required. It is very important. And society considers it is not a sin as long as it is legitimate. There is also an argument that a business which is loss-making is a burden to the society, right? A business which is under huge losses, they may not be able to pay the salaries. They may not be able to pay their stakeholders. They may not be able to pay their suppliers. They may not be able to pay dividends. They may not be able to pay taxes or interest on the borrowings, though ultimately they'll become a sin or they may become burden to the society. These are the in favor of profit maximization. These are the arguments in favor of profit maximization. Now, there are certain arguments where profit maximization is criticized. The very important argument against profit maximization is the profit is not clear. So what profit are we talking about? Are we talking about net profit, or we're talking about the gross profit, right? We're talking about profit before tax, or we're talking about profit after tax, or it is earning before interest and tax, or it is profit before interest, tax, depreciation and amortization. So what profit are we talking about? It's not very clear. So when we say the ultimate goal of financial management is to maximize the profit, which profit the business wants to maximize? So that is not clear. So that is a criticism against profit maximization theory. Duration. What is the duration for which profit maximization goal is set? Is it long term or it is short term, say 1 year, less than 1 year? Many a times, businesses are compromising on their long term profits when they are focusing too much on the short term profits. So that is the sin. That's a very, unwanted sign of profit maximization goal. Scale factor. Synchronization between size of the business and volume of profit. Many times you would have heard that the cost of setting this business is, say, 10,000 and the profits we can expect from this business is 1 lakh. Don't you think it is something unusual? Your investment is just 10,000 and you're going to earn 1 lakh. And there is the smell of illegitimate activities in the business. You just invested 10,000 and you are saying you are going to earn 1 lakh. How is that really possible? Because when a business is investing 10,000 or 10,000, a business may expect 30% or 40% or 50% returns, considering the risk return factors, right? How are you able to make those many times of your initial investment? So that is something, is a very big question mark when it comes to profit maximization. Consideration of time factor. Are we considering time factor when we talk about profit maximization? The question is unanswered. The profit maximization focusing only on maximizing profit. What is the time duration we are considering to earn that profit? Is it 1 year, 5 years, 10 years, 20 years? What is that? Is unanswered. That is a criticism on profit maximization theory. Undue aggression towards profit maximization may lead to the social evils. When a business is too focused on making profits, when they're very aggressive about making profits, there will be scope for corruption, quality drop, mis-selling, false promises, undue influences, right? So it may lead to all those things. It ignores risk associated with profits. What is the risk associated with profit? Remember, risk and reward are two faces of a single coin. So what is the risk we are going to take to earn the profit is not discussed under profit maximization theories. Wealth maximization goal. So very important, very popular goal of financial management, wealth maximization. And this is one of the most, the recent approach towards financial management. And it is popular too. When it compared to profit maximization, wealth maximization goal looks very attractive. So before we understand what is that is catching the attention of the corporate world, let us understand what is wealth maximization. What is wealth? Wealth maximization is basically an increasing the value of business to increasing the value of shares held by the stakeholders. When we say stakeholders, who are the stakeholders to the business? There are two important categories in which we can segregate, we can classify the stakeholders. External stakeholders, internal stakeholders. Who are the stakeholders who are external to the business? creditors, governments, suppliers, tax authorities, customers, media, and the society. So these are the people, these are the entities which are outside the business. They're outside to the business. They're not insiders to the business. Now, who are the insiders to the business? Insiders to the business may be shareholders, managers, board of directors, and employees. So these are the people who are internal to the organization. So value of these stakeholders is to be increased. How? Through wealth maximization. We're talking about wealth. So how? What is wealth? Basically, wealth maximization means increasing the price of the share or ensuring the dividends are paid to the shareholders. Let us say I have invested rupees 100 in a particular share. After 1 year, company is declaring a dividend of rupees 10. That 10 is the value. That's a value maximization. Now, let's say the price of the share is 100. By the end of this year, the price of the share is, let's say, 120. So this 20 is the wealth. That is the wealth that is created by the business. So wealth is maximized. The share price is increased. We calculate the wealth of a business through various techniques. So one of the ways to calculate wealth of a business is through NPV, net present value. So what is net present value? Net present value is the present value of benefits minus present value of all the costs. Right? So that is a calculation of wealth. Now, what are the arguments in favor of wealth maximization goal? So it takes care of larger interest of the stakeholders. We're not talking about profit, we're talking about wealth, increasing the value of stakeholders. So it takes care of larger interest of the stakeholders. Wealth is based on cash flows, not on profits. In profit maximization, we talk mostly about the profit. We talk about profit before tax, profit after tax, EBIT, earning before interest and tax, profit after tax, right? So these are the aspects we discuss the profits. But in wealth, we're not talking about the profits. We're talking about the cash flows, how much cash flows the business is able to generate. Long-term perspectives rather than the profit maximization goals. When we talk about profit maximization, we talk about how to increase the profits. When we talk about wealth maximization, we talk about how to increase the value for stakeholders in the long run. Remember, profit is looked for the short run. Wealth is looked at the long run. A consideration of time value of money, wealth maximization goal do consider time value of money. The rupee earned today is worth more than the rupee that would be earned tomorrow, right? So it gives weightage to that principle. Wealth maximization goal considers risk and uncertainty factors and help board members to create consistent dividend policies. Well, so these are the favored arguments of wealth maximization goal. Now, there are certain criticisms on wealth maximization also. So what are the criticisms on wealth maximization goals? It is prescriptive idea, not a descriptive idea. So creation of wealth for the stakeholders is just prescriptive, just prescribing that wealth of the stakeholders need to be increased. How to increase this wealth of the stakeholders is not discussed under wealth maximization theories. Wealth is not socially desirable. This is one of the most debated criticism on wealth maximization. So why it is not desired? Why it is not appreciated in the society? There are various reasons. The wealth should not be concentrated on few hands. When a business is concentrating on wealth maximization, the wealth will be concentrated. For example, when we say the business is dominated by major players in the corporate world, let's say, we talk about Alibaba, we talk about Elon Musk, We talk about Bill Gates, we talk about Ambani, right? We talk about Mark Zuckerberg, right? We talk about many others who are actually are the legends in the business and who are creating wealth. So what is happening? The wealth of the world is concentrated on a few hands. It is concentrated. When the wealth is concentrated on a few hands, what will happen? They'll destroy the competition. They may destroy the competition. They may ensure there is a dominance of their business in the entire industry. And ultimately, that will cause serious problems for the end users, the customers. So that is one of the arguments put forth why wealth maximization should not be a consideration for financial management. Of course, there are debates on that. Of course, there are arguments against which is not true, but this is something that is discussed in the domain. Maximization of shareholders' value is a very generic term, or it's a vague term. When we say maximizing the stakeholders' value, when we mention stakeholders, it also includes the debenture holders, the bond holders, the creditors, the everyone who are just invested their money for fixed interest, right? So what is that they're going to earn? When the business is able to create wealth, when the business is able to add value to the business, what will be the benefit for debenture holders who are just receiving a fixed interest every year? And how the value of these stakeholders increased is a question mark. So wealth maximization is not really focusing on the debenture holders, on the creditors who are receiving fixed interest from the business, no matter how much ever the profit the business is making. They're kept in a separate note. They are not considered for the profit. They are just considered for interest payments. The decisions of manager to maximize wealth may lead to employees' exploitation. When the business is too aggressive on wealth maximization, the employees may be exploited. The customers too may be exploited because the business is concentrating on wealth maximization. So that is something that is criticized in financial management. Improving market share is the third important goal of a financial management. What is improving market share? Improving market share is a very generic term. Like every industry will have players within, and every player will have their own share of business in the industry. Let's say we talk about FMCG. HUL, Nestle, ITC, Britannia are leading the market of FMCG sector, right? HUL, Hindustan Unilever Limited, is leading. They have a major market share. And then comes Nestle, and then comes ITC, and then comes Britannia. And again, they keep competing for the market share. So improving market share is a very important goal of financial management. That is also important. The financial decisions taken by the financial managers should be in line with improving market share. The financial decisions taken should improve the market share. The telecom sector, Jio, Airtel, Vodafone, BSNL, right? So Jio is leading the market. They have a major share in the entire industry of telecom. Steel industry, right? Steel industry, JSW, Tata, they're leading the industry. They have the market share. Automobiles, Maruti Suzuki, Hyundai, Tata, M&M, Honda, right? So they're all the market leaders. They have major share, especially Maruti Suzuki has the major share in automobile industry in India, right? So the decisions taken by a business should improve the market share of a business. Investors can understand the market share of company through various sources, right? So how to understand the market share of a business? There are various ways to understand the market share. For example, one of the common routes is to analyze the annual reports of a business. So understanding the size of the balance sheet is the way to understand the market share. There are other ways, like they can go to published material on companies. They can check television, they can check newspapers, right? There are various sources from which they can understand the market share through advertisements also, right? And also increase or decrease in the market share indicates the current position of the business. So if the market share of the company, let's say automobile industry, Maruti Suzuki has got major share in the industry. Whether it is increasing or decreasing is also one of the major parameter to understand whether the company is doing good or not. So that is the reason why we need to understand the market share of the business. Economies of scale. By focusing on economies of scale, companies improve the market share. So what is economies of scale? By increasing the number of units sold, they can reduce the cost incurred in manufacturing those goods or services or producing those goods and services. So by producing large number of quantity, selling large number of quantity, they can increase the revenue for the business. So that is economies of scale. Growth in market share also grows the revenue. When the market share of a business is growing, that indicates that the business revenues are also growing. And the growing market share will efficiently manage the competition. So if the market share of a company is increasing, the competition is very well managed. The competition is, to an extent, it is reduced. So that is the importance of improving market share. So what we wanted to understand is improving market share is a very important goal of a financial management. The financial manager should take decisions, the finance decisions, in line with this particular aspect, improving the market share for a business. Now, how do companies increase market share? There are various ways in which companies can improve the market share for the business. Reducing cost, increasing the volume of sales, promotion, improving the efficiency, introducing new products to the market, customization or standardization, customer loyalty, improving the customer loyalty, introducing new technologies, talent retention, and acquisition of existing firms. There are various routes through which the market share can be improved. Well, market share improvement is also not free from the criticisms. There are a couple of criticisms on improving market share, why financial management should focus on improving market share. Acquisition may lead to monopoly, right? When there is a focus on improving market share, there will be scope for monopoly or duopoly. So what is monopoly? Only one company is ruling the entire market or the entire industry. What is duopoly? Only two companies are ruling the entire industry. Right now, if you look at Indian telecom sector, there is a situation of duopoly, right? You can see Jio. To an extent, you can say it's a monopoly, but it is not established because Jio is got major stake, major share in the entire telecom industry. There is also some other players like Airtel. They also successful in retaining their market share to an extent, right? So you can see the situation of duopoly, Jio and Airtel ruling the market. So that is not good because when there is monopoly or a duopoly situation, the customers will be impacted. How? There will be less alternatives because customers cannot go for alternatives. They have just Jio or they have Airtel, right? They cannot go beyond those two players because they have the major share and they are the top players in this industry. And when they have dominance in the industry, they can increase the prices because there is a dependency. People have dependency on these companies. They can increase the prices. The customers can do little about that, or they cannot do anything about that. They just need to pay and use the services because there is no alternative in the market, right? Unethical practices will increase when there is monopoly or duopoly. The unethical practices will increase, like sales, like quality drop, fake promises, service failures, or those things that will increase when there is monopoly or duopoly. So market share improvement, though it is very important for a business, at the same time, when the market share is improving, the companies need to also understand that they need to ensure the services are not compromised or the offerings are not compromised. So that is very important. And that is one of the criticisms of market share improvement. What is the scope of financial management. What is a broader perspectives on financial management? There are three important areas under which we can discuss the entire financial management. It is about financing, investing, and dividend decisions. Every business will encounter these decisions. They're supposed to take these decisions at large. Financing decisions. So, what is financing decision? When a business is growing, when the business is too small, there will not be any need for financial resources, the financial requirements. They can manage with their own money. When the business is growing at scale, they need money, right? So, how a business can access that capital, access that money? There are various sources through which they can borrow money, right? There are shares. By issuing shares, they can obtain funds. By through issuing debentures, bonds, they can go to venture capitalists, they can go to angel investors, they can go to primary markets, they can go to secondary markets, right? There are various ways they can pledge their assets and they can take loans, right? How any of these options are going to help the company is a very important financial decision to be taken by a finance manager. So, what source to go, what source not to go? If the company is choosing to go for equity, the finance manager should understand there will be a dilution of ownership, right? So the owners, those who are going to invest in the company will be the owners of this business. Let's say the total number of shares issued by the company is 100. If I take 25 shares of this particular company, I am the owner of the company for the proportion of stocks held by me. That's 25% to 25 numbers. So I'm 25% of ownership belongs to me. So ownership is diluted. What if the business is going for debt or bond? They need to pay a fixed interest on those loans because all debts are eligible for interest. The bond holders, the debenture holders will get interest on frequent intervals, maybe regular intervals, maybe quarterly, half yearly, or 1 yearly, right? So the company is supposed to pay interest on those funds. No matter whether the business is doing good, they are supposed to pay the interest. So there's a drawback. Again, this is very important to go for debt or equity or any other sources like retained earnings. What if the business has certain reserves and they wanted to use those reserves to expand the business? What are the advantages and disadvantages? All these things need to be analyzed. So that is the area in which financial management comes into the discussions. Investing decisions. Investing is nothing but it is just what are the options the business has to invest in the industry. Let's say it is a telecom business. So what are the opportunities to invest? What are the investment alternatives available? And how to analyze those investment alternatives? What are the techniques that are supposed to be used? It may be net present value, or it may be payback period, it may be internal rate of return, it may be break-even analysis. So what is the technique a business should deploy to understand the investment alternatives? So what is the business? Which is the business is going to give a quick cash? Which is the business is going to give us long-term returns? Which is the business is going to give higher returns with lesser risk? All these decisions are part of investing sections, investing decisions. Now, dividend decisions. A listed companies pay dividend. At what intervals they need to pay the dividend? How much in dividend they are supposed to pay? Under what circumstances a company should pay the dividend? When the business is making profits, they generally pay the dividend. When there is no profit, they're not going for dividend. Instead, they'll just maintain status quo. And when there is a profit, they'll go for dividend distribution. All these things are part of a financial management at large. Well, what are the functions of a financial manager? So, what are the functions performed by a financial manager? What all roles he will play in his designation in finance department? Estimation of capital requirement for the business is one of the very important, very critical function of a financial manager. Why? Because understanding the capital requirement, understanding the scale of business, what is the scale of business need to be understood, then only they can make estimations of capital requirement, how much money is required. Only when they understand how much money is required for the business, they can understand where to procure the funds. Let's say the money is required to take care of short-term requirements of the business. They can understand what is the right source to go for funds. Once they understand what is the estimation of capital requirement and how to procure funds, they need to take decisions on capital structure. So I need 10 lakhs for my business debt. How much I should borrow from equity? How much I should borrow from government sources? How much I should take from public, right? So it's all very important. They need to understand how much each source. Let us say I need 10 lakhs. I want to borrow 8 lakhs from equity, 2 lakhs from debt, or 5 lakhs from debt, 5 lakhs from equity, or 5 lakhs from debt, 2 lakhs from equity, 3 lakhs from retained earnings, right? Remember, even when the business is using its own capital, that is retained earnings, when the last year they have made profit and they have retained the money, and that is also has cost. They cannot assume that it is free. There is a cost implication for the reserve, that is the bank balance in proprietor's account, right? So that is another decision to be taken by a finance manager. What is the capital structure to be for this business? A resource allocation, understanding for each section how much of financial resources are required and when is something that financial manager need to understand. Disposal of surplus. Disposing the surplus. What is surplus? It may be profit. Profit. How to distribute profit. Who will be given the first major share of this profit? How much to give? These are the decisions to be taken by the finance manager. Management of cash is very important because business also need to maintain certain cash to take care of daily activities, right? So what is the petty cash that is required to take care of daily requirements? What is the working capital requirement? All these decisions to be taken by the financial manager. Principal agent relationship in business, agency theory. So this is one of the most debated topic in the area of financial management, and it is most important areas of discussion. Often this is causing a serious problem in the corporate world. Who is the principal and who is the agent in business? Basically, principal and agent relationship in business, it's a fiduciary consensual relationship between two people in the business. These two people will have their own set of duties and responsibilities. When these two parties are not able to take care of their duties and responsibilities, the conflict of interest arises, and that's when the agency problem arises in general. In a generic example, let us talk about mechanic. So, mechanic, right? How agency problem arises with mechanic. Let's say, consider you have a car and there is some problem. There is a left pulling issue in your car, and you will take your car to the garage and you will show it to the mechanic. Mechanic know that just by doing wheel balancing, this problem can be sorted, and it will just cost the owner, say, less than 5,000 to do that wheel alignment. Now, when the car is given to the mechanic, a mechanic is the agent, the owner is the principal. When principal has assigned certain duties to the agent, it is a duty of the agent to take care of the best interest of the owner. That is supposed to happen. When that is not happening, that is when the agency relationship, the agency problem will arise. The car is given to a mechanic, and mechanic know that it is costing less than 5,000. Despite that, the mechanic will suggest the owner to go for a very major repair work or to replace some spare parts in the car, which will cost owner, say, 20,000. Mechanic knows that it is just costing 5,000 to the owner if that is going for wheel balancing, but still is suggesting some replacing some spare parts which is of no use. So the agency problem arises. Same with the doctor, same with the lawyer. There is just cough and cold that you can get it tested and you can take medicine, that just over the counter medicine, but still you have gone to the doctor to check. But doctor knows that it is a very common flu which can be, that can be cured with 2 to 3 days of medication, which will cost less than 1,000 rupees to the patient. But if the doctor is not doing that, if the doctor is suggesting to go for some scanning, some major medical tests which are of no use, even the doctor is aware of that. That is when that agency problem arises in this situation. Now, when it comes to a business, how agency problem arises? In business, there are two parties involved. One is agent and one is principal. Who is the agent and who is the principal in a company? Principal is the shareholder, right? The shareholders who are actually invested in the business. They are the owners of the business. Who is the agent? Agent is the board of directors or the chairman who is actually entitled to take care of the operations of the business, the entire business, because the shareholders may not be able to participate in the day-to-day activities of the business. And that is the reason they are hiring board of directors or top officials of the company, including CEO. Now, it is the duty of CEO or board of directors to take care of the best interest of shareholders. The decisions that CEO or the board of directors take should be in the best interest of the principal. Who is the principal? The shareholders. When the decisions of board of directors is not in line with the requirements of the business, when that is not in the larger interest of the business, when that is not in the larger interest of the principal, that's when agency problem arises. There are so many examples in this context. You can take Satyam case, where Ramalinga Raju was the key person in Mahindra & Mahindra who actually manipulated the accounts, which is not in the best interest of the shareholders. The shareholders have not told him that to alter the annual reports to impress the society, to impress the governments, or to impress the investors. It was not in the best interest of stakeholders, right? Same holds true with Malia. When he was in the position to take key decisions to the business, when the shareholders choose him as the CEO or a board member of a particular group, he is not supposed to take the decisions that will harm the interest of the shareholders, right? There are so many cases where agency problem arises, and it's very damaging to the business. When this kind of situations arises, there will be survival question. Business may survive or it may just vanish, because when there is a compromise to the best interest of the shareholders. That is agent and principal relationship. In agent and principal relationship, agent is hired by principal and principal pay rewards to agent for the work, for the duties performed by the agent. But when the agent is not impressed about the rewards that he would expect from principal, he may find other routes to increase his financial rewards. And that's when he'll get into the agency problem. Now, this is the time to understand the financial system. So, why we need to discuss about financial system when we talk about financial management of a business? We need to understand business is part of the system, and finance is very much connected with the financial system. A business is a part of the entire ecosystem of a country, right? So we need to understand the financial system, how financial system of a country is functioning, and how a business is connected to the financial system. A financial system of a country can be broadly discussed under three areas: financial instruments, financial markets, and financial intermediaries. It may be any country, it may be for India, it may be for any country, but these are the areas when we can discuss the financial system. Let's understand what are financial instruments. So what are the financial instruments we talk about and how these financial instruments are relevant to the business. Financial instruments are the assets for a business or for any entity. These financial instruments will have economic value. That's very important. They'll have economic value, and these financial instruments are traded in the market. It may be in the exchange or it may be in the over-the-counter market. It may be traded on a listed stock exchanges or it may be traded in over-the-counter environment. Financial instruments will have legal validity, legal tender. That's the reason these are considered as instruments, especially financial instruments. These instruments can be real or virtual. It may be intangible asset or it may be a tangible asset, tangible instrument. It may be a long-term instrument or it may be short-term instrument. It may be a long-term instrument like share or it may be a short-term instrument like T-bill, a treasury bills issued by Reserve Bank of India. Right? Now, what are the financial instruments we talk about? Financial instruments may be equity shares or debentures, bonds, preference shares, certificate of deposit, mutual fund, T-bill, or receivables, any of such instruments. But what we need to understand, these instruments can be classified into two categories, where short-term and long-term. Anything that is invested, any instrument that is traded for less than 1 year is a short-term, which beyond that is a long-term in a generic understanding, right? So debenture is traded for long-term. It's used for 5 years, 10 years, longer term. Bond, right? Debenture is long-term. Bond is long-term because it is traded for more than 1 year. Preference shares, long-term. Certificate of deposit, again, it depends, but considered as long-term. Mutual fund, long-term. T-bill, short-term. Receivables, short-term. Equity shares, long-term. Right? So equity shares are traded, equity shares are issued to the shareholders, and it will be maintained for longer duration. Now, the financial instruments can be viewed under two broad umbrella terms: money market and capital market. Money market is, as I mentioned, money market is for short term, less than 1 year. So it may be T-bill, right? It may be certificate of deposit, right? It may be promissory notes, commercial papers, bank acceptance, or repurchase agreements. Capital market, long term, debt, equity, or derivatives. Debt instruments are entitled to receive fixed interest. Equity holders are entitled to receive dividend. Derivatives, again, it's profits, right? So higher profits. Dividends, when we say derivative, the derivative may be forward contract, futures, options, or swaps. These are the common derivatives that are traded in the market. So these are capital market instruments. So money market instruments, capital market instruments. Now, financial markets. We understood the financial instruments that are traded in the market. Now, what are the financial markets? Financial markets are the marketplaces where the people or the individuals buy or sell the financial instruments. So whatever the instruments we have discussed so far, those instruments are bought and sold in the market. And this is the platform. Financial markets are the platform where we can buy or sell the instruments. What are the financial markets that we can see generally. It may be a debt market where only debt instruments are traded, equity market where all equity shares are traded, primary market, that's also called as IPO, right? IPO. Secondary market, exchange traded, right? So exchange traded. OTC, over the counter market. Cash market, daily transactions, right? So daily the banks are borrowing between the banks within the group will borrow from each other for short term requirements. So commodities market where commodities are traded, money market where all short term financial instruments are traded less than 1 year, T-bill, certificate of deposit, all those instruments are traded in money market. You cannot see these markets in isolation in generally, because many times these markets are overlapping. For example, equity market, secondary market, a primary market, right? And money market. These instruments are traded on a particular stock exchange, right? So these secondary instruments are traded in stock exchange. Money market instruments are not traded in the stock market. They're not traded, right? They're available with the parties. So money market instruments, for example, T-bill, certificate of deposit, right? All those things. Financial intermediaries. So who are financial intermediaries? Financial intermediaries are the parties who enable trading activities. So they are the people who actually bring buyers and sellers together. They facilitate the trading activities. For example, the brokers on stock exchange, right? So these brokers enable investors to trade or invest on particular shares, to buy or to sell, and they are the intermediaries. So who are the intermediaries generally that you can see in the market? It may be banks. Why bank is considered as the intermediary? Because they borrow from those who are having excess money, they'll lend it to the people who are actually in need of money. So they come these two people together and they'll connect them. Insurance companies, pension funds, mutual funds, investment banks, stock markets, and agents and brokers. Remember, all these parties are regulated. Banks are regulated by Reserve Bank of India. Insurance companies are regulated by insurance authorities, IRDA. Pension fund is also regulated by pension authorities. And mutual fund, again, it comes under SEBI. Investment banks regulated by SEBI. Stock markets regulated by SEBI. Agents and brokers, definitely they are regulated from SEBI. What is SEBI? Securities Exchange Board of India. It's a watchdog of capital market. Security for investments in business. Now, it's very important to understand the security, how secure the investors are in business. There are various investors in the business. There may be equity shareholders, bond holders, there may be creditors. There are various categories of investors to a business. Now, the question comes, are all these people equally safe? It's very important to understand not all these people are safe, and there are priorities for each of these categories of investors who are saved first when there is something wrong with the business, when the business is approaching bankruptcy. Creditors, bondholders, preference shareholders, and equity shareholders are common people, common investors for a business. At the same time, there are various other categories of investors who actually invest in a business. Now, let us understand who is safe in the business and to what extent they are safe. What is the ranking of their investment safety? Well, this we will understand with a simple example. It will be a very funny and interesting example to understand who is safe in the business. I hope this will help you understand who is safe, who is more safe in the business. Let us take this flight example. The flight is flying high in the sky, and it is a very reputed flight where hundreds of passengers are traveling in this under different categories of seating arrangements. Consider there is something wrong in the engine, and the flight is at risk, right? The flight is about to crash. and pilots get to know that there is some problem, and they'll announce that there is a problem in the flight, and the passengers are expected to jump out of this flight with parachutes that are provided at the exit door. And remember, there are only 4 categories of people who are traveling in this flight: first class, business class, then economy class, and coach plus. Okay, and this is the exit door. Okay, and exit door is here. This is the exit door. Now, when there is some problem with the flight, who will be saved first? That's a question. Is coach plus people allowed to exit the flight first? The answer is no, because their seating arrangement is far behind to the exit door, and those who are sitting close to the exit door are supposed to be allowed to exit first, because they can quickly exit the flight and they can allow space for business class people and then economy class people and coach plus. Otherwise, there will be unwanted juggling between these passengers, and there will be some other problem later. Right? To avoid that situation, the first class people are allowed to exit the flight first with the parachute, and then the next class of people, business class people and economy class people and coach plus. Right? Now, let's say there is some problem with the flight. The first class of people will jump out of this flight first because they are sitting very close to the exit door. This is the situation with the very common situation where the flight is going to crash or flight is going to have crash landing. Right? Now, let us try to understand the same example in business perspective. Consider this flight is a business flying high in the sky, doing great, and it is doing fantastic, right? And the business is generating a lot of profit, and something goes wrong. Something goes wrong, and the business started declining. And there are various categories of investors to this particular business. Who are those investors? Loan holders, bond holders, preference holders, and equity holders. Now, let us consider the business is at the bankruptcy. Now that that business is going to crash, who will be saved first? Remember, loan holders are the people who will be saved first. Okay, debenture holders. When we say loan holders, debenture holders are saved first. They are allowed to exit the business with their stake. Then the bond holders, and then preference shareholders, and then equity shareholders. This is the order in which they are saved. Let us assume the loan holders, bond holders, and preference holders will get their stake, get their money back from the business, and they'll exit the business. If there is something left over, will be given to equity shareholders, else equity shareholders will incur loss. Okay, and that is the reason we say equity is risky, loans are less risky. The loan holders will receive fixed rate of interest no matter how the business is doing. Equity shareholders receive dividend, the profit, based on the performance of the company. So, when there is something wrong in the business, loan holders save first, then bond holders, and then preference holders, and then equity shareholders. So here is the quick recap of what we have learned so far in this video. Finance is all about money. It talks about cash, bank, investments, savings, forecasting, borrowing, investing, and budgeting. And there are various other aspects as well. So what are the broad areas of finance? Personal finance, business finance, public finance. Financial management is an art and science of managing money to meet predefined objectives. We have understood why it is science and why it is an art. We have understood what are the goals of financial management: profit maximization, wealth maximization, and improving market share. These are the 3 important goals of financial management. There are so many other goals, but ultimately all other goals will boils down to these three important goals of financial management. Then we have understood who are the stakeholders to the business. We have understood the stakeholders to the business may be internal stakeholders to the business, or it may be external stakeholders. Who are those internal stakeholders? Maybe board of directors, employees, right? Shareholders, right? They're the internal stakeholders to the business. Who are the external stakeholders? Creditors, bondholders, suppliers, customers, media, right? Society. So these are all external stakeholders to the business. Financial management, we have understood the scope of financial management. We've discussed investing activities, financing activities, and dividend activities of financial management. So finance extends to these areas. And we have understood the principal and agent relationship, agency theory. So what is principal and agent relationship? It is an arrangement where one entity lawfully selects another person or an entity to act on behalf of the principal. So agent and principal. Financial instruments, financial markets, and financial intermediaries are the constituents of financial system. And lastly, we have discussed how safe the investments in business, who faces higher risk and who has less risk in the business. So that's all in this video. I hope you all enjoyed these videos. Thanks for watching. All the best. Welcome to the video on time value of money. My name is Pawan Kumar Chandrappa. In this video, we are going to understand the concept of time value of money. We'll understand the relationship between time and money and how inflation come in between time and money, and it will impact the value of your money. And we will understand the compounding principle, conversion of present value of money into future value of money. And we discuss about the discounting principle, that's conversion of future value of money into present value of money. And we will talk about Rule 72. It's how many years your money is going to take to double itself. So we'll talk about that, and we'll talk about the perpetuity and growing perpetuity. Let's start our discussion with the fundamental question: what is time value of money? You must have heard this question so often, but understanding this concept requires certain essentials, like we need to understand the basics of money. So let us try to understand this concept with a simple real life example. Think about it. Let's say you are a manager, you are working in an organization, your manager is so impressed about your performance and he wanted to give you a bonus of rupees 10,000. But the manager gives you two options. You either receive 10,000 rupees today or receive 10,000 a year later. So as a reasonable individual, which option would you choose and why? This is a very critical decision to be taken because there are two options given to you and you have an opportunity to choose any one of this. Now, if you are in this position, which option would you choose and why? If you are a reasonable investor, you would definitely go for option 1 rather going to option 2. There are three important reasons why you should be choosing option 1 instead of option 2. Option 1 is more practical compared to option 2. What is option 1? Collect amount of rupees 10,000 today, or option 2, collect the amount of rupees 10,000 a year later. You would choose option 1. The fundamental reason is default risk. Why we talk about default risk in this context? For example, when your manager says that I will give you 10,000 rupees bonus because you have performed extremely well, your manager promised it, and now let's say your manager is happy and after 1 month, let's say you commit a serious mistake in your organization and that is very damaging to your organization. Will your manager be able to give you the bonus of rupees 10,000? The answer is no, because he's disappointed about your performance. So there is a chances of default risk from your manager if you choose option 2, collect the amount of rupees 10,000 a year later. So that is not an attractive option for you. You should be going for option 1 because, as we mentioned earlier, the bird in the hand is better than 2 in the bush. So that is the reason you would choose option 1. Reason 2, why you should be going for option 1. There is an inflation risk that we are actually facing. We all face this inflation risk. So what is inflation risk? The value of money. When we talk about the appreciating assets and the depreciating assets, you should be putting money into the asset that depreciates over a period of time. So the money is a depreciating asset. So the value of money depreciates over a period of time. And why that happens? Because of inflation effect. Okay, so inflation will take away the value of your money. For example, let's say the Indian inflation rate right now is 5%. It's an average of 5%. Now, when we say 5%, the value of your money depreciates over a period of time by 5%. Let's say 1 year. Let's say you have this 10,000 rupees and you will keep it in the safety locker of your home. What will happen? The value of your money depreciates. Even if you kept it safe in your locker, the value of money depreciates because the inflation will damage the value of your money. So, to protect the value of your money, what you need to do, you have to take money right now and you have to invest in the market at least for 5% so that you can save the value of money by 5%. For example, so in this case, so let's say you have chosen option 1 and you have taken 10,000 rupees from your manager right now and you will invest this money in the market for 5%. What will happen? The first thing, you are going to save the value of your money. Let us assume you are not investing this money, you are not choosing this option 1 and you're going for option 2. What will happen? 10,000 rupees that you are expecting to receive by end of this year will lose 5% of its value because 5% is the inflation. So 5% of 10,000 is 500. So the 10,000 rupees minus 500, 9,500. So what money you're going to receive at the end of this year is 9,500. It's not 10,000. Though you feel it is 10,000 rupees right in your pocket, it is not the actual value. It is not the intrinsic value of your asset, intrinsic value of your money. So that is the reason you should be going for option 1. You have to take this 10,000 now and you have to invest in the market at least for 5% so that your money, that is 10,000 rupees, will be 10,000 at least at the end of this year. The third reason why you should be going for option 1, there is a reinvestment opportunity. Okay. So let's say the 10,000 rupees today you will invest in the market and the percentage of interest you are actually planning is 10%. So 10% is the interest you are actually going to earn. And in the 10%, 5% of the value will be taken by inflation. Remaining 5% will be your return. So here, by investing for 10%, you're not just protecting the value of your money, you are basically earning excess return from your money. Okay, so that is the whole idea why you should be choosing option 1 and not the option 2. Now, what we need to understand from this, the rupee earned today will have more value than the rupee that would be earned tomorrow. The rupee saved today will have more value than the rupee that would be saved tomorrow. The rupee invested today is more valuable than the rupee that would be invested tomorrow. Now, the concept of time value of money can be discussed under 2 broad categories: discounting and compounding. We generally talk about time value of money under these 2 broad categories. So, what is discounting? Basically, discounting is also called as a future value of money. Let's say your father has promised you to give 10 lakhs after 10 years. Now, you want to understand what is the worth of this 10 lakhs right now. My father promised 10 lakhs. Absolutely fine. I know that 10 lakhs I'm going to receive. But what is the worth of the 10 lakhs right now? So, discounting principle will help you calculate that and understand the intrinsic current worth of your money, the current worth of the 10 lakhs you're going to receive after 10 years. For example, let's say you want to invest 1000 rupees every year, and for 10 years you're going to invest 1000 into 10 years, it is 10,000. So after 10 years, the total value of your money is 10,000 is what you're thinking. But what is the actual value of your 10,000 after 10 years? So to find out answer for that question, you need to use the compounding principle. The compounding principle will help you understand your value of your money after 10 years. So what we will do, we will discount, we'll apply time value of money principle to understand the current worth of your money. So this can be calculated using the equation present value of money is equal to future value of money divided by 1 plus r power n. In this equation, FV is nothing but it is future value, R is discount rate, N is number of years. So you can also call it as period. So let's take an example. We'll apply this formula. We'll understand how discounting it actually works in real time. Let's take an hypothetical example. Let us assume that your reporting manager is impressed with your performance, the performance of the entire team during the last quarter. In order to encourage the team, the management has decided to offer an employment continuance incentive. Let us say the management offers incentive with 3 options the management is giving. Alternative 1, receive 1 lakh at the end of 3 years. So this is the option given to you by your management. Alternative 2, receive 32,000 at the end of each year for the next 3 years. Alternative 3, receive rupees 36,000 at the end of first year, 32,000 at the end of second year, and 28,000 at the end of third year. You carefully observe this. In alternative 1, you are going to receive a lump sum of 1 lakh at the end of 3 years. It's one-time payment, one-time amount is going to give you. But in the alternative 2 is going to give you a uniform cash flows of 32,000 for the next 3 years. But in alternative 3, 36,000 at the end of first year, that is one amount, 32,000 at the end of second year, and 28,000 at the end of third year. So the cash flows are not uniform, right? And consider the management gives the team a day time to decide the alternative that they want to opt for. So if you are part of this team, then which option would you choose and why? So this is a very practical situation that most of us will encounter. Let's try to understand how we can solve this problem. Let's understand what will happen in case of alternative 1. So receive 1 lakh at the end of 3 years. Now, when we say 1 lakh, remember this is a one-time payment and you can consider this is a annuity, right? So one-time payment you're going to receive. Now, the present value of single cash flow. This is a present value of one-time cash flow, right? 1 lakh is the one-time cash flow at the end of 3 years. So to do this, we can use present value principle, present value equation. Present value is equal to future value divided by 1 plus r power n. So just apply these values. Future value is 1 lakh. Why it is future value? We don't have this money right now. So we are going to receive this amount. R is discount rate, that is 6.5%. N is 3 years. So 1 lakh divided by 1 plus 0.065 power 3. So 0.065 is nothing but 6.5 divided by 100. Now power 3. So 3 is nothing but it is term at the end of 3 years. So what you're going to get is 82,784.91. That means the value of this 1 lakh is 82,784.91 right now, means today. So if you are promised to give 1 lakh, don't believe that you're going to receive 1 lakh. You are going to receive just 82,784.91 today. That is the actual value of your money. So you should remember when manager said 1 lakh, your manager is going to give you 82,784.91. And according to financial term, he is mentioning 1 lakh. It is not true. He is going to give you this amount. And what you're going to receive is 1 lakh, but the worth of this money is 82,784.91. So now we have understood how to calculate the present value of money using the formula. Now let us understand how to use table values to calculate the present value of money, because most of the time applying formula may be quite challenging. Sometimes it takes time, right? Do calculations. Now you may be thinking how to apply, how to use this principle with the help of table. So I'll show you how to use table. This is called present value interest factor table. It is showing dollar. We can use it for rupee and the values are the same. So in this case, let's say it is 6.5% and this is for 3 years. So how to see the table value for this particular values? Now, most of the tables come with 1% difference. Okay, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, like this. So you will mostly get like this. So what you need to do, sometime you'll not be able to use this table. You may have to calculate the numbers, and some tables will give you 1.5%, 2%, 2.5%, 3%, 3.5%, all these values. So we have another table. This table will give you the values for 3 years and 6.5% discount rate. Okay, so 3 years and 6.5%. So we can calculate for this values. So this is the table, and you can find out how you can find out 6.5%, and this is for 3 years. So the value is 0.827849. So this is the value. So what you need to do, you have to use this number and you have to multiply this number with, so 1 lakh. You can use 1 lakh and the table value. So you will get 82,784.91. Now we need to understand another thing in this context. For example, when we say this 0.827849, so how this value is calculated? So you must be wondering how this number is calculated. So to understand this, what you need to do, you need to apply the formula. Very complex. The numbers are calculated with a simple example, simple formula. So present value table will help you to calculate present value in few seconds. So now let's understand alternative 2. So what is the alternative 2 is given to you? Receive 32,000 at the end of each year for the next 3 years. So we understood these are multiple even cash flows. So 32,000, 32,000, 32,000. So 3 years, we're going to receive 32,000. Now, so what we need to do, we need to apply this present value formula. And these are number of years, year 1, 2, 3. And the second column is a future value. What is future value? 32,000 is the future value for first year, right? 32,000 is the second year future value, and 32,000 for the third year. So if you look at the total of this 32,000 for the 3 years, it is 96,000. But can we consider this 96,000 as your value of your money? The question is that, but the answer is no, because 96,000 is the amount you're going to receive at the end of 3 years. Put together all 3 years cash flows, but you have to apply discounting principle. Discounting principle will use inflation. You'll consider inflation, and then you're going to get the result. So what you need to do, 32,000 for 6.5% discount rate. So if you apply this present value formula, you will get this number, 30,046.95, 28,213 for the second year, 26,491.17 for the third year. If you total this, it is going to be 84,751.12. The value of your money, if you receive in alternative 2, is going to be 84,751.12. Remember, the value of your 1 lakh is 84,751.12 today. Okay, so this is a direct method of applying present value formula. We can also do this with the help of present value table. So present value table will help you. Since this is a uniform cash flow, you can take the discount rate and you can calculate the table values. So first year 6.5%, second year 6.5%, third year 6.5%. So 6.5% first year. Okay, so 0.938967, 0.881, 0.827. So you have to plug in these values in this area and then multiply that with column B, that is cash flow. So 32,000 table value, you will get this numbers. Okay, and this is going to be 84,751.12. So this is alternative 2. Now let's understand alternative 3. So what is alternative 3? Receive 36,000 at the end of first year, 32,000 at the end of second year, and 28,000 at the end of third year. Remember, this is not uniform cash flow. So we are not getting us same cash flow for all 3 years. It is different. Now, how to calculate this discounted value? So consider 3 years, year 1, 2, 3, then cash flows 36,000, 32,000, 28,000, and then use the discounted rate 6.5% for all 3 years, and you can multiply 32,000 with discounting rate, 28,000 with the rate. So you will get these values. So first year 32,863.85, second year 28,213.10, and third year you will get 23,179.77. So remember, these are the discounted cash flows. So you have taken inflation into consideration. So what is the worth of these 3 cash flows now? 84,256.72. So now we have all 3 options right in front of you. This is a decision time for you. Which option do you think is attractive? Obviously, the option which gives you the maximum discounted value, right? So that is option 2, 84,751.12 is the maximum out of 3 options. So a reasonable individual would choose alternative 2 against all these 3 options. So that is how discounting principle will help you understand the value of your money right now after applying discounting principle. Now, having understood discounting principle, this is the time to understand what is compounding. So how to do compounding? What is compounding? Basically, compounding is nothing but it is just trying to understand the future value of money. You want to understand the value of your money on a specified future date. You have some amount right now and you don't know what is the value of that money on a specified future date, let's say 5 years, 10 years, 15 years, or 20 years down the line. The compounding principle will help you understand the value of your money on a specified future date. Basically, compounding is conversion of present value of money to future value of money. Compounding refers to an increasing value of an asset due to the interest earned on both principal and accumulated interest. So compounding will help you understand your future value of money. So here is an equation to understand the compounding principle. A future value of money is equal to present value of money into 1 plus r to the power of n. So in this, future value, FV is future value, PV is present value, R is discount rate, and N is number of years. You can also use future value table and you can consume the table values to calculate the compounding values. So here, future value of N is equal to present value into future value interest factor annuity. So R is discount rate, N is number of year. So let's take an example to understand compounding principle better. So what is the future value of 1,000 deposited for 3 years with the financial institution offering 8% return per year? So in this example, the present value is 1,000. The discount rate is 8%. That's 0.08%. 8% divided by 100. And N is equal to 3 years. So number of years, 3. So just plug in the values to the formula. So future value of N is present value is 1,000 into 1 plus 0.08 to the power of 3. So the value will be 1,260. There is an alternative method to calculate compounded value. You can use future value interest factor annuity. So you can take table value, so future value interest factor annuity. So in this case, it is 8% discount rate, number of years 3. So you have to see future value table for 3 years for 8%. So you have to take that value and you have to multiply with 1000. So the value of compounded amount is going to be 1260. So that is the value you're going to earn. Now, how to see this value in the table, right? You can refer the same table, the future value interest factor, right? So you have to see 8% and 3 years. So you must be saying 1.2597. So when you round this 9, it will become 1.26. Okay. So 1.26 into 1000. So 1260. So this is how you can calculate the compound value of your money. Let's take another example to understand compounding better. Let us consider that you are a popular financial consultant in Bengaluru. A customer come to you for a financial advice. You are thinking about recommending your client to invest in gold that costs 85,000 rupees. And you are certain that next year the gold value will be worth 91,000 and assures you 6,000 gain. So 85,000 rupees is your investment and you're going to get 91,000 rupees. The difference is 6,000. Let's say there is one bank in the same locality and the bank is giving you a 10% return. Should the client undertake investment in gold or he should go for the bank deposit where he'll get 10% return? So let's calculate that which option is better for your investor. So in this case, the present value of your money is that 85,000 is going to invest. Bank is giving 10% return. Number of years is 1 year. So at the end of 1 year, I want to understand what is the worth of this particular investment. So we'll approach future value formula. Future value is equal to present value into 1 plus r power n. So 85,000, 1 plus r, 0.1. R is discount rate 10% divided by 100. So 0.1. So power 1. So it is going to be 93,500. Okay. So if your investor deposit money in the bank, he is going to earn 93,500 from the bank. But if he invest in the gold, what is the amount he's going to get? 91,000. So 93,000 is simple mathematics. 93,500 is bigger than 91,000. You should be suggesting your client that go for bank deposit and don't go for investing in gold. Now, let us understand Rule 72. You must have heard Rule 72 everywhere. Like if you keep money in the bank and you will get the double of your amount from the bank. So that is a magic formula that we often speak is Rule 72. So Rule 72 help you understand how far you have to wait to see your money doubling in the bank. It is not doubling overnight. It will take a certain period to double. So that is Rule 72. So Rule 72 help you understand how much time your money will take to become double in your account. This rule number 72 can be applied to anything that grows exponentially. If you're talking about money, you can apply to your money because it grows over a period of time. So you can apply to that. You can apply to GDP, gross domestic product of a country can be calculated using 72, and inflation. So you can also consider this formula to calculate what is the growth of inflation in the specified future date. So Rule 72 helps you. Basically, Rule 72, why it is Rule 72? Rule 72 is basically this is the time it will take for your money to double or anything to double which is growing exponentially. So 72 is calculated using the exponential value, the standard exponential value 2.7182. So that is the base for the calculation of 72. And you need not look at log normal distribution table to calculate this. It is already calculated. This is a constant value. So 2.7182. There are variations you can see. to rule number 72. There is 69 which is used for the calculation of interest rates. 69, 70, 72. Some cases you can also see 69.3 also used for understanding how much time your money will take to become double. But 72 is the most popular, very useful rule that will help you understand the value of your money on a specified period, when the money is going to double at what rate. So we use 72. So you also, I suggest you to go for 72. So for example, suppose you want to invest 1 lakh today at the compounded annual interest rate 8%. How long will it take for you your money to become double? Simple, direct formula. Years to double is equal to 72 divided by interest rate. So 72 is the same value you're taking, and interest rate. Let's say the prevailing interest rate is 8%. So divide 72 divided by 8, you're going to get years to double. So your money will take 9 years to become double in your bank account. When you put FD, fixed deposit in your bank, they take 7 years, 8 years, 9 years to double your money. On what basis they have done it? They have done it based on Rule 72. So 9 years will be the required time. You have to wait for 9 years to see your money doubling. You need to approach rule number 72 very carefully. You have to understand the hidden meaning of what is years to double. For example, when we say 9 years your money takes to become double, that means in 9 years your money is losing 50% of its value. Virtually, what you're going to get at the end of 9 years, this is after offsetting the inflation effect. So that is the value you're going to get, that 1 lakh will become 2 lakhs in 9 years. In 9 years, the actual value of 2 lakhs will be 1 lakh. That is a hidden principle behind doubling curve. So the compounding principle. Now we will talk about perpetuity. You must have heard perpetuity. It's a quite common term when it comes to retirement planning. So we talk about perpetuity to understand how we are going to receive cash flows after a specified future date. For example, let's say I am going to retire at so and so year, let's say 2050. So up to 2050, I'm going to save certain amount and I'm going to deposit my money in the bank account or in an investment vehicle. And after a specified duration, how I'm going to receive my cash flows. After a specified period of time, I'm going to stop investing in that particular vehicle and I'm expecting cash flows from that investment, right? So I want to understand perpetuity, how far I'm going to get money and at what rate I'm going to earn returns after a specified period of time, right? So that's the whole idea behind perpetuity. So perpetuity is basically refers to the constant stream of cash flows with no end. So that ends only when the person finish his journey, right? So like after retirement, let's say 60 years after a person retires, and then till the end of his life, he'll keep receiving the cash flows. But there is no definite period when he's going to stop receiving the cash flows. So it is perpetual, indefinite. The holder of this financial instrument entitled to receive the interest payments forever, and that is indefinite. There is no specified future date when the cash flows are going to stop. Have you heard of a retired person who is going to stop receiving his cash flows? It is no, right? So that is indefinite. These indefinite series of cash flows can have a finite present value. Though we say we are going to receive infinite cash flows, we have time value for those cash flows. So we have to time those cash flows. It is not that every year if I am going to receive 10,000 rupees, it doesn't mean that I'm going to have 10,000 rupees every year and it is going to be 10,000 forever, right? So the value of the 10,000 changes, that depreciates over a period of time. So the perpetuity principle helps you understand the value of those cash flows that you're going to receive after a specified period of time. So here the formula to calculate the perpetuity, perpetual value of your money. So present value of perpetuity is equal to amount divided by R. Amount is the cash flow you're going to receive after a specified period of time, and R is the interest rate you're going to receive after a specified period of time. At what rate you're going to receive the cash flows. So that is perpetuity. Let's understand the concept of perpetuity with a simple example. Calculate the present value on 31st December 2021 of perpetuity, paying 10,000 at the end of each month starting from 1st December 2021. The monthly discount rate is 7%. So what is 7%? It is the discount rate at which we are receiving the cash flow. So in this problem, the periodic payment is nothing but it is amount is 10,000. Discount rate is 0.07, that is 7%. Present value of your cash flow is 10,000 divided by 0.07, that is amount divided by discount rate. So 10,000 divided by 0.07, it is going to be 1,42,857. So that means the perpetual cash flows you are going to receive after a specified period of time, the discounted value of those cash flows is 1,42,857. Though you receive 10,000 rupees every month for indefinite period of time, we can calculate the present value of those cash flows for indefinite period of time. The amount is 1,42,857. Now, adding to perpetuity, let us say in this case, we have seen the perpetual cash flows are constant. That was 10,000. In a real world scenario, it is hard to imagine that the cash flows for the future are going to be same. The discount rate is going to be the same. The cash flows are going to be the same. Because these cash flows and discount rates are influenced by several macroeconomic factors. So, when these factors are influenced by external environment, definitely the perpetual cash flows we are expecting will also change. The cash flows we are expecting will also change. The discount rate we are talking about is also going to change. So, we need to understand growing perpetuity, how the cash flows will grow perpetually. Imagining cash flows will remain stagnant for indefinite period of time is an economic assumption which is necessary for the understanding of the principles. But in the real world, the discount rates, the cash flows will be influenced by various macroeconomic factors that needs to be discounted when we calculate the growing perpetuity. So let's consider an example. What is the value of promise to receive 10,000 next year, growing by 2% forever? The cash flows are expected to grow by 2%. 10,000, 2%. Next year, again plus 2%. So it will grow gradually. So we need to understand what is the perpetuity that going to grow, right? And that is under the assumption that the interest rate is going to be 8% per year. So when you need to assume that the perpetuity is going to grow for a period of time, you have to apply the growing perpetuity formula, amount divided by discount rate minus growth. That is 10,000 divided by 0.08 minus 0.2. The result is 1,66,667. What it refers? The value of your growing perpetuity will be 1,66,667 after your tenure, that when you are going to start receiving the cash flows. So that is growing perpetuity. Here is a quick recap of what we have learned so far. The value of money depreciates over a period of time due to inflation effect. Compounding refers to conversion of present value of money to future value of money. Discounting refers to conversion of future value of money to present value of money. The rupee earned today will have more value than the money that would be earned tomorrow. The rupee saved today will have more value than the money that would be saved tomorrow. The rupee invested today will have more value than the money that would be invested tomorrow. Why? Because of inflation effect. We also talked about perpetuity, right? Perpetuity refers to a constant stream of cash flows with no end. And we have applied time value principle to perpetual cash flows. And we have understood the growing perpetuity. Growing perpetuity refers to a cash flow that is not only expected to be received for indefinite period of time, but also grow with the same rate of growth forever. Thank you.
So before moving on, let's talk about our learning objectives. So we'll start off by knowing what exactly are financial markets, what is the need of financial markets, and also why are financial markets important. Then we'll know about the various types of financial markets. We'll start off by knowing what is a stock market, what is a bond market, what are currency exchange, what is a commodity market, what is a cryptocurrency market that is in hype these days, and also we'll be talking about the most riskiest part of the market called the derivative market. So we'll start off by knowing what exactly are financial markets. So we can consider financial markets as a marketplace or a bazaar, right? We go to various supermarkets. A supermarket has various components, like we have groceries, we have vegetables, we have fruits, we have various cleaning items, and all of this is in particular one place, right? But similar to this, we have financial markets. So all the equities, bonds, securities, currencies are traded at one particular place called the financial markets. So basically, how you buy a particular product in a grocery store or something like that, in a financial market, you exchange money. Money is exchanging hands, and it is circulated from one individual to the other or one individual to an organization. Now, selling or buying of financial assets takes place between two major parties. One is called the buyer, the second is called the seller. So we start off by knowing what are the different types of financial markets. So we can assume a financial market as a house, and there are various key elements to that house. The first one is called the stock market. The second is called a cryptocurrency market. The third is called a forex market, which we often refer to as foreign exchange. Then it is derivative market and also commodity market. Various livestock, various agricultural products are traded on commodity markets. So we'll next know about what exactly is a stock market. So stock market is a place where shares of publicly traded companies are bought and sold. So the buying and selling leads to a fluctuation in prices. It can be on the positive side, it can be on the negative side. Now, the companies are registered at this particular place called exchanges. We'll know about that going forward, where people buy and sell. So in India, we have two major exchanges called the National Stock Exchange or NSE, or the Bombay Stock Exchange or BSE. So there's a very good history of how the stock market came into picture. So it was around the year 1600s. So the world was not explored much at that time. The maps were not drawn at that time. So in order to explore the world, the ships were sent out from the harbors to various parts of the world. So in order to maintain the ships, it was a very heavy cost that used to come up. So the companies individually cannot have all the money put in for the ships to go across the world. So in that case, they thought that we'll take the money from various common people so that they can explore the world and also incur and take care of the expenses that have been incurred. So what was that for a common man? How would a common man gain profit out of it? So in that case, they thought that when these ships go and find new places, all the treasury, all the gold that they find, they will distribute that among the people who gave them the money in the first place. So this is how stock market came into picture. Now the investors purchase these shares and allow the company to raise money to grow its business. Now every company, in order to grow, needs a capital expenditure. We call it capex. So these capex is required to enhance the company, to take it forward for them to move forward. So the stock market does come with a lot of risk, but with the right investment strategies, it can be done safely with minimum risk. So what used to happen currently in the digital world is that everything is on just a click of a button. So we can buy, sell all the shares with a click of a button. But in the 1900s, it used to be physically. So if you were living in the places where Bombay Stock Exchange was there or National Stock Exchange were there, only then you can physically go out and hand out the slips. right, of buy and purchase of the shares. But now in this era, we can do it just with a click of a button. So we'll understand what exactly is a share. Now we can consider a share as a small part of ownership in a financial asset or a business entity. So for example, you are a company and you plan to raise 50 lakhs, right? So you divide those 50 lakhs into small chunks of shares with a small value and distribute it among the people. Let's take an example. As we can see that a company called X, Y, and Z, right? Let's take an example, a company X, Y, and Z. So now it needs to raise a sum of around 50 lakhs. So in order to do that, what it can do is distribute those 50 lakhs into 5 lakh shares with 10 rupees per share. This is not a fixed value. It depends on the company, what they want to do. They can also make it as, let's say, so the company don't always need to have 10 rupee as 10 rupee per share. They can also distribute it as, let's say, 50 lakh into 1 rupee per share. 1 rupee per share. They can also do that. Now, what happens is that the company divides its total capital into small chunks called the shares, which is used to raise money again. But majority of these shares are kept with the promoters of the company, or the top brass of the business. The reason is that the main decision making body is the board, right? So they need to have majority of the shares so that they can have control over the particular entity. So this is why minority of the shares are let out in stock exchanges for common man or the retail investors to purchase. Next come is what exactly is a stock exchange. Now you may have heard a lot of times these words stock exchange come into picture, right? So what exactly is a stock exchange? We can consider it as a building or maybe a mall in which different types of companies are registered there, are kept there for the common man or the retail investors to purchase. So in India, stock exchanges are a very big part of it. There are two exchanges called the National Stock Exchange or the Bombay Stock Exchange. So in National Stock Exchange, around 1700 companies are registered. And in Bombay Stock Exchange, almost 5400 companies are registered. Now, in order to know the growth of the India, basically to know the growth of how these companies are doing, we have different indices, which is for National Stock Exchange, it is called Nifty, which comprises of 50 of the top companies, and their growth can be measured looking at how they are performing on day-to-day basis. While on the other hand, Bombay Stock Exchange has its index called as Sensex, which comprises of top 30 companies, and you can also know what type of growth is happening by looking at their graphs. So next we'll talk about how does the stock market work. What is the theory behind it? How does the prices fluctuate? How, as you retail investors, can invest your money? So in general, the main governing body of stock market is called as SEBI, which is called Security and Exchange Board of India. So that regulates the entire markets. How do the markets perform? What is the thought process behind each company registering itself, and if there are not any malpractices that are happening. So if you want to invest in a company XYZ, right? You cannot just go right there and ask that, okay, give me XYZ number of shares. You need to go through a entity called as stockbrokers. So these are the people who have registered accounts in the exchanges. These are the people who know how the markets work. They are the people who have the right to invest in a particular company by your money. So they have the right to do so. So we as retail investors, right, we have to make, apart from our saving banks account, we have a savings bank account, right, that we all use, right? Apart from it, we need to open one more account, which is called as a demat account. So demat account is the particular place in which you can trade into securities. We call it securities or equity markets. So you need to open a demat account. Now demat account will have a particular account attached to it called as a trading account. So all of your buying and selling will happen in your trading account. And through this trading account, whatever the loss that you incur, whatever the profit you gain will be transferred to your demat account. Now, this trading account is linked to your broker's account. So when you ever trade in any particular company or any particular stock, these brokers will pass on your order to that particular company in the exchange, and they will give you a confirmation that yes, your particular order is complete, and then you will receive it in T plus 2 days. So India follows a T plus 2 day settlement period. So if you buy today, after 2 days you will receive that particular stock in your demat account. So the brokers are just the medium. So your stocks are stored in an entity called CDSL, which is Central Depository Securities Limited, or NSDL. So these are the two things. They are government owned, and they're the companies in which your stocks are stored. Next, we talk about what exactly is a bond market. Now, bond market is also known as a fixed income market. Now, this type of markets are not very volatile. These are safe entities, right? This is also called as a safe investor's heaven. So bond markets, you usually don't have a lot of fluctuations in prices, and also they are considered as a loan to a government, company, organizations by the people. So we lend out our money to these organizations or government so that they can give us an interest on the payment, right? So governments and business entities, they issue bonds to raise capital. Now, what is this capital needed for? For example, if a company wants to establish another business in another country, so for that, massive amount of capital is required. Now, most of the companies don't have that kind of money, and if they go to the banks and ask them the money, they would probably reject their own loan requirement, stating that it is too high for them to give it. So in that case, what these companies do, they roll out bonds, which guarantees the particular investor or the people that when you are giving, like, let's say 10,000 rupees, you will get additional 10% interest in next 4 years or 5 years. So this is how the bond entity works. Now, investors who buy these bonds get regular fixed payments for a specified duration, right? It is similar to what we call as a fixed deposit, that you and I, everyone would know that how it works. It's similar to that. Now, bond market is less volatile, as I already mentioned, than the stock market. There are still certain concerns about the bond market that I will be talking about. So there are essentially three types of bonds that exist. Number one is called the government bond. Second is called the corporate bond, and the third are the less known ones called the municipal bonds. So what exactly happens? Repeat. So what exactly happened in the government bond? So the federal government issued the government bonds to raise the money for various developments that might be happening, like, let's say, big infrastructure. You need to make express highways, you need to make large complexes, you need to make bridges, you need to lay down the railway line. So all these things require massive amount of capital, so these government issue bonds. There can be one more reason that I would not be taking up into deep consideration, that is to reduce the liquidity in the market. Now, just in case of how COVID happened, a lot of money was printed by the government and set out in the system, repeat, in the cash system of India. So what this leads to rise in inflation prices. Inflation is at its all-time high. So to reduce this kind of inflations, also government use to roll out bonds so that they can reduce the liquidity in the market. Now, second is that these bonds attract a lot of investors, right? Government bonds, because it is a central government that gives out these bonds. So the risk of default, risk of them not paying you back, is very less. And the other reason for issuing government bonds is to minimize liquidity, as I already mentioned. And also, these bonds act as a sovereign bond. We also call it sovereign bond, depending on which country or which you are in. India you would call it as a government bond. In America, you would call it as a sovereign bond. So it depends on a lot of areas as well from where you belong. But also, these bonds are the most safest type of investment considered. They don't generally have a lot of interest rates. They would probably give you a maximum of around 6% of interest on your investments. But since it is safe, so you are guaranteed that 6% you will receive it at the end. Next comes is corporate bonds. Now, corporate bonds are issued by big business entities or small business entities to expand their operational activities throughout the world. Now, they are there's a term which is used, is called as capex, which is called capital expenditure. So they need to make a proper plan where they are investing the money that they are getting after issuing those bonds. So corporate bonds are usually very long-term instruments, and so their maturity comes from 1 year to, let's say, 5 years. So there are two types of corporate bonds. One that are issued by very big organizations like, let's say, Reliance or Tata, that are more trusted ones, right? You will be more than happy to give your money in exchange of an extra interest. But also, then there are some companies that are not very known. They are small capital companies, and they also roll out their bonds. So what would happen is that they would have a higher risk of defaulting. So the first type is called as investment grade bonds. So investment grade bonds are very high quality bonds and are more oftenly for fundamentally strong companies, as I mentioned, like Reliance or Tata. And they also have a lower risk of defaults, but also lower interest rate. So their interest rate would be very less, let's say 4 to 6% at max. So this would be an interest rate of a corporate bond of a big company. Second, we call it a high yield or junk bonds. Now these are issued by relatively less known companies, and their risk of default is very high. They could probably run away with your money if they want. And this is a very high risk type of investment, but also since it is a very high risk, so you also get high rewards out of it. So their interest rate would be somewhat between 7 to 10% at max. So these types of investments are called as a junk bonds or high yield bonds. Next is called municipal bonds. Now municipal bonds are generally considered as a tax saving option or a tax saving bond, because you are not liable to pay any taxes on these types of bonds. But they are less common because they are not easily rolled out, because it's more of a municipal thing, more of a locality thing. So if a small government owned entities want to open a park, let's say, build a park, build a statue, build a flagpole or something, and they need investments for that, then they issue these kinds of bonds, which have a very less, they have a very less interest rate. They are not very attractive. So, but they are also a stable investment to put your money in. The investments would, repeat, the interest rate would probably be around 2%, but still it is considered a very common type, or more stable type of investment. So next we'll talk about what exactly are forex market. So forex market stands basically trading of currencies, right? We always see in news that there are always news about $1 is equal to how much rupees. The dollar has taken a dive. The dollar has increased against INR, Indian rupees. So all these things, how do they come to know? What is the fluctuations that are happening? So that all is done through forex market. Forex market involves buying of one currency and selling of another currency, and it involves buying and selling of currencies. So the profits are booked by buying and selling and predicting the direction in which these currencies are likely to take in future. So it is not necessary that today you buy the currency and you can predict it right now. You can also take a bet on next 2 to 3 months. We call it futures. So you can also take a bet on the future price and trade it today itself. So the forex trading gives a very high rate of interest, but it also comes at a very higher risk. You can lose all of your money at once as well, and you can also gain a lot of money at once. The forex market has two major components called the interbank market and the over the counter market. Now in interbank market, what exactly happens is that large banks trade currencies for their balance sheet adjustment. Now these banks are basically investment banks, or big banks like Goldman Sachs or JP Morgan, Morgan Stanley. So all these banks, they use to trade currencies for the adjustments in their balance sheet, right? They need to make their balance sheets good, so that the investors look at in a very positive way and they don't look at the negatives of it. And the second part is over the counter market, which is for you and me, like retail investors. You can trade in those currencies through brokers and online platforms. Online, some of the banks have their online platform, or general any companies that are in the brokerage firm, they can also do these things. So the forex markets are predominantly divided into three major parts. One is called the spot forex market. The second is called a forward forex market, and the third is called a future forex market. So we'll take a deep look into each one of it. So the first one is called a spot forex market. Now the spot forex market is an immediate exchange of currencies between the buyers and the sellers at a current exchange rate. So whatever is happening throughout the day, that will start in the morning and end in the afternoon. So it does not have a leap over into 2, 3, or 4 days. It's the current day, the current scenario. And most of the trades, right, their deliverables are in that particular day itself. It is not prolonged to next week or long. Most of the trades in spot markets are by bank, dealers, speculators, and brokers. So all the major trades in the spot markets are done by major investment banks, major major dealers, major brokers, and most of the individual and retail investors stay away from the spot type of markets. So big investment banks, as I already mentioned, make up the large part of spot forex trades. Next comes is forward forex market. So in forward forex market, what exactly happens is that two parties agree to trade the currency for a fixed price in future. So it is not today, not tomorrow. So it is basically 1 or 2 months in advance. So they can actually speculate whether the currency will go down, whether the currency will go up. So they take a bet at a number that is in future, right? So now this involves a lot of risk, as I already mentioned. If you don't meet up to the exact price that you are putting your money in, you may end up losing a large chunk of money. That is exponential loss, right? So the next is the two parties can be either governments, individuals, or companies. It is open to all, and they are generally not heavily traded. Hence, they are not liquid. So the volumes of trades in these type of forward markets is less because it is on a very high risk level. Next comes is future forex market. So they are similar to the forward market, but in uh, in future forex market, it is mostly traded in centralized trading markets like in NSE, BSE, or you can actually make your account on these brokers and you can trade it yourself. They are highly liquid because since it is on the centralized trading markets, it does not involve an agreement between the two parties. Therefore, so it has more volumes and hence highly liquid. So, commodity markets, the first question that comes to our brain is what exactly are these commodities? Now, commodities is mainly natural resources that can be mined, or they can be commodities like agricultural products or livestock. So, what exactly happens is that we bet on various energy, spices, or crude industry. So, according to how much volumes that are being extracted, for example, how much gold is extracted, or what are the oil prices that are currently circulating within the world, we take a bet on these prices and we invest in this. So if we think that the prices will go high in the coming future, we'll buy that particular commodity so that it will have a greater gains for us. So basically the commodity markets are divided into two major categories called the soft commodities and the hard commodities. So hard commodities are natural resources that are mined, right? It requires physical digging of a particular land to extract it. So these are like rare earth metals like gold, silver, or it is aluminium, nickel, or oil that is extracted by it's a complex process to dig out these things. So that is called as hard commodities. Then comes the soft commodities. Now soft commodities include agricultural products, livestock like agricultural products like paddy, wheat, coffee, cotton, you name it. Most of the things that are directly grown on land, there probably comes under a commodity market. And also livestock like pork. So all these commodities are also traded like forex currencies. So they have spot, futures, and forwards. Similarly, commodities also have spot, forex, and forwards. So these commodity markets are not a new thing. So around in 1600s as well, they used to happen most of the trades through barter system. So these commodities were traded in exchange of spices, or any other things were exchanged for that matter, and they were also forward market then. So if you have failed to pay a particular price for that particular commodity, you will be probably giving out the things that you grow in the coming future. So this is not a new concept. The commodity market started way back around 200 years ago. So this existed back then also. So next we'll talk about what exactly are cryptocurrencies. So this is the most hyped up type of markets that we all know. All the millennials and everyone who are in their 20s know about these markets because of the hype it has gained over the past decade. Now, cryptocurrencies are a sort of digital currency which is decentralized in nature. So you don't have any intermediary governing institute to look after it. There are no regulations in cryptocurrencies, which is why it is considered diversified type of cryptocurrency markets. Now, every transaction that ever exists is on an open ledger, right, which is accessible to anyone. So what would happen is that in a centralized organization, if it is governing a particular thing, so most of the things you and I would not be aware about. So that is the case why cryptocurrencies were born. So what happened in the 2007 or 2008 market crash? So at that time, all the banks, they gave out bad loans. We call it the housing bubble, right? Most of the banks gave out bad loans to people, and they could not repay the loans. Hence, most of the investors who had the money just in their banks lost a lot of money, right? So in that case, there was a pseudonymous person called Satoshi Nakamoto who discovered Bitcoin, right? He wrote in an academic paper that the currencies should be decentralized in nature and everyone should know what exactly is happening. So every transaction that is made in a cryptocurrency world is on a public ledger which is accessible to everyone. Now, these cryptocurrencies, they work with a particular technology called the blockchain technology. Now, so every transaction that is taking place is almost impossible to change and hard to fake. So which is why it becomes more trusted with people like you and me, that everything is decentralized in nature, everything is open, it is transparent, and so not within one particular organization. Now, cryptocurrencies, they guarantee the value of transparency, hence it is more trusted by you and I. Next is derivative market. Next, we'll talk about derivative market. Now, the derivative markets are a very high volatile markets in which you have instruments called the forwards, futures, and options. Now, these are based on an underlying asset or value. For example, if you have a major stock, let's say Reliance stock or a Tata stock, so it would have a very large value that most of us won't be able to afford, right? So they have a certain section called an underlying asset. So it's like a small kit to that parent company, which you can invest in quite cheap money, right? But that would not be of a particular day or a particular time. It would be in a future, in a forward instrument, in about 2 or 3 months ahead of time. Now, these instruments you can invest your money in, but they are very volatile. Like they can give you exponential losses as well as exponential gains. So I would not deep dive into what exactly are derivative market because it is out of the scope of this particular course. But I will tell you that they are highly leveraged elements and they have a very high risk potential. They are again of three major types called the forward contract, the future contracts, and the options contract. Okay, so let's look at what we have learned so far. So we have learned what exactly are financial markets, why are markets important. Then we learned about what exactly is stock market, how does the stock market work. Then we discussed about the different types of bonds and the bond market, like the government bonds, corporate bonds, municipal bonds, and also looked at what exactly are derivative markets. Then, so we also learned the way in which the currency is traded, what are the different methods in which the currency is traded. And at the end, we also discussed about the commodity markets and also the cryptocurrency markets, which are in higher uptrend and are the more hyped about. In the end, we discussed about the what are commodity markets and also what are cryptocurrency markets. Why are cryptocurrencies so hyped up market? What is the benefit of cryptocurrencies? And also, why does cryptocurrency have such high influence on the young generation these days? So all these things we learned in this course. I hope you had a very knowledgeable session. For more such videos, stay tuned to Great Learning.
Before moving on, let's talk about some of our learning objectives. What is stock market? What are the different terms and terminologies that are used in stock market? Now, the second point that comes into picture is knowing what exactly is share, how are shares rolled out in the stock market, what is the process involved in it. Then we'll talk about the two major stock exchanges in India where companies are bought and sold, that is the National Stock Exchange and the Bombay Stock Exchange. Moving forward, we will know the basics of share market. What does that mean? That means the common jargons that are used in stock market that we commonly hear when we turn on the television or a business channel or a business newspaper for that matter. Then we'll know about the process in which these companies are listed on stock exchange, which is called as the initial public offering. We'll know that in a greater depth. Moving forward, we'll know what type of investor are you? Are you a trader or an investor? What is the difference between the two, and what other type of trader are you? So we'll talk all about that in this particular session. Then we'll know about how are companies fundamentally analyzed. What is the thought process behind that? What are the key components that you need to know to analyze a particular company? Then we'll talk about certain questions that keep coming up when we talk about share market. So all that thing is included in this particular course. So make sure that you have your notebook and pen in hand because this session is going to be a knowledge packed session. So without any further ado, let's get started. Now, before starting to know what exactly is stock market, I would like to ask you one simple question. I would like to ask you one question. Do you know which was the first ever company that got listed in the stock exchange? It has a very significant history attached to it, but stay tuned till the end of this module because I'm going to give you the answer at the end. So let's get started by knowing what exactly is stock market. Now, when we talk about stock market, it is generally the place where publicly traded companies are bought and sold. And when I mention the word publicly traded, it does not mean that the government is controlling these companies. It's not a public sector company. It generally means that a private company is now open to the investments by the general public, which is why it is called as publicly traded companies, in which the investors like you and me, which we often call as retail investors, can put our money in order to expect a good returns out of it. Now, we can address stock market as a mall, right? As a marketplace. Just like how a mall has different shops of different brands, similar to that, a financial marketplace or the stock market has different brands as companies in which retail investors like you and me can go and pick and choose which company you want to put your money in, right? In order to gain hefty returns at the end. These companies can be bought and sold into two such exchanges in India. There are many more, but two prominent ones are the National Stock Exchange and the Bombay Stock Exchange. Now, the investors purchase these shares, which allows the company to grow its business. I'll just give you a hypothetical example. Let's say that you are starting your own company. Right? So you would have very little capital attached to you, but you would have the majority part of the company. Let's say you are owning 100% of the company, but you don't have that much funds, right? So you would be open to investments from other people. So these other people would demand a percentage of your company, let's say 5% or 6%, right? Which is called as initial series funding. So it is series A, series B, series C, series D, and many more series of funding in exchange for the little ownership that you would grant them of your company. Now, what would happen is that there would be a certain stage in your company when you want to grow your business at an exponential level, but you don't have that much funding attached to it. Then what would be the way out? In that case, you would list your particular company in a stock exchange in order to get more money or more funds from the retail investors in return of a part ownership of your company, right? In this way, a company gets its funds to invest its money. In this way, the company generates more funds from the general public in order to meet their capex requirements. Now, what is capex? It means capital expenditure. That is a plan that the companies chalk out for their future expansion, right? Or if they want to get into another country, they want to start a new venture out of it or a new entity out of it, this is how they do it. Now, we have often heard our parents or our colleagues tell us that what, stock market is a very dangerous thing. It is a thing that you should not put your money in. It is a very risky affair. We can all agree to that. We have heard it from someone or the other in our lives, right? So if it was such a dangerous thing, it was a thing that nobody should touch, why hasn't the central government or the Reserve Bank of India already banned such thing? It has some interesting thing attached to it, right? It has something that will improve our life eventually. That is why they have still continued stock markets in India, right? To move the global economy forward. Now, this very question, that what is the need to invest, keeps buzzing us all day. So I will give you a very simple example for it. But before that, I often get reminded about the one particular quote from the legendary investor Warren Buffett. If you can't figure out to make money while you sleep, you would have to work each day of your life. Now, with that thought in mind, I would like to say that by investing, you can deal with unavoidable situations like rising living costs. Now, if you are just a fresher out of college, or if you're just looking for a job, you would know that shifting to another city or shifting to a place outside home is a very, very expensive thing. Now, in order to deal with that, now this would be a major problem, right? Now, in order to use that, you would have your savings. You would save, let's say, 20,000 a month, or let's say 10,000 a month. Now, what do you think? That 10,000 will remain of the same value as it is today in the next 5 years? No, right? The reason is one particular thing called inflation. Now, inflation is something that we can't control. This is something that the global economy controls or the policies of the government control. Now, what would happen if you would have noticed that prices of everything post COVID have dramatically risen? And the reason for that is the low interest rate, which leads to higher inflation rates, which is why it becomes increasingly important for us to know that the money that we are earning right now, the money that we are saving right now in our bank accounts, is not sufficient to sustain a life going forward. We would need to put our money into certain investment instruments, which we will be talking about in greater depth going forward. Now, by investing, you can hope to have a larger sum of money at the conclusion of at your retirement age or something to fund your after work life, right? So that is also one of the most important reasons to invest. Now, people want to be financially protected, right? You don't want to have emergency situations in which you are out of money, which is also the reason why you want to put your money in certain instruments like equity stocks or mutual funds or debt funds. We'll talk about that going forward. Now, apart from it, we also have certain goals and ambitions in life. We also want a fancy car, we want a fancy house to live in, right? To fund all of these things, it is possible in a minimum income if you know how to put your money at the right place at the right time, right? So all these are major reasons for you to invest in the stock market. No doubt that it is very, very risky. It is a place in which you need to have a lot of knowledge to get into, but still you can make a lot of money out of it as well. All right, now let's talk about the different types of financial elements, or we can say financial markets, that are present in the world, right? So we'll start with knowing what is stock market. So the first type of market is called the stock market. Now, since this particular course is based on stock market, I'll tell you about it in a greater depth going forward. But to know about the other markets is also an important thing. So I'll give you a brief idea of what type of other markets are present, right? The second type is the bond market. Now, bond market includes retail investors like you and me giving our money to the government or certain corporations. In return, they give you a particular certificate stating that you have invested XYZ amount in particular government or the corporations in return of a particular interest amount. Now, that interest amount can be varying. It can be from as low as 3% to as high as 10%. But that depends on the time and also on the interest rates. So, bond market, why would people invest their money in bond market? Because it is relatively less riskier than the stock market. So people tend to minimize their risk when they buy these bonds, right? The next type of market is called the commodity market. Now, commodity market involves the buying and selling of agricultural goods or certain things that can be mined like gold and silver, right? So this is called as a commodity market. Now, the commodity market is divided into two components. The one is called hard commodities and the second is called soft commodities. Now, hard commodities involves things that can be extracted and mined like gold, silver, rubber, etc. Right? Soft commodities, on the other hand, includes agricultural goods and livestock, right? Like barley, rice, and all that stuff, right? So the trading of all these things are comes under commodity markets. Then comes derivative market. Now, derivative market is one of the most riskiest type of market that ever exists. So in this particular market, what happens is that you are buying an underlying asset of a particular company, right? Which is called futures and options, right? So in futures, what exactly happens in derivative market is you basically buying an underlying asset, a small part of the original share, but in futures. So let's say you are buying for a particular price 2 months in advance. So that is called as derivative market. I'll not get into too much depth about what derivative market is because it is a subject on its own. To give you a brief idea, this type of market is very, very risky, in which you can lose all the money at once. If you have heard stories when people say people losing all their money, this is the reason why they lose a lot of money, which is derivative market. At the end, we talk about what are cryptocurrency markets. Now, cryptocurrency markets, we all know, are in a lot of hype these days, right? So this was involved buying and selling of cryptocurrencies like Bitcoin, or you have other type like Doji coins and all. So all the meme coins that are coming into picture, all the coins that already exist like the Bitcoin. So all these coins are daily sold and bought. So this comes under cryptocurrency market. Now cryptocurrency market is technically an investing instrument in India because it is not a legal tender to buy and sell a good or a service for in exchange of cryptocurrencies. But people buy it thinking about it is an investment asset, right? All right. Now let's talk about greater depth. What exactly is this course about? That is stock market. At the start of this course, I asked you one question, right? What was the first company that ever got listed on a stock exchange? So the answer is Dutch East India Company, the same company that later came to India. So around 1600, this company got first listed in Amsterdam Stock Exchange, which is, by the way, the oldest stock exchange in the world. Now let's move on to knowing what is a stock. Now stocks or shares are a small part of ownership in a financial asset or a business entity. Now what does it resemble? So, as the name suggests, share represents something that is being shared by everyone, which is the part ownership in this particular case. So, people who buy these shares are called shareholders, and the company divides its total capital into small chunks, small parts, right, of equal value, which is called a stock. So the main reason, right, you would want to know, why does the company issue stocks? What is the reason behind it? Now let's just take a simple example. All right, let's say a company is in a shoe business and it has funds of 10,000 rupees, to make, let's say, 100, or let's say 1,000 shoes. Now for this fund is limited. Now this fund is only for a month, right? And it can make only 1,000 shoes out of it. Now let's just assume that a company got a very big order from someone, right? And the total requirement for completing that order is 50 lakhs. Let's just assume it. Okay. Now it does not have funds, right? It does not have funds that it would need to make that amount of, to complete that particular order. So in that particular case, what would happen is that the company would give part ownership to general public or retail investors like you and me. So it would divide those 50 lakhs, it would divide the 50 lakhs into small chunks. Let's say it divides it into 10 rupee chunks, which comes out to be around 5 lakh shares, right? So this 5 lakh shares into 10 rupees per share, it will roll out. Now this amount is not fixed like 10 rupee. It can roll out 50 lakh shares with 1 rupee face value. Face value is this particular amount that is set. Now it can be 10, it can be 100, it can be 1. It depends on a variety of reasons, the valuation and everything. So we won't get into that. But in a general sense, this is how a share is created. A stock is created. Now then it is listed in the stock market and you have XYZ amount of shares that you can buy. Now how does the price of it increase or decrease? That is completely dependent on the demand and supply of that particular share, right? So if the demand is high, if the supply is high, depending on that, the price of that particular stock increases or decreases. If the stock price of that particular company increases, then it utilizes those extra amount and gives you back as dividends, right? So this as dividends. Now let's talk about the benefits of investing in stocks. Why would you as a retail investor put your money, your hard-earned money into share market, right? So you would want to know what are the key benefits that it provides. Number one is capital gains. So what does it mean? It means that if you've invested in particular stock, let's say you have taken 20 stocks for 100 rupees each, right? That would be, you spent around 2,000 rupees. Now the value of this 100 rupees in, let's say, 2 years went to 1,000 rupees. Hypothetical example. So what would that mean? So that would mean your 20 shares would now be worth 1,000 rupees each, right? That would be 20,000 rupees in your pocket. Now, if you know what would be your profit in that, your profit would be 18,000 rupees. Now, with that amount of profit, you would definitely would be willing to put your money. You have 2,000 and you're getting back 20,000. That is a great deal, isn't it? So the first benefit is capital gains. Number two is dividends. If the company is performing at an exponential rate, if it is performing very well, it is generating extraordinary returns, what would happen is that the company would want the investors like you and me to stay in that company for a very long period. So in order to do that, it would divide those profits into small chunks and distribute it among the shareholders. That is called as dividend, right? Third is the ownership. Now, when you're buying a certain stock of a company, you would also have the feeling of ownership to that company. So you own a part of that company, right? You can go around and say, I have 20 stocks of Tata Steel. I am a part owner of that company. So that is called ownership. Next comes the voting rights. Now, when you are buying shares, right, you would also be given the voting rights to choose the management or the board of directors of that company. That is called voting rights. So that also comes up when you invest in stocks. Then comes IPO profits. Now, what is IPO would be discussed a little later, but I will tell you what is IPO profit. Now, what exactly happens in an IPO is that you are buying a lot of shares. A lot means a lot may consist of 20 shares or 50 shares. That depends on company to company. But you would buy a complete lot of shares for a particular predefined value. Let's say you are buying 50 stocks for 100 rupees each. So you are putting 5,000 rupees as your capital. Now, after this is before the company is listed. When the company is listed, let's say the price that is defined by them is, let's say 500 rupees, right? Now you would instantly gain 50 into 5,000 rupees. That would be 25,000, right? You would have almost 5 times the amount that you invested in an IPO. That is called as IPO profits. So these were the benefits of investing in stocks. All right. So the next module that we will be talking about is what is a stock exchange. But before understanding stock exchange, I would want to explain you what are the two types of markets that the investing worlds deal in. That is the primary markets and the secondary markets. Now, if you talk about the primary markets, when the company raises fresh securities or part ownership. Now, what does this mean? You would have noticed that Flipkart recently got sold to Walmart. Majority of its stake got sold to Walmart. Now, this did not happen through stock market. This happened outside the stock market, in which a very big firm or a firm with a lot of money puts or buys a part ownership in that company. Now, this happens outside the stock exchange, hence it is called as primary markets, right? So securities are created in the primary market. Firms sell new stocks and bond to the public for the first time in this market. Right? So this is all about primary market. The second type of market that we are talking about is called the secondary market. Now, secondary market is also termed as the stock market when it comes to purchasing different stock or equities. Now, I would like to tell you that this stock market is for retail investors like you and me. If we want to buy a small chunk of that company, which is usually less than 0.00001% of that company, we go through this route, which is called as secondary markets. Coming on to what is a stock exchange. Now, stock exchange is a marketplace or a bazaar, we can say, for the stockbrokers and the traders to buy and purchase all the assets, that is stocks, bonds, currencies, and other financial instruments like derivatives, etc. Now, this happens through stock exchanges. Now, in a layman's term, I would like to tell that stock exchange is basically like a mall that we all visit. Just like in a mall, you have different brands in different shops. In the same way, stock market is a financial market of or a financial mall in which you have different companies that are listed in exchanges. For an India's perspective, we have two major stock exchanges in India, which is called the National Stock Exchange and the Bombay Stock Exchange. So most of the companies are listed in these two stock exchanges only. Now let's look at how does the stock market actually work. So stock market consists of three key players. Number one is the stock exchange. Second is the stockbroker, and the third is us, that is retail investors. Now let's look at the work of all these three entities. Now, when we come to stock exchange, the major work is to get the company listed in that particular platform and to maintain a depository for the same, right? So There are two major depositories in which your stock gets stored. Number one is called CDSL, which is called as Central Depository Service Limited, and the second one is NSDL, National Securities Depository Limited. So these both entities store your stock or shares. Now, what is the work of a stockbroker? So, stockbrokers are listed on repeat. Now, stockbrokers are the members of stock exchange that conducts the trading on the behalf of a retail investor to put their money in the stock exchanges. Now, basically, they are called as dalals, in which because they move money from one party to the other party. That's their work. Now, when we talk about why we need stockbrokers, is because they make the work more fluid. Since India follows a T+2 settlement period, which means that if you are buying a particular stock today, you will receive that particular stock at the end of 2 days. So this type of thing can be very, stressful for a retail investors that does not have much knowledge about the financial market. So in that scenario, it becomes essentially important to have stockbrokers that would help in the transactions that you're making from your side to the company side. Now, stockbrokers are many that are there in the market. It is ever growing. Post pandemic, it has sky boomed the number of players that are in the brokers business. You would have ICICI Securities, SBI Securities, HDFC Securities, you have Zerodha, you have Grow, you have tons and tons of different brokers that are currently available in the market. Now, when we talk about retail investors, so we as retail investors, what do? We open an account with a stockbroker. So we open an account with a stockbroker, we give them our money, and then we decide which stock we have to buy, either by phone or today everything is on internet, so every transaction can be made online. Now, when this happens, you have to have a bank account, right? Bank account is a must. So you need to have a savings bank account in which you have all the money stored. Now, this bank account is one account that everyone holds, right? On the top of it, for trading in companies, you would also need a demat account. Okay. Now, demat account holds the number of shares that you are currently having. So it is stored in CDSL or NSDL that we already discussed. But what happens that on your side where your stock is there, that would be your demat account, right? And then you have a trading account in which all your securities can be sold or bought at any point of time during the market hours. All right. So this is what happens. Now in India, the market timings are from 9:15 a.m. to 3:30 p.m. from Monday to Friday. And there can be a lot of holidays in between. That is another story. But mostly it operates from Monday to Friday for equities in from 9:15 a.m. to 3:30 p.m. We have already discussed what is the need to invest from a retail investor's point of view. But now let's look at the benefits that the companies get when they list their particular companies on the stock market. Now, the first point that I would like to tell you is that this helps in raising funds. As I already mentioned, there's something called as capital expenditure that the companies look forward to, and the companies make a plan. They chalk out a plan where what amount of funds are needed for what amount of projects, right? So all these things are taken care of in their capital expenditure. Now, this also acts as an exit route to the existing investors or the promoters, if there are any. So what happens is when the companies list a particular stock in the stock market, then what happens is that there might be some investors or promoters that want to leave the company. So they would exchange or they would get out of that particular company by leveraging their particular portion or the part ownership that they have to the stock market, to the secondary markets. The second point now is that for raising further capital for the future development of the company, as I already mentioned before, capital expenditure, if they are opening a new branch in a particular city or they're expanding globally to a new continent or to a newer country, this is what listing on the stock market is what helps them achieve that goal. Then it leads to the liquidity of the security. So it tells you how much liquid, how much Now it tells us that if the company is going to be bankrupt soon or not. If they have enough cash, if they have enough liquid money attached to it, then the company is in good hands, right? It also depends on the nature of the management that is handling that particular company. Then it reflects a true and fair price of the stock. Now, as a company, you would always want to know the clear or to a true picture to its consumers, that how does the company look like, how are they a growing company, are they a valued company. So all these things tell us the what is the fair and a clear picture of that particular company. So this is why it is the fourth point, reflects a true and fair price of the stock. So the next module that we will be talking about is called the basics of a stock market. Now there are certain commonly used jargons that we hear on a day-to-day basis, right? So let's discuss some of them. So the first one is called the bull market. Now bull market is a market when the prices of the stock are in an upward trend. What does upward trend mean? It means that on a month to month basis or a week to week basis or a day to day basis, the price of that particular stock is increasing than the previous day or the previous month or the previous week, in whichever time frame you are looking at the stock at. So this is considered as a bull market. Now the bear market is considered when all the trend lines are falling downwards. The stock is not performing well, its value is decreasing month on month, year on year, week on week, and day on day. So this is termed as a bear market, right? So now the fluctuation in prices, right, it depends mostly on the supply and the demand, the bull side and the bear side, the people who are selling the stock and the people who are buying the stock. Now we always hear in news that the bulls have taken over the market. It means that there's a strong momentum going towards an upward trend, which is why it is called that the bulls have taken over the market. Now when the stock market is in the downtrend, then we generally refer to as the bear market. The bears have taken over the market. So these are the two commonly used terms. Then is called the face value of a stock. As we already discussed before what it is, I'll reiterate it. So for example, if a company needs a 50 lakh rupee, repeat, 50 lakh rupee is their capex or their capital expenditure requirements, then what would they do? They would generally roll out 5 lakh shares of 10 rupees each. So this 10 rupee is 10 rupee per share. So this 10 rupees called the face value of that stock. Now next comes 52-week high or low. Now 52-week high and low generally means that the highest value of that stock that has been achieved in 52 weeks or basically in an year. Similar to that, the lowest price that the stock has achieved in 52 weeks or 1 year is called 52-week high or low. Next comes the upper circuit and the lower circuit. Now, as I already mentioned before, so there is a governing organization called SEBI, which is called Securities and Exchange Board of India. Now, this particular organization is run by the government. It's a regulatory body which takes care of all the trading that happens in the markets. Now, money is a very sensitive issue. Now, it can lead to a lot of malpractices or fraudulent behaviors that we would see in the market. So, in order to curtail that, in order to maintain the decorum of the markets, so SEBI regulates most of these things. Now, one of these things is called the upper circuit and the lower circuit. Now, what usually happens is that the government does not want the investors to lose a lot of money. Just imagine a situation in which a company is trailing all good, and suddenly a news comes that the entire management has resigned from the company. What would happen to that particular stock? Everyone would keep selling that stock. The reason for that is they do not believe in the company anymore. They would not believe that if the company would exist in the longer run, and their money would not be given back to them. So in certain cases, the prices of that particular stock would fall rapidly. It would crash, right? So in order to protect that, there's a limit to which it can go up or down, which is called the upper limit and the lower limit. So from a fresh day, a fresh limit is set. It usually is in percentage, like 10 to 20% of the stock's value or something like that is the upper limit and the lower limit. So when that particular stock hits that particular limit, right, then the trading stops in that particular stock. Either ways, upwards or upper circuit or lower circuit does not matter, but the trading stops if it touches that limit. So in order to protect the retail investors in order to protect the money of the retail investors. This is what the SEBI regulates on a day-to-day basis. So the next module that we will be talking or discussing about is called the IPO markets. Now, we have had a brief discussion about it in the previous modules, but in this particular module, I'll give you an overall outlook of what IPO is and also know about a case study of Zomato. So let's get started. So IPO basically stands for the initial public offering. Now, what happens in this particular scenario is that privately held companies offer its shares to the public for the first time. Now, this means that these privately held companies are now publicly traded companies in the secondary market. Remember, we already learned about the primary markets in the previous module. The same thing is when the company gets into IPO, it basically offers themselves, it basically tells that I am open to public investments, and public investors are basically you and me, which is called as a retail investors. Now, the shares can be traded in the secondary markets by the retail investors as well as two other types, by retail investors and also foreign institutional investors and domestic institutional investors. Now, what are these investors? They are called as FIIs or DIIs, which means that they are institutional banks, basically, which is called iBanks, or maybe fintech companies that want to put their money as investments in these companies. So for them also, secondary market plays an important and integral part of their earnings. Now, for a company to get listed in an IPO, there is a proper staging, there is proper steps that need to be followed. So the first step in doing so is called due diligence, which is done by majority of the accounting firms that are there. So what exactly happens in due diligence is that they check if the financials are correct, if the company is on track of what they propose to be, and also if there are any malpractices or misdoings that are done by the company. So all that things are taken by these accounting firms, and then they are reported to SEBI. SEBI is the Security and Exchange Board of India. So now they have the first step that the company has to do is they have to prepare a document called DRHP document. Now, what does this mean? This means that it is a draft red herring prospectus, which basically tells about how the company is performing, what is the potential loss that the investors can have if they invest in the company. They perform a SWOT analysis, which is called strength, weakness, opportunities, and threats. So they list out all these things in their document called the draft red herring prospectus. In order to know about this, you can visit the SEBI website and find it. I'll just show you how it is. So if you go to SEBI website, you would see something. Okay. So if you go to the home tab, filings, public issues, then you will come to this particular section called draft herring documents filed with ROC, or you can have draft offer documents filed with SEBI. If you click on that, then you can get the number of companies that have applied for their IPOs. So if I see in general case, I'm taking an example of Zomato. So I'll see when was Zomato had its okay, here it is. On April 28th, they filed this DRHP here. So if I click on it, then a window will open and I can actually see what this document is. Now, this document is a very big document. It is not a 10-page or 20-page document. It's around 500 pages document, which gets the details of everything that the company does or has done in the past or about to do in the future. So it just tells us about what are the management think about the company, and also about what are their future plans or what are their potential risks involved in the business that they are currently dealing in. So along with that, it has a brief description of if there are any legal matters that the company is engaged in. Are there any cases that are filed by the consumers against the company? Also, the document tells us about what is the management, what are the promoters of the company, who are the investors, who are the big investors that are there present in the company before getting listed to the stock market, and also if the company is pledging its shares before listing on the stock market, which means that they want to exit the company before it is listed, or they want to reduce the percentage amount in the company. So all these things are mentioned in this document in detail. All right. So this is the document that is called DRHP. So you can see that the name of the company is written here. You have written draft red herring prospectus. The date is mentioned and everything is there. So
if you go through this, so as I mentioned before, they have to do due diligence and everything. So the one that helps we call it the merchant banks, which helps the company list it in the IPO. So these are the merchant banks: Morgan Stanley, Credit Suisse, Kodak, and all these things. So you have mentions of everything in this document. Now, if you see the table of contents, it has basically everything: general, the risk factors, the introduction, the offer, what they are planning to raise. For in case of Zomato, they are planning to raise around 9,000 crores from this IPO, which means that there is a fresh issue of securities worth 9,000 crores. And then there will be some promoters or some existing investors that want to exit the company or lower its share in the company, which is around 375 crores in case of Zomato. So the total amount that they are raising through IPO is 9,375 crores, around that. So this is what they are offering. And apart from that, they are also, as I mentioned in the previous module, that there's something called as face value of the stock. So they have kept their face value as rupees 1. So that is how they're issuing their shares to in the secondary markets. All right, what else is there? Our business. So if I click on that, it will land me into this page called Our Business. So it will tell you basically what the company is about, what they are doing, what they have. So we already know, let's say they have Zomato Pro, dining out, food delivery is their business and everything. So they have mentioned it, what they are doing, how many restaurants are they covering throughout India. They have mentioned it. We have around 1,31,000 something active delivery restaurants every month. So this is mentioned. You get a whole view of what this is. You get to know how the company functions from the basic level to the more complex levels in this particular document. So it will also tell you about the growth prospectus, what will happen, what has happened, its basic financials, basic, balance sheets, and all those things will also be covered in this document. All right. So basically, the company wants to sell itself in a much more positive way. So they will be displaying a lot of information that might feel like there's too much to the company, but they will be rolling out something that would be really, really helpful for the investors to, attract them to buy it in their IPO. So this is their major purpose with this document. All right, getting back to what we were discussing. So what happens is the IPO is listed. How do we know? So in your Demat account, in your Demat account, there will be a portal to invest in IPOs, to apply for IPOs. So what happens is, first is their open date, which is called the first date in which you can buy shares by a lot. Okay, I have mentioned it before as well. You buy shares in lots. So if the issue price is in a band, let's say from 75 to 79, right? This is a band. Now you can select any price in between this. So let's say if you buy 75, and they will mention it in their particular document, what is the size of one lot. If the one lot is of 25, so if you buy 2 lots, then it will be into 50. So this is the amount you have to pay during the issue. And remember that if you are giving your money in IPOs, it does not really mean you will be allocated that IPO. It depends totally on the company if they are willing you to give that IPO to you or not, right? So you would have first the open date, then you would have a close date in which the amount they want to receive, if they have received or not, then that would be an open date. Then comes the allocation date. So allocation date will be much later than the open date and the close date in which they will allocate it. If you have received the allocation, you will receive the shares in your Demat account later. If you haven't, then the next phase comes refund. Refund if you are not allocated any IPO. Then comes the credit to Demat account, to your account. If you have been given the shares will come to your Demat account. Then finally, it is called the IPO listing date. Listing date is the day in which the company gets first functionally traded on the stock market. That is called the listing date. Now, why do people should invest in IPOs? Now, the major purpose is that if it is a very high trending company, right, then everyone wants to put their money in. Now, what would happen? Let's just say that I'll give you an example of this only. If Zomato's cut-off price is 79, let's say, and you're buying 50 shares out of it. Now, 50 shares, when it gets listed, let's say it goes to a price of 131 on their first day. Now, you would earn approximately how much? Let's say for 50 rupees per share on their opening day. So, your time duration of investing is reduced to just 2 days, right? You will be earning 50 rupees. That's more than 20% of what you will be investing in. So, you'll get a returns of that massive amount within days, which is why the compounding period is decreased with so much earnings. That is why you should apply to good companies for IPOs in which you believe your money will be grown to a higher levels in that IPO. So that is why you should invest in IPO of good companies. Now, if you are someone who is very new to the markets and who does not know much of the jargons that roll around in this particular domain, so this particular module is for you. Now, you need to understand what type of investor are you. Are you a trader? Are you a day scalper? Are you a growth investor? Or are you a value investor? So all these things will be told to you in this module. Let's clear all the conceptions and move forward. So now let's look at what are the different types of investors that are in the stock market. So it can be a day trader, a scalper, a value investor, a growth investor, or a swing trader. Now let's see what each one of them are in greater depth. So a day trader is someone who opens and closes his trades on the same day. So he does not carry forward his positions to the next day, right? Which is also known as intraday trades, okay? Which is also called as intraday trades. So market, as I already mentioned before, opens at 9:15 a.m. to 3:30 p.m. for equity stocks from Monday to Friday. So this particular type of trader would start his investing around 9:15, or throughout the day he will take his trades for a few hours, or when the market opens till the market closes. But he need to close all his position, okay? He need to close all his position by the end of this period. He can't carry it forward to the next day. So that type of trader is called a day trader. The next type of trader is called a scalper. Now this type of investor is basically who buys a lot of chunks but sells it within seconds. What does this mean? So let's just take an example. So if a person is buying, let's say 10,000 shares of a particular XYZ company at any price, right? Let's just not get into it. Let's talk about the quantity. So quantity is 10,000 shares. Now, if the price increases by 1 rupee in, let's say, 2 minutes. In 2 minutes, the price increased by 1 rupee. Do you know how much amount of money he'll make? He'll make 10,000 rupees straight on that trade. He'll make 10,000 rupees straight in 2 minutes. It's all because of the quantity. So he's dealing in the quantity rather than the time. There are two important factors in trading. One is called the quantity. The second one is the time. Either you can make money by having lots and lots of amount of capital and just invest it for seconds. If the price moves 50 cents or like 50 paisa, or it moves 1 rupee, you sell the stock. So that is what a scalper does. He does not take trades more than, let's say, 5 minutes or 10 minutes. That's the maximum thing. So scalper makes quick money with large amount of capital. Next come value investors. Now, the goal of this type of investor is to find good firms that have been in correction. When I talk about the term correction, it means when the markets are down. Okay. So when the market sentiment is down, this value investor will buy it. And regardless if the company is there in its peak of the time or whether it is anywhere. So now this type of investor would value the company fundamentals more. So what does this mean? This would be more of like Hindustan Unilever or let's say Infosys or let's say TCS. So these companies are a very good buy. They are fundamentally strong companies. So he will take a bet on that companies when the market corrects. So there's always a term called buy low, sell high. So if the market is going down, he'll buy it. If the market is going high, he'll sell it, right? So he'll make money out of it. So this is called as a value investor. Next is called growth investor. Now, the aim of this particular investor is to hold on to their stocks for at least 10 years or 15 years, because he knows that this particular stock, if it is trading at, let's say, 100 rupees, it will become 1000 or 5000 rupees in near future, in around 10 years time or 15 years time. What now, just give it a thought, what type of sector this particular investor will target, right? So what would be the future of the world in general? If I have to guess, I would say the green energy sector, because the fossil fuels are limited, the coal is limited, you can't run on fuel for longer. So you will take your bet, you will invest in companies that are into green sector. What would that be? That would be Tesla, let's say. That would be Adani Greens, any company that deals in solar energy, wind energy. So that would be a growth investor's perspective of investing in those companies. Right. So the goal is to find the businesses that are likely to grow considerably as a result of rising industry and macro trends. What does macro trends mean? Similarly, in a layman term, what sector would improve in the coming future? That's the question that comes into the mind of a growth investor. Next, we talk about a swing trader. Now, this is a very interesting type of investor that keeps his trade for maybe a week, maybe 3 days, maybe 4 days. Range depends on the type of trade he's doing. So what is his target to achieve? I'll just show it with a simple graph. So let's say this is a market graph. This is the price and this is the time frame. Okay. So let's say this is first day, second day, third day, fourth day. Okay. So he'll be targeting companies that have the potential of swing trades. What does this mean? He'll look for if a company is making higher highs, which means that I'll not get into much depth of technical analysis, but I'll say that this is a rejection point of this stock. This is a rejection point of this stock. This is a rejection point at this point and this point. So if you see, if I make a straight line, so this is something that happens, which is called as a trend line. Right. So if he's a swing trader, he'll probably buy the stock at this point and sell it here. Right. Buy it here again, sell it here. Buy it again, sell it here. So he knows that this is how the company is making it. It is making higher lows, higher highs. So this type of investor would just look at the graphs, which is called charts, we call it, and look at the charting patterns. In order to be a swing trader, you need to know something called as charts, right? You have chart patterns that are there. So you need to know all about that, how different types of patterns are there, head and shoulder pattern, raising wedge pattern, flag pattern. So all these patterns are there. So you need to learn about that. If you really want to learn, I can make a video on that as well. Just let me know in the comment section below. So now let's just assume that you are a very new investor to the stock market. You don't have much knowledge about how the market works. So what would be the criteria that you would decide to put your money in, right? What is the way that you would know that, okay, this is the particular stock or this is the particular company that you want to put your money in? To answer all these questions, there can be multiple ways. One could be a very easy way in which you turn on the news channel that gives you business news and listen to the stock tips that they are giving you. Right? So that can be one of the ways in which you can put your money to know which company you want to invest in. So the drawback of that particular thing is that a lot of people would be watching the same stock tip, right? Same stock suggestion that the channel is providing you. Now, what would happen is that, as I already mentioned before in the previous modules, that stock market, the price of a stock moves by the balance of supply and demand. Now, in this case, if a lot of people are looking at the suggestion to buy a particular stock, then there will be imbalance in that thing. And that would lead to the investors like you and me losing out on a lot of money. So what can be the other way around to counter this? Now, the other way is to fully understand how the stock market operates, to know what are the in-depth views that the investor look at when they are analyzing a particular company. Now, this calls for two different analysis. One is called the fundamental analysis. Second is called technical analysis. Now, what happens in a technical analysis is that, as the name suggests, it would deal purely on mathematics and algorithms that the investors make or people who analyze these stocks make. Now, this includes knowing a lot of mathematical complex equations, knowing different charting patterns, different technical elements and indicators like the moving average, MACD lines, Gantt charts, etc. Different indicators like you would have moving average, you would have MACD lines, you have different types of exponential moving average. So all these things are considered while looking at the technical analysis. On the other hand is fundamental analysis. Now, fundamental analysis is basically knowing how fundamentally strong a company is. What are their valuations? What are the proper cash flows that the company has? How strong is the foundation of the company in terms of the management? So all these things are looked upon in the fundamental analysis point. Now, it is a way of determining the intrinsic value of securities by looking at the linked economic and financial elements. So what is this economic and financial elements that has been talked about? So it's basically certain financial statements that we need to look at, certain financial ratios that we need to look at, and also look at the sector in which the company is operating. Is it the steel sector? Is it the food business? Is it the e-commerce? Or is it a financial company? So what are the different elements? Repeat. So what are the different sector in which that company is operating? That is a must to know. Then is it a monopoly in that particular sector? Or and does it have good competitors? So all these things have to be looked upon when you are analyzing a company to invest. Now, fundamental analysts look at everything that can influence the value of that security, of that stock. Microeconomics, macroeconomics, both are important. Macro would include how the state of economy is, how does the Indian markets are growing in general, what is the GDP growing in general. So all these things matter when it comes to macroeconomic values. Second is the microeconomic elements that would involve the company's management. Does the CEO of the company or does the chairman of the company believes in the way they are doing things? Are they constantly improving, constantly analyzing the way they are operating? So all these things have to be looked upon when you are analyzing a company to invest. Now, there are certain key elements to fundamental analysis. Number one is that fundamental analysts generally look for long-term investment. So if you are fundamentally analyzing a company, that would mean that you are analyzing a company for the next 5 years or next 10 years or so. Because in technical analysis is mostly if you're doing a swing trade, as we mentioned, or if you're a day trader, that would make more sense because the value of the stock that is increasing or decreasing in a day would matter to them. But for a fundamental analyst person, for a person who would not know more about the stock markets or much about the stock markets, then for him, long-term investments would be a better option, right? He can't afford to lose money on a day-to-day basis. He wants to put the money in a fundamentally strong company so that it can grow exponentially moving forward. Right. Second is knowing about the basic financial statement. So basic financial statements are typically three types. First is called the balance sheet. Second is the income statement. Third is the cash flow statement. Now, balance sheet involves knowing what are the assets and the liabilities of that particular company. Right. You have an entire sheet that describes what are the total assets of the company, what are the total liabilities of the company. Then comes profit and loss statement or the income statement. Now, this tells you about the revenue and expenses of a particular company. What is the revenue coming from? What is the expense that the company is doing? All that stuff is in P&L statement. Then comes the cash flow statement, which tells what is the actual cash in hand in the company. What are the different elements to it? Now, if you want to know more about these financial statements, we do have a course on basic accounting and financial accounting. So you can look at that to get a greater depth of these financial statements. Then comes recognizing firms in relation to the industry in which they operate. So exactly how you have to do the market research. Is the company a particular monopoly? Let me give you an example. IRCTC is a stock of Indian Railways, right? So that is a monopoly because it does not have any competitors. So it may be a good outstanding stock, but again, you have to look at different fundamentals, where they are getting their money from, revenue from, and all that stuff, right? So you have certain monopoly stocks and you have certain stock that have so many competitors. Right? So like financial companies, you have a lot of competition in that. Banks, you have a lot of banks involved. So there are certain monopolistic companies and certain non-monopolistic companies, or the companies which have a lot of competitors. So you need to look at that as well. You need to do your basic market research on how the company would perform in the longer run. Then comes learning about the management of the company. Now, if the company is fundamentally strong, the second point that you need to look at is if the management or the board of directors of that company stand by the company, stand by its employees. Are they providing good facilities to their employees? Are the promoters of the company not too much selfish about getting money first to themselves? So all these things have to be taken. Do they have a good vision for the company in the future? So these elements are involved when you look at company for a long-term investment perspective. So next we'll talk about some frequently asked questions on what about the stock market. So we'll know about that in a greater depth. So what the most important question that people keep asking me on a day-to-day basis is, what, Madhur, tell me what are the key events that impact the stock market? Now, some of that I've already mentioned in this video, but to know that in a more detailed way, I'll give you certain pointers on that. So number one is supply and demand. I've always told you there is a constant fight between the bulls and the bears. That means the ones who want the price to go up and the ones who want to sell that particular stock and want the price to go down. So the constant rivalry between the supply side and the demand side leads to fluctuation in prices. That's number one. Second could be the company related affairs. If the management of the particular company resigned all of a sudden, right, there will be a huge decline in the price of the stock. So that would be one of the reasons. If the management is not strong enough, if the management is good and visionary, the price of the stock may go even higher, right? So we can see that in case of Tesla, let's say, right? So that depends on the company related affairs. If they are very progressive, very visionary towards the future, then yes, that would be a good stock. That would be considered as a good stock. But then you have to look at the fundamentals, the technicals and all that stuff. Third comes the investor sentiment. Now, market is a very sentimental place. What does that mean? It means that it would depend purely on the basis of how people react to situations. If people are too nervous, then they'll want to sell that particular stock, right? If people are too fearless, they would buy that particular stock more. So the fear and the greed of to get more money could also lead to the fluctuation in prices, which is called as the sentiment of the investor. Then comes the interest rate by central and federal banks. Now we know that you have to maintain a balance between low interest rates and then inflation rates. So, if whenever these things change, right, whenever these things have an impact by the RBI, when they have certain regulations that come into picture, the market reacts to it. Market reacts in a way to know if that is a positive news or a negative news. We have heard repo rates, we have heard interest rates being changed by the central banks. India has RBI as its central bank. So the things that impact it, so such news also impact the way stock market prices go up or down. Then comes political news. Now, India is a very politically strong country, right? India is a democratic country. It has a lot of political parties. So the way India is growing forward would depend on the central leadership of the company, right? So various political events that take place. Let me give an example. If company's government is open to cryptocurrencies, or are they banning cryptocurrencies? So such political news, such political governance news can lead to a lot of impact in the market, right? In the sentiments of the investors. So political news play a lot of big role in the way if there is an election that is happening, if particular political parties have changed. So that things also play a huge part in knowing whether the price of the stock is moving upwards or downwards. Then comes natural disaster. Now, this is the most recent one, and we would know about it that during COVID, the news of COVID struck and the market went down by almost 10% or more than that. So such natural disasters like COVID-19 could lead a huge impact on the country's economy as well as stock market. So if you would actually see the charts of what happened during that time, you would know that, okay, this thing was not good enough and our market crashed because there was no vaccines till then in March 2020, right? There were no hope of a vaccine, and it would seem a catastrophic affair that everything would just go on, people would continue dying. So the market was very weak at that time and it lost a lot of value. People lost a lot of money. So natural disasters can also lead to impacting the share market, right?
So after learning about stock market through the modules, now it is the time to know what you have learned so far. So we started by knowing what is a stock market, how are publicly traded companies bought and sold. Then we found out what is a stock, how are companies divide their capital into smaller chunks of ownership that they roll out in the stock market. Then we talked about what are the two major exchanges in India, stock exchanges. Number one is the National Stock Exchange. Number two is the Bombay Stock Exchange. We discussed about that. Then we talked about what are the basics of stock markets, what are the commonly used jargons that are used when it comes to trading in the stock market, whether it is the bear market, the bull market, the upper circuit, and the lower circuit. Then we discussed about how privately owned companies get public, what is the process called, that is called the IPO, how it is done, what is the storyline behind it. We discussed all about that. Then we discussed what type of investor are you? Are you a trader? Are you a day trader? Are you a scalper? Are you a swing trader? Or are you a growth investor? So all these things we discussed in the module trading versus investing. Finally, we learned about what is fundamental analysis, how do we do fundamental analysis, what are the key high elements that are involved in the fundamental analysis. Finally, we also discussed what are the key events that impact the stock prices of different companies, right? So all these things we discussed in this particular course. Hope you had a fun session, and for more such videos, stay tuned to Great Learning.
Hello friends, welcome to this course on asset management. So what exactly we'll be covering in this course is nothing but, as the name suggests, how to manage assets. So what exactly is asset? So we know assets are something which are being owned or invested by certain persons, so that these kind of investments or these kind of assets to which we have made the investment would be helping us to create wealth. That is exactly why we need to be having assets, right? So that's exactly how assets are going to help you as well. So simply by having an asset would not be enough. You need to be making the investments to buy the assets or to own the assets. And after owning the assets, you can't simply, say that you own the asset and the asset will be making money or will be building wealth for you on its own. So it is not like that. You should be knowing how to manage your assets well, so that only then you will be able to manage, and only then you will be able to get returns, higher returns, by owning or by managing your assets well. So you need to be knowing how to manage your assets, what are the various methodologies need to be following while managing your assets, and what are the things that you need to be keeping in mind or to be aware of by owning and managing any assets. So that's exactly what we are going to be covering in this particular course on asset management. So let's understand now what are the topics that we will be covering in this course on asset management, so that you will have a clear idea on the holistic view of asset management. So let's move on to the agenda and see what exactly are we covering in this course on asset management. Coming to agenda. So the topics which we will be covering in this course are: what is asset management? That is the first topic that we'll be starting off in this course on asset management. So we need to be knowing what asset is, and then only we'll be able to understand how to manage assets, right? So in order to manage assets, you need to be first understanding the clarity or clear idea on what exactly an asset is. So after that only you will be able to understand how to manage or how to create wealth by owning or by managing an asset. So that is exactly what we'll be covering in this particular course in the beginning. And after understanding what is asset management, we'll be moving on to understand need for asset management. So what exactly is the need for asset management? Won't asset be building wealth for us, or should we be doing something to manage assets? And what exactly is the need or requirement for managing the assets? So assets are actually supposed to be making wealth or building wealth for us. So what is the need for asset management? How can we manage the asset properly, and what are the benefits of having asset management? So that is actually what we'll be covering in the second topic, that is nothing but on the need for asset management. After understanding on this, we'll be moving on to understand what are the several tasks involved in managing an asset. So what are the several tasks? You need to be doing your research, you need to be doing your investments, you need to be managing your assets, you need to be making sure that the asset is actually building wealth for you and not a liability. So you need to be doing all these things while managing an asset. You need to be taking an informed decision whether to make the purchase or whether to make the investment. So to getting all these things you will be doing, right? So in order to do that, you need to be having an idea. What are the tasks required? How is it actually good to make the investment? Who will be making the investment? what are the rules and regulations required, and will it be possible or will it be feasible for me to make the investment in such scenarios. So all the tasks associated with asset management will be dealt with in this particular topic on tasks involved in asset management. Right after this, we'll be moving on to the next topic, that is nothing but types of asset management. What are the various types of asset management? There are several ways or several types of assets as well. So apart from this, we were also having types of assets management as well. So depending upon various types of assets, we'll be having different types of asset management as well, because the kind of management that we'll be able to implement to each type of assets would be differing. So based on that, we'll be able to manage the assets. And that's exactly what we'll be talking about in the types of asset management. Then we'll be moving on to our last topic in this particular course, that is nothing but the challenges associated with asset management. What are the several challenges which we will be facing while managing an asset? So each and every task will not be easy, right? So in here, when we are managing assets, it's a huge investment and huge capital has to be raised while managing or while buying or by owning an asset. So it is of huge amount, right? So while managing an asset, it is coming to a higher picture. So the kind of amount and the kind of money and the kind of risks involved in managing an asset would be high. Therefore, the kind of challenges that you need to be facing while managing an asset will also be high. So that's exactly what we'll be covering in the last topic on this particular course on asset management. So by understanding the topics, let us now dive deeper into each of these topics one by one to understand what all are these and how we can be able to manage assets in the best way possible. Coming to our first topic on this course on asset management, that is nothing but what is asset management? As I said before completely going to understand what is asset management, we should be knowing what is asset. What is an asset? For example, an asset can be classified in several categories based on person to person or on the business you're actually trying to organize or the business you're actually running. So based on that, the assets would be differing. So for example, an asset can be something which is of high value, which is useful for you to bring up something or for your business to be running. So it can also be something which can help you build your wealth. So all these things which fulfill these criteria can be classified as assets, which is of high value, high potential, and something which is of useful and also which will help you build wealth. So after understanding on asset, we should be knowing how to get wealth, how to manage your assets, and only then you will be able to make use of the asset properly, right? So that's exactly what we'll be seeing in this module. Asset management is the practice followed to increase the wealth over time by acquiring, maintaining, managing, and selling investments. So actually, by understanding this, we know that asset management is a practice. It is not a task. It is not a procedure. It is actually a practice of following to increase your wealth. It actually aims to build your wealth, get more returns, and also bring value to you as a person or to your organization which you're actually working for or for your business which you are running. So all these things which are helping you to build all those things can be classified as asset, and the procedure or the practice of managing that can be called as asset management. And in asset management, we look on after acquiring, maintaining, managing, and selling investments. So in order to have an asset, we need to be acquiring the asset. We need to be owning the asset. We need to be making the investment to own the property, own the asset, or own something which is going to build your wealth. So that is actually nothing but the first thing you need to be acquiring asset. Then comes maintaining the asset. Simply by acquiring the asset, you won't be able to get in more value or return on your investment. So in order to get that, you need to be maintaining the assets in the proper manner. So if you are actually not maintaining your asset, the value of your asset which you are possessing would be going down. So you need to be making sure whatever investment you're actually made, you need to be making sure you're maintaining it in the proper way so that you are not losing out on the value on your investments. Then you need to be managing. How can it be managed? How can the asset being used in order to create the wealth? So you need to be knowing on that. So what are the things or what are the precautions or what are the steps that is to be followed to convert or to use this particular asset in order to bring in wealth or value to your creation? So that's exactly nothing but how to manage your asset. Then comes on selling. So Just by having an investment would not be always bringing you any money or any wealth. So in order to get that, you need to be knowing on when to sell an investment. For example, if you are making an investment on stock market, you need to be knowing when to sell the stock. So if you're not selling the stock in the right moment, the market can be crashing and you may not be getting anything out of the wealth you're actually investing. So maybe if you had sold at some time before, you might have got a profit, but now the market has crashed and the wealth you're actually possessing were lost. So it is also important for you to understand when to sell your investment as well. Asset management is a service offered by financial institutions to make your wealth considering the risk factors in the market. So financial institutions also help you to manage your asset. They are actually a group of people or a team which is being employed to make sure the asset which you possess or which you own are going to build you wealth and is going to add value to your investments. So that is exactly what these financial institutions are trying to help you out with. The financial institutions will be doing a thorough market research so that they'll be knowing what is to be done, what is the investment to be made, in which sector is the investment to be made, and by how long will you be getting this particular return on this particular investment. So all these things would be done by financial institutions to help you manage your asset in a more effective manner. And human resources, capital, property, goodwill, data are all assets to any organizations. So for example, the human resources can actually be classified as an asset because the human resources team who are actually working for your business or to your organization are actually trying to build your wealth and also trying to bring in more business to your company. Thereby employing human resources or by having human resources, you're actually getting more benefited. It is actually helping you to run your business, and thus human resources can be classified as an asset. Coming to the capital. Capital which you invest in any property is actually having the motive to bring in more money. So capital is always an asset. You do not need me to explain much on capital to convince you that what exactly or how exactly capital is going to be an asset for you. Now coming to property. Property. In real estate business, you would be knowing much on this. So that if you're owning a building, owning a plot of land, and you will be able to get more return as the time passes. So the investment which you have made on any property right now would be bringing in more value in few years. So that is exactly how property can be an asset. Then comes goodwill. The kind of brand value you're creating through your business, the kind of potential people you're actually employing to bring in loyal business and loyalty in the market, it will be helping you to bring in that particular goodwill to you. For example, if you're taking the example of Tata Group is actually run by Ratan Tata and is actually having huge potential. So the kind of goodwill Tata has created over the period of time is immense, and this goodwill can also be classified as an asset. Then comes data. Whatever data you're processing, maybe a patent, maybe an information, maybe something of that sort, which is going to be helping you to run your business, can always be considered as an asset. In asset management, knowing which investment to make and avoid are gained only by having thorough market research. So if you're not a person who are actually not into market, and if you're actually a person who doesn't know how the market works, then you're not the right person to be doing your asset management. You need to be seeking the help or advice, or else you should be actually processing, or you should be actually having that willpower or that particular need for you to know more about asset management. You need to be spending more time on the market, analyzing how market works, analyzing market trends, and also knowing what is the kind of actions that are being taking place in the market in order to create wealth. So the thorough research and having a complete understanding on the market will help you to gain wealth by managing your asset. And only by having this particular research, you will be able to manage your wealth in the proper way possible. Asset management is essential because if you don't manage your assets well, you can end up losing your wealth. So it is actually simple as that. If you manage your asset well, it is going to be building your wealth. But in case if you're not managing your asset well, you will actually be losing all the assets which you have created over the period of time. So it is important for you to know how to manage. So for example, in taking the case of stock market, if you know that the stock market will be crashing soon, it is always better for you to exit the market. Having a proper exit would be bringing you more profit. But if you're actually delaying your exit in the market crashes, and the value of the stocks are going to be going down, and the wealth you're actually possessing till then would be lost. So that is the kind of knowledge which you need to be knowing. So it is always important for you to manage your assets. So no matter what, maybe right now, maybe you are possessing a lot of wealth, but if you're actually not having the particular knowledge on how the market will be going, then all the wealth you have built till now would be going in vain. There are four types of assets that help you gain wealth, which are tangible assets, intangible assets, current assets, and fixed assets. Tangible assets are something which is of physical. It can be a vehicle, it can be a property, it can be a building, it can be something of that sort, which is actually an investment for you or you have done in order to get more wealth for you. Coming to intangible assets. Intangible assets can be trademark, copyrights, patents, and the investments which you are actually getting or the returns you are actually getting in a period of time. So tangible assets are those assets. Now coming to current assets. Current assets are something which are actually employed for you in order to get wealth for a shorter period of time. This current asset may be replenished or exploited within 1 year itself. So the assets which you will be possessing for a short period of time, like less than 1 year, can be classified as current assets. Now coming to fixed assets. Fixed assets are actually fixed. They're actually installed or employed for a longer term. For example, the building which you own, the building which you have built, the land which you have actually invested. So all these things will be prolonging for a longer period of time, and the investment which you actually make on fixed assets would be more, and hence the time period in which the fixed assets will be working for you will also be longer. Now let's look at the need for asset management. Why do we need to manage asset? What exactly is the need, or why do we actually need to follow asset management? That's exactly what we'll be covering in this module on the need for asset management. So these are the various steps or various key points which I would like to share with you on the various needs for asset management. Starting off with easy coordination across departments. We know that there are several departments that is working on asset management. So in financial or institutions or in order to have a wealth build, you need to be doing a lot of things. You need to be having the acquisition. You need to be having the particular team to do the market research. You need to be having some persons in order to allocate the resources which you are actually having to make the necessary investments. So regarding all these things, these are the various few examples which I have put forward. So based on all these things, there are several categories and several departments that need to be working. So by managing your asset well, we'll be able to coordinate very easily across different departments. For acquisition, you need to be talking to the acquisition department. In order to acquire, you need to be talking to the resource allocation department to give you the money to, have the actual budget for you to make the investment, to buy the property and all such things. So in order to maintain and manage and all those things, there are various several departments that is going to be working with you in order to manage your asset well. So by having a proper asset management system, it is going to be very easy for you to manage or to coordinate along with all the several departments so that the management or the asset management can be maintained and managed properly by following this. And next comes saves time and resource. The kind of time and resource that you need to be spending on huge investments would be more, because the amount of money that is coming into picture on here on investments and managing your assets would be really high, right? So in order to buy a property, in order to buy a car, in order to buy something of that sort which is going to be building wealth would be really expensive. Even if you're simply investing on stock, you need to be doing the market research. So by having this necessary actions done by the asset management department, it is going to be helping you to save your time and resources. So they will be helping you, guiding, giving you the advice, and also providing you the necessary steps that is to be followed for making sure that you're properly maintaining and managing your assets, so that you can save your time and resources, which you will be able to spend those on several various other categories or investments that you can do on your own. Next comes better results and gain wealth by implementing the right moves. So you will be knowing what are the right moves to be taken. Analyzing the market, you would be knowing where the market would be going, what is the trend like, and which would be the correct investments for you to make in order to bring your wealth, rather than becoming a liability. So when you're making the investments, you should be making sure that the investment would be giving you better returns in the coming period of time. So if you're not doing the right decisions, or if you're investing in the wrong property or wrong asset, you would be going in loss. So in order to avoid that liability, you need to be making sure that you are doing the right moves. And that is exactly being made possible by having a proper asset management system. Then comes better risk management. Exactly as I told you right now, by knowing the market, the trend, the analysis, and the sectors in which would be giving you more returns, you would be actually making the investments on the right platform, on the right area, and the right teams as well. So by understanding that, you would be managing the risk. The kind of opportunity that you are getting here would be high, and there will be only very minimal chances for you to go on loss. So that is the kind of strategy which you will be able to accommodate by following asset management. Then comes eliminate legal risks and associated issues. So since you're making investments and this kind of investments need to be regulated by the government officials, you need to be making sure that you're following the rules and regulations. And the legalities which are included by taking part in these investments would also be high. So you need to be making sure on all these things that you're not legally obliged to anyone and you are not guilty for doing anything. So that is the kind of steps and that is the kind of procedure and that is the kind of severity which are being associated with these kind of investments as well. If not done properly, you'll be ending up in severe penalty. So in order to avoid that, you can have a better asset management system and team to make sure that you are being eliminated or such situations are being avoided with you while managing your inventory or while managing your asset. And then comes improved regulatory performance. There are a lot of government bodies, authorities from which you should be getting the approvals. You should be getting the sanctions, approvals, and all the necessary documents for you to proceed with your acquisition, to maintenance, and also for selling your asset. So by getting all these done, only you will be able to acquire or manage or maintain or sell the investment which you actually made. So in order to get that done, you should be following all the necessary actions, all the legalities, all the formal procedures, all the legal documents should be clear from your end. So you should be having all the sanctions and approvals from the bodies. So that is exactly nothing but you should be following all such things. And that is also made possible by having asset management team within you. Then comes provides safety on your investments. Since you're actually playing well informed, you're actually managing your risks and you know how the market will be moving because you have done the research, you're managing the risks, you know how much you'll be losing because you're actually aware, you're actually taking an informed decision so that the kind of safety on your investments which you're actually making is high. So thereby, you make sure that the kind of losses which you can incur by making the investments are very low and the chances of getting profit would be very high as well. So these are the various advantages that you will be getting by following asset management and having an asset management system for your organization or your business or in order to create your personal wealth as well. So these are the things which I would like to put forward for you on the needs for asset management. Now coming to tasks. What are the tasks associated with managing your assets? So that is the next topic for this course on asset management. That is nothing but tasks involved in asset management. Let's see what are the various tasks which we are to be followed while managing an asset. So first one would be gathering information on the various asset management system and continuous research on market trends. So we should be having that particular information. So you should be taking informed decision while making any investment. And after making investment also, you should be thoroughly understanding and gathering information on those particular investments which you have made. Whether it is actually on profit, it is actually making wealth for you, and is it bringing you value of money. So all these things should be known. So it can be done only by having the particular information. Having an informed decision and informed criteria, you will be able to manage and you will be able to build wealth. And how will you be able to get this information? Get the real-time clear information. That can only be achieved by having thorough market research. You should be knowing how market is, what are the trends, what is the area which is on the boom right now, and how can the industry be going in the future? Will it be going up? Will it be going down? Or will it be stable for some period of time? So you should be actually working on all such scenarios, doing market research and gathering information on all such activities which are related to your investments. So based on your investment, you should be doing relevant research and also by understanding on such informations, only you should be taking your decisions. Then comes observing variation in the value of assets depending upon the market. So we should be observing the variations. So market will not be stable for a longer period of time. And it can be said that the market is not stable at all. Maybe it is on the high, it is on the rise. Maybe it is actually stable for a while and then it is crashing. So based on all these things, you should be actually analyzing the potential of the market So is the market going to be high? Is the market going to crash? So if it's going to crash, you need to be knowing that there is no point in buying or there is no point in holding that particular stock. So by gathering these many informations and knowing the variations, so where is it going? What is the trend like? So by understanding that, we'll be able to get an informed decision, and we'll be able to analyze and understand and implement the right decision at the right time itself. Then comes planning the asset management strategies based on investors' goal. So basically, you are making the investment, you're actually spending some time and money and effort to make sure that you're making the right investment. So basically, why are you investing? Obviously, you are actually investing in order to create your wealth, bring in more money, and bring in more returns to your investment, which you have actually done. So what was the goal? So maybe for some people or some personalities or some organizations, the investment would be done based on several factors. Maybe it's on a goal, maybe it's on the objective, maybe it's on a future project which the company is going to take up. So based on that, the investment should be planned accordingly. Maybe if you are a person who would like to buy a car or buy a house in the future, you will be making some savings, and the savings would be invested so that you would be thinking that you will be getting more return on investment, and from this return which you are getting, you would be able to buy a car or a bike or a house which is of your concern. So you should be understanding what your goal is. You should be planning your strategy in such a manner that all the actions which you're doing right now is actually associated with the goal which you're actually planning to achieve by the end of this investment. And that's exactly how you should be having, or you should be having the approach to the market and approach to the investment which you are making as well. Next comes knowing the life cycle of assets and timing the entry and exit. So we know that every product in the market would be going through several phases. So in the life cycle of a product, it would be going through several phases as human does, right? So for the product, the various phases would be introduction, growth, maturity, and decline. In the introduction part, the product is just introduced and it is actually trying to grasp the market and also getting to know more about the market and trying to implement more sales to that particular product. And then comes growth phase, where the product is actually a hit. There are more number of sales coming in, people are actually liking the product, and all such things are happening in the growth phase. And in the decline phase, the actual market is actually not for the actual customers, or the actual product has actually taken all the benefits from the market itself. And then comes decline, where the product is actually old-fashioned or outdated. So you should be knowing what is the phase of the market. And all these investments which you are making, you should be knowing in which phase is this investment which you have made is lying. Is it in the growth phase? Then well and good. It is actually going to be continuously growing. So you will be continuously building wealth as well. So you should be understanding which is the phase the investment which you have made is lying. So you should be understanding which phase it is, and you should be rightly interpreting. You should not be misconceptualized or misunderstood that the product is growing and it is actually continuously in the growth phase. So it might be a false growth, and it might be in the actual potential where the complete maturity is done. The complete gain or the complete return on the particular investment is actually achieved, and now it is actually going to be slightly declining. So regarding on all those respective, you should be having a complete understanding, and only then you will be able to time the market, timely entry and timely exit. If the market is going to crash, you would know that, and then you would be having a safe exit as well. So that is the kind of knowledge which you should be possessing. So you should be knowing what is the life cycle of an asset, and what is the phase which the asset is lying in, and what would be the entry and what would be the exit point as well. And then comes making purchase decisions based on the market and your research. So the research which you are going to put in should be really enough to make sure that the investment which you are actually going to make, the kind of money which you are going to invest, which you actually made out of your lot of struggle, lot of work, lot of hard work, and also efforts, right? So you're actually investing that. So be careful while investing, because the kind of market research you have done, if it's not thorough or if it's not well and good, then the kind of investments that you are going to be making would be a wrong one. So make sure that the right investments are being done only by getting the market research and the variations, and understanding the variation, and also understanding the market trends and where the market would be going for the investment which you're actually going to make. It can be on equity, bond, gold, or a stock market, or real estate property, and anything of that sort. So wherever, on which category are you trying to invest, do the market research on that. And then comes maintaining your asset without losing the value of the asset. So as I said before, maintenance is also one of the most important tasks which you should be doing while managing your asset. So you have done a lot of investment on your asset to own your asset, right? So you are trying to build your wealth. So only by actually maintaining it in the right way, you would be able to maintain, you will be able to achieve that particular value to your wealth or to your asset which you have invested. So in the down the time, if you are not maintaining your asset, then the condition in which your asset would be lying after a few years would be very poor, and the kind of investment or the kind of returns that you would be getting in the later stage would also be going down. So it's always important, and it's always a basic necessity for you to maintain your asset. You might be thinking that the kind of investment that you need to be doing on the particular property or particular investment is also keeping on increasing. But if you're actually not doing that, the kind of wealth or the kind of value you are actually having on that asset would be going down, and it would be costing much higher for you in the later stage. So it is always better for you to maintain your asset whichever you are possessing. Now coming to types of asset management. Here we'll be seeing all the various types of asset managements which are available to us to follow to manage our assets. So depending upon the types of asset we are owning, so we'll be able to showcase or we'll be able to follow or strategize our management strategies depending upon the types of assets which we own as well. In this module, that's exactly we'll be seeing. That is nothing but types of asset management. Let us see what are the types of asset management which are available for us to follow to manage our asset. So the 6 types of asset management which I have put forward for you are these, including digital asset management, fixed asset management, IT asset management, enterprise asset management, financial asset management, and coming to infrastructural asset management. So digital asset management, all the social media platforms, your softwares, all those can be classified or all those can be classed under digital asset management. It is actually an asset which you possess in the digital platform to run your business, for your personal growth or for your business growth, right? So all such things can be classified or can be grouped on digital asset as a digital asset, and the management of digital asset can be classified as digital asset management. Coming to the next, which is nothing but fixed asset management. Whichever asset which you possess for a long term, it can be a building, it can be a property, it can be a machinery or heavy equipment which you possess to run your business or for your personal enterprise. So all these things which you possess can be classified as fixed assets, and managing such assets can be called as fixed asset management. Next comes IT asset management. IT. So in this scenario, most of the people are working from home, and the kind of network and the kind of data and the kind of research which you need to possess to have or to implement work from home in an efficient way would be under the responsibility of IT department, making sure the server is available, the server is up, there is no delay, the server is maintained, the security is maintained, all such activities, right? So all the such things which you possess to run your business for your personal finance or for your personal purposes can be classified as IT asset management. All such activities for the server, security, and for maintaining the access to those particular people who are actually having the credential are maintained and actually be managed by the IT asset management team. Next comes enterprise asset management. Whatever enterprise are you running, all the asset which you actually own on part of that can be grouped as enterprise asset management. All the wealth which you possess, all the property, all the equipments, whichever which you possess on behalf of the enterprise can be classified as enterprise asset management. Next would be financial asset management. It would be completely regarding your finance. Whatever money or the whatever currency or whatever amount which you possess, how much interest are you paying for your loans? How much loans are you having? How much is your credit? How much is your debit? How much is your credit score for the company, for your personal account? And such activities are being managed by financial asset management companies or financial asset management strategies. So these are the various types. And finally, we'll be looking at infrastructural asset management as well. So what are the various infrastructure which we possess? Maybe in public sector, maybe in private sector, and all such, right? So all these things, bridges, dams, roads, and all these things are coming under infrastructural assets. And managing those assets on a larger scale would be classified or would be managed by infrastructural asset management teams. So these are the various types of assets management systems which we are having, which we'll be able to follow regarding whatever types of assets which we are possessing, so that we'll be able to manage, we'll be able to maintain, and also we'll be able to bring in more wealth, more return on our investment in all these categories of assets which we possess. Coming to the first type of asset management system, that we will be seeing in this course on asset management, which is nothing but digital asset management. So, what exactly are we managing in digital asset management? So, as the name suggests, everything that we process in the digital platforms or digitally, that all items we will be taking care of in digital asset management. So, in digital asset management, almost every business right now in this present scenario, almost every business is having its presence in the digital platform. And hence, there is a boost in the digital media usage and the content in digital media platforms. So that's exactly why digital asset management has come to a necessity right now, because most of the business which is running, let it be in e-commerce, let it be any kind of business which is running actually right now in the right scenario. And right now, due to the pandemic as well, everything has gone on the digital mode, right? On the digital platforms, every business and every opportunity that you are needing is made possible in the digital platforms. And that's exactly why the kind of usage which is being going on in the digital platforms are very high. Hence, it is always important to manage your assets in the digital platforms. Let it be a social media account, let it be the software which you process, let it be any kind of marketing strategies that you can be following in the kind of platforms, which is nothing but digital platforms. So all these things can be classified as your digital asset, which are in turn bringing you business, wealth, and also more connections as well. You will be able to connect with a lot many number of people, irrespective of the location where they are from, right? So all these things are being made possible through digital assets. So that's exactly what we'll be managing in digital asset management. The most important aspect to be looked into in digital asset management is regarding the security. So we know that the hackers are there. There are a lot of issues, threats, and violence is going on in the digital platforms as well. And that is the most concerning factor regarding digital asset. Whatever your asset you are possessing, you should be maintaining or you should be making sure that the assets which you possess are used on the right terms, and it is not misused or it is not used in such a manner that the people who are actually getting affected in the harmful way. So people should be affected by in a good way by taking advantage of the digital assets which we are processing by providing the services or products which we are supposed to be providing. Apart from that, no security threats, no damages, or no harmness should be processed or should be attained by using our digital assets. So that's exactly the most major concern is. So we should be concerned about the security. Who is having access to our security and who is able to threat or who is able to give viruses, threats, malware can be all installed in the digital platforms, right? So that is exactly what we need to be taking care of while managing the digital assets. Digital asset management is responsible for providing access to the digital assets to the right persons with the right credentials. So this comes as part of security itself. So in order to log in to any digital platform which you possess, maybe your digital account in LinkedIn platform, maybe on Instagram, Facebook, WhatsApp, or let it be on any basis, right? So based on all the things which you possess for your business to run or for your personal activities, you would be given your username and password. And the main advantage of having this kind of digital platform is that you will be able to access all these items, all these digital assets from wherever you are. You need not be carrying a laptop or any item with you always. Even if you're using a different laptop or different source of origin in order to access that, you will be able to do that. The only thing that you need to be providing is your access, the credentials which you possess, your user ID, your password, and if you are actually taking two-step verification, maybe the OTP which will be sent to your phone number. So that is exactly what is being enabled to make sure that the security is maintained. No one is actually able to access the particular digital assets which you possess other than the required or other than the officials which is actually owning that particular digital asset. So this is one thing which is majorly implemented to make sure that no harmness or no threat are being done, and only the digital assets are being accessed by the officials which own the digital assets. Now coming to the last point, digital asset management provides you the option to track everything which is happening on the digital platforms. That is also one of the most important factor which digital media or digital platforms or digital assets provides to you. You would be able to track whatever is happening around you. You will be able to know who signed in with which credential and what was the time which he used to do that and what is the activity that he was doing by logging in with the credential. So using all these details, we'll be able to track what is the item going on, what are the things which is being taken care of, and what are the tasks which was done by this particular person by using this particular credential during this point of time. So regarding all those things, we'll be able to track and we will be able to know where the things were gone wrong. If things were gone wrong and if things actually had a turnaround, you would be knowing, you would be in a position to check where the issue had happened, who actually made the mistake. And regarding all those things, we'll be able to know. For example, we'll not only be able to track if anything goes wrong, we'll also be able to track our performance. For example, in Instagram, how many follows are you getting? How many likes are you getting? How many reaches are you getting to your post which you are posting on Instagram? So all those things can be seen or can be viewed or can be attained by the insights which each platform are giving. So we'll be able to know the kind of performance we are able to do. For example, if it's LinkedIn, you will be able to know who actually viewed your profile, how many times your profile got appeared when the people were actually searching for someone related to your field. And you can also see how many reach have you got to your post which you have posted recently. So these are all the various analytic tools which are accessible to us to evaluate our performance, as well as even if things are going wrong, we'll be able to know who did that by checking the access, by checking the time, by checking the tasks which were done by that particular person during that point of time. So these are the various management strategies which you'll be able to follow by following digital asset management to manage your digital assets. Coming to the second type of asset management, which is nothing but fixed asset management. Here also, as the name suggests, we'll be managing fixed assets. How are we managing our fixed assets is what we are concerned about in fixed asset management, which is the second type of asset management we are looking at. And what are fixed assets? Which all assets will be coming under or will be classified as fixed assets? So those are nothing but the various properties which you own, the various buildings which you possess to run your business or to create your wealth, the kind of infrastructure which you are providing to run your business, for your warehouse, for your inventory, and all such machinery activities, all such production process, you'll be having infrastructures. So all these things and also various equipments which you possess to run your production process, and also the heavy machineries which you're having to get all the processes and actions done to get the item manufactured or produced to the later stage, right? So all these things which are being possessed by you or by your organization or by your business which you are running can be classified as fixed assets. So these are the assets which we'll be managing in fixed asset management, since all these things or all these assets are considered as fixed assets. All the items which an organization has installed and employed to generate income can be generalized into fixed assets. So it is actually simple as that. Whatever item the company, the organization, or the business you're running are actually employing can be considered as assets, because it is actually bringing in you wealth or bringing in you more services or being able to produce an item. And it is of high value or high importance or high wealth creation potential. So only then we'll be able to classify anything as assets. And hence, we are actually talking about the kind of assets are fixed. We are talking about fixed asset management. And whatever you employ, whatever you install in your machinery, in your equipment, or in your facility, all these things are coming under as fixed assets, and managing those are coming under the management of fixed asset management. So all these things which you are employing or installing are able to bring in you more wealth, more value creation, and also which is helping you to run your business, whatever requirement you're possessing or whatever requirement you're having. All these items or all these assets are being able to address to all those concerns which you're having. And next comes, these assets would be serving the organization for a longer period of time and is not used for short-term benefits. Therefore, they would be expensive as well. So, as fixed assets, the name suggests, it is fixed. It is not a temporary asset which you would be possessing for a short period of time. It is fixed and hence it would be there with you for a longer period of time. It will be employed, it will be used, or it will be utilized by you, by your organization, or by your business to get it more revenue, more wealth, and more revenue generation as well. So these are the kinds of application a fixed asset would be giving. And it is coming under that category itself. Since it is going to be benefiting you for a longer period of time, it is very obvious that the kind of investments that you would need to be making on these fixed assets would be huge. For example, if you're looking to buy a property, do you think that buying a property is cheap? Never. Even based on the locality, the prices may be changing here and there based on the demand and the kind of access you are having to that particular location. It is absolutely sure. But even then, the kind of investment that you need to be making in order to purchase a property would be high, since it's a fixed asset and would be serving you for a longer period of time, and the kind of return that this property can be giving you after a few years would also be increasing. And coming to building, do you think that buying a house is something small? Buying a home is something small? So all these things, all these infrastructural facilities, your home which you possess, any commercial building, all these are expensive because it is going to be relevant, or it is going to be important, or it is going to be staying with you for a longer period of time. It can be staying with you for 10 to 20 years minimum, right? That is the kind of service period which those property, which those buildings, which those infrastructures will be providing. And it is same for the machineries and heavy equipments that you're actually employing. So it would also be expensive. It would also be installed in once in a while. And it is not something which needs to be replenished or which needs to be restored each and every time. It is not like changing the oil. You can't change any machinery or any heavy equipment like changing an oil, right? So changing oil can be part of servicing or maintaining. But that is not it. Heavy equipments, machineries, properties, buildings, infrastructures, these are the various fixed assets you are employing for longer term, and therefore it will be expensive and you are getting benefited out of this investment for a longer period of time. Since fixed assets are employed for longer period of time, fixed asset management focuses into the maintenance of these assets so that they are serving them well in the duration of their lifetime. So we are employing, or we are actually making a huge investment on these properties, right? On these fixed assets. The kind of investment is huge. So we know the kind of investment is huge, and the kind of return or the kind of benefits that we are having on these investments are also going to be high. So it is always necessary to make sure that you're maintaining these assets. If you're actually not maintaining your asset, the value creation which you have added to those particular assets would be going down. And the kind of benefits or the kind of service or the kind of utilization of that particular asset would be going down as well. If you're not maintaining your property, maybe some people around can be attacking your property, can be actually acquiring your property without you even knowing. The same goes with building. If you're actually not cleaning, if you're actually not maintaining, or if you're actually not having a proper security system to the building, things can be going wrong, right? So for maintaining your fixed assets also, you should be making certain investment, and you should not be feeling anything for doing that, because you've already created or already made a huge investment on these fixed assets. And if you're not maintaining these assets in the right manner, whatever you have invested will be going in vain, because you will not be getting the actual return you should be getting on these particular assets which you possess, because you have not done the maintenance. You need to be doing the maintenance so that it is running or it is performing in the perfect condition, and it is being able to get you the maximum benefit out of by possessing or by utilizing these particular assets in the right manner. Coming to our third type of asset management, which is nothing but IT asset management. And here, as the name suggests, we'll be managing the IT assets which we possess in order to get all the work done. So these are the various tasks which are employed for the management of IT assets. And IT asset management focuses on the management of the software and the hardware which we are possessing, maybe as an individual, maybe as an organization, maybe for your business which you're running, right? So all these things, the softwares, the hardwares, and all these things are coming into the picture in IT asset management. And IT assets comprises of electronic devices such as computers, routers, IT equipments, and also intangible assets like software, subscriptions, licenses, patents, trademarks, and even copyrights. So these are the various assets which we are having, which can be classified as asset of IT or IT assets. So the trademarks which you have taken, the copyrights which you have possessed, the patents you have applied for. So all these are of high value. It is of high value and it is going to be creating a wealth or name or a brand name for your company or for your organization as well. So that is the kind of importance these are having. At the same time, the computers, the hardwares, the systems, the equipments which you possess are also coming under IT department. They should be having a complete account on how many equipments are there, how many computers, or how many laptops, how many routers, which brand routers. All these complete details should be taken care of by IT asset management team. They should be having complete account and they should be accountable for all these things. Especially during the time of pandemic, people are working remotely and all the equipments which the employees should be possessing are sent to their location. Especially during this period of time, we should be having complete note, complete account on what are the items which are being shipped, what are the items which we are having in the inventory, and what is the kind of response that we are getting to our maintenance team. So all the IT team, all the people working in that particular team will be getting tickets, will be raising calls and raising concerns regarding the performance of this particular equipment as well. They need to be providing the answers as well. So it is always important for the department to maintain the account, maintain the data of the items which they are having, which the employees are having at their space, and related stuffs as well. IT assets are the core assets that help you to carry out your works, and any interruption to IT assets would be affecting the business. For example, especially as I told you before, we are given the equipments from our company in order to get work done from our remote space. So irrespective of which location we are part of, from where we are working, we are able to do so if we are having a system or the necessary equipments and also having access to the internet. That's exactly how we are working remotely, even though we are not going to the office due to the pandemic. And if you're not able to work remotely, how will it affect the business? We'll not be able to get the work done, and the work will be delayed, work will be pending, and the work will be starting to pile up. So that is the kind of a condition that can be arising if the system is not working properly, if the kind of response we are getting from the IT team is not proper, and the kind of efficiency with which they are working, if it's not proper, all these kind of events will be happening and the kind of business will be going down, the kind of service which we are able to provide to our customers will be going down, and it will be directly affecting the business of the company. So it is very much important to have a clear structural IT asset management team so that any issues, any concerns can be addressed to in the short period of time itself. IT management ensures that there are no external attacks and other malwares or virus which can be a threat to the organization. As digital assets as well, we are also prone IT attacks. It can be a phishing attack, it can be a cyber attack, it can be a cyber security issue, or it can be malware or viruses which are being transferred or installed to our systems or to our network as well. All these things should be taken care by serious issue, as a serious issue, because all these things can be a threat to the organization. The data which you are processing may be transferred, the data which you are processing may be destroyed completely, which cannot be used for the future references. So all these things will be of high issue, and all these things should be taken care well by the IT department as well. So making sure that these things never taking place, and also the working environment of the employees are also not being taken apart. So all these things are the various responsibilities, tasks which the IT department is to manage so that the employees which are working remotely, especially during the time of pandemic, are being able to get their work done, and also there are no any attacks coming from the outside world to our organizational network or any assets which we are possessing. Coming to enterprise asset management. This would be the fourth type of asset management that we'll be looking into. In enterprise asset management, all of the assets which the enterprise would be owning should be managed. How the coordination, how the implementation, how the management can be implemented by following enterprise asset management is what we'll be talking here. Enterprise asset management aims to integrate and organize an organization's physical asset to carry out its business. We already know that enterprise would be regarding carrying out its business, right? So it would be carrying out its business, and in order to do so, the enterprise would be having certain assets in order to carry out its business. So how to manage that? How to integrate and organize and coordinate between all the items or all the assets which the enterprise would be owning or possessing. So that's exactly what enterprise asset management is all about. Enterprise asset management is having a holistic approach to the assets which the organization holds. So as I said before, it is having a holistic approach. The enterprise itself are having several departments, and the several departments will be possessing several assets. So it is completely considered as a holistic one. The whole thing, the whole assets would be considered as a single unit and also would be preferred to manage all of that, and by organizing, integrating, and also making sure that the coordination and cooperation are being implemented in the right way to maintain or to make sure that the management of such assets which the enterprise would be owning or would be possessing in order to get its business done is managed properly, well and good by following enterprise asset management. Documentation and reporting is one major task to be followed in enterprise asset management. It should be accountable for all the documentation, knowing how many assets they are possessing, how many assets are each of the departments in the enterprise possessing, and how many are being engaged, employed, and how many are being sitting idle. So regarding all such details, we should be making a note, and we should be aware on all such aspects as well. So if an item is being sitting idle, it can be implemented or it can be engaged in several other departments where it is to be implemented, right? So we'll be able to have an account on that and document that, and also make sure that whenever we require any item, we'll be able to implement or we'll be able to engage that particular asset to any other department where we actually need the requirement of that particular item. So by documentation and reporting, we'll be able to do that very easily. We'll be able to manage, we'll be able to integrate, we'll be able to organize, coordinate, and cooperate within the several departments within the enterprise. Data visualization, charts, data interpretation are all carried out in order to evaluate the functional productivity. So how well are you functioning? How well are the operations being carried out within the enterprise? So all those things will be validated using the enterprise asset management. Are the charts or are the data showing that the functionality of the particular enterprise is high, or the efficiency or effectiveness in which they are working are high? So complete idea on that will be sought, and the complete study will be done with the enterprise asset management to make sure whether the assets are being managed in full-fledged manner so that they are able to get maximum out of those assets which they are possessing right now to the maximum benefit, to get in more revenue, more transaction, and also more profit. That's how we'll be able to manage our assets properly so that we are able to get maximum return out of the investments we have made on our assets. EAM, Enterprise Asset Management, also focuses on the warranty and compliance regulation to ensure the smooth functioning of the operations within the organization. So, in order to make sure that the functioning and the operations and all the items which is being carried out within the enterprise, we should be making sure that all the necessary items or all the necessary actions should be made possible, right? So in order to get that done, we should be having to claim the warranty, and if there is any compliance regulation to be made possible, the enterprise asset management would be looking into it and would be pitching in to make sure that all such activities are being carried out and ensuring that the working and the operation and the functionality of the particular department, of each of the department within the organization or within the enterprise, are being carried out in the most effective way possible. Moving on to financial asset management. Here, we'll be looking how to manage the financial assets which we possess in this type of asset management, which is nothing but financial asset management. Financial asset management encompasses on the investments which we are making on our holdings, brokerage services, equity, bonds, and other portfolios which we are holding. So based on all these things, financial asset management helps us to manage our portfolio, our investments which are made on the stocks, bond, and equity. So these are the kind of services which financial asset management would be offering. So we would be making entry into the market, and we need to be knowing when to make the entrance and when to leave or when to exit the market. So regarding a stock, right? So we will be giving guidance, advice, and also we'll be given all the necessary requirements that is to be made known of, made aware of by following these. So by making investments, we'll be holding portfolio. What all are the stocks which we will be holding? And when is the time that we need to be buying? When is the time that we need to be selling all these stocks? Related to all these investments, we'll be giving a clear clarity by following financial asset management. Market trend analysis, tax filings, valuation, interest rates are all managed here in financial asset management. We need to be knowing what is the market trend like. Only then we'll be able to take the informed decision on how to make the investments and where to make the investments and in which category we need to be making the investments. So regarding that, we need to be having a complete awareness on the market trends. And tax filings, we'll be having to file taxes, right? So we'll be paying taxes for income tax, luxury tax, and all other taxes are coming. So in order to do that, we need to be having some inputs. We need to be aware how to file taxes, how we'll be able to eliminate taxes, and how we'll be able to pay tax-free scenarios. All right. So these are the kinds of services and these are the kind of activities we'll be able to follow by following financial asset management. We'll also be able to evaluate our stocks, our holdings, or our portfolio, which we possess right now. And we'll also be knowing what would be the value of our portfolio in the coming future. Valuation, interest rates, and all those things are being made possible to us, and we'll be having a clear clarity and we'll be having a clear screen in front of us by having right financial asset management. Financial asset management focuses to build wealth over time by making informed investments that would bring in exponential wealth creation. So that is exactly what we need to be having in financial asset management, right? We need to be making the investment and we need to be having exponential growth to our investment. We will not be making any investments so that we'll be making loss or the prices would be going down. So we'll also be investing or making investments on such items only where the value of that particular stock or that particular investment would be going high in the future. So that is the kind of investments that we would like to make and we will need to make. So in order to get that done, we need to be having thorough market research. What are the investment strategies that you need to be following? And which stocks would be going high in the future? And where will I be able to achieve or when will I be able to achieve my target price? So that is exactly what we'll be able to manage and we'll be able to sort out by following financial asset management. The risk factor is always present in managing financial assets and can be done by wholly having thorough research on the market. So while making any investments regarding anything, whenever the presence of money or the amount is there, we'll be having risk. The kind of investments which we are making, will it be going up? Will it be going down? Always the risk factor is there in the market. So based on the demands, based on the market trends, and based on any certain activities or any certain precautions, we will be having a complete understanding or at least a basic understanding on how the market would be going. Only then we are making the investments thinking that the prices would be going high and in the future we will be able to make profit by making these investments right now. So even then we are having the risk factor, but here we are trying to eliminate the risk factor by reducing the probability of the value going down for the investments which we are making. So that we are not trying to eliminate the risk completely, but we are actually taking high probable trades, high probable investments wherein which the value would be going high in the future. Coming to the last type of asset management, which we will be discussing in this course on asset management, which is nothing but infrastructural asset management. Infrastructural asset management is all about developing and maintaining the infrastructure in your specified locality. So in your locality, you'll be having a lot of infrastructural facility which is being made possible, especially by the governments, right? So you will be having a lot many infrastructures, let it be road, transportation facility, water supply, electricity, and also the buildings which is being enabled, right? You'll be having ports, you'll be having container terminals, and based on your locality, you'll be having various infrastructures based on the landscape, based on the geography, based on the demographic, regional speciality. Depending upon all these things, you'll be having certain infrastructures, and governments and private organizations are also working towards in order to make such facilities available to you in your locality as well. And it is actually being managed to make sure that the quality of life which you are having or the standard of living which you are having in your locality is maintained and it is kept high. Because in order to make a transportation happening, you need to be having a road. And how are you having a road? And it is the responsibility of the government to do so. And if you are having road, you need to be having the vehicles. You need to be getting all the necessary items or necessary equipments or necessary transportation facilities made available for you. Let it be in terms of private transport, in terms of public transport, and also on various other aspects as well. So you can be having railways, you can be having metros, you can be having bus terminals as well. So these are the things which are coming in the transport sectors. And various other facilities like water supply, you need to be having water supply throughout. 24/7 water supply is required whenever you need to be sufficing or whenever you need to be having that particular requirement. And coming to electricity is also a basic necessity for any human being, irrespective of the location which they are living in. So you need to be having basic facilities being made available for you, right? So that is exactly what we are focusing on: infrastructural asset management. What are all the infrastructural asset which is being enabled in your locality? Are we managing that? Are we maintaining that? And is it actually in good shape? So that is exactly the main task and responsibility of any infrastructural asset management strategy. Infrastructural asset management ensure the facilities are being made available to the public in the best way possible. As I said before, you need to be having a basic standard of living, the quality of life, and the need or necessity for you to have these facilities are actually the basic facilities. So in order to get a life going, in order to have the standard of living, and in order to make a quality of life, and in order to have that quality within your life, you need to be having basic facilities for transportation. Let it be water supply, let it be electricity, let it be the basic buildings, your home, your facilities, your all the necessary security systems as well. So these are the basic necessities, right? All these infrastructural assets which you possess based on your locality, maybe in your private sector, maybe in the public sector, irrespective of all those things. So how to manage that, how to implement that, and how to maintain that. That is exactly what infrastructural asset management is all about. Resource allocation, planning, process optimization, decision making, and maintenance of the infrastructural items or infrastructural assets are the main tasks held with infrastructural asset management. Resource allocation, the government or the organization behind that would be having certain budget. And based on the budget, you should be allocating the resources to various departments to ensure that the basic facilities, like all the ones which I mentioned before, should be ensured, right? So resource allocation should be done, resource maintenance should be done, and also complete planning should be done. How to implement, what are the basic necessity to manage that, how to build that, and what is the kind of response that we will be getting from our public people who are actually making utilization of these particular facilities. So we should be having thorough plan on that as well. And we should be optimizing all this process so that it can be done in the best efficient way possible without making huge investment and without making any loss as well. With minimal investment, with high quality, how are we able to do it? That's exactly what it is all about in process optimization. And the decision making skills is also resting with the organization, wherein which, it is actually a whole task. It is actually a completely huge task wherein which money is there, people's reactions are there, people's opinions are mattering, and also you need to be having government's approval. So a lot many things are being coming into picture while managing an infrastructure in any locality which you are managing. Coming to the last topic that we are having in this course on asset management, which is nothing but challenges in asset management. It is obvious that you would be facing lot many challenges and hurdles that you need to be overcoming while managing your assets. It is directly involved with a lot of money, and hence you would be going through a lot of risks, and you should be maintaining or you should be managing all these challenges in the best possible way so that you are able to manage all these challenges that you are facing while managing your assets. So the 5 points which I have put forward for you in order to overcome the challenges you are facing would be maintaining your asset uptime, cost-effective asset maintenance and replacement, total cost of ownership, poor asset visibility, and also making asset purchase decision. So these are the various challenges that you would be coming across while managing your asset. Coming to the first one, that is maintaining asset uptime. Maintaining asset uptime is actually nothing but you would be owning a lot of machinery, equipments, and also necessary items that you need to be done or you need to be having in order to get the production process done. So if you are actually not making sure that the equipment or the production line is running throughout, you would be losing out on your money because the production is being affected. The complete full-fledged running of the particular production process would not be happening if the uptime is not happening. So you should be ensuring that the machines would be running throughout and there should be no delay or idle time for the equipment so that you will be able to get maximum within the short period of time as well. So in order to get that done, you need to be making sure that you're getting the right items, right equipments of high quality, and you should also be making sure that the equipments or the machinery are being serviced properly. So you need to be making sure when it's to be serviced and how it is to be serviced, right? So all these things are coming to the next point, that is cost-effective asset maintenance and replacement. You should be knowing when is the service period, how often should an equipment be serviced, and how the service should be done. Regarding all these things, you should be aware of, and you should be having a separate maintenance team to look after that. And you should be knowing when is the time to replace these items, where these equipments, machineries, and all these heavy production items should be replaced when it needs to be. Or else, if you're not replacing it on time, you would be going through huge losses because it would be affecting the production process. Because if you're not replacing the items on time, it would be damaged and it would be having to stop the production process for a while. And by incurring that, you would be incurring a lot of loss on your investments and on your business because the production process is completely affected. Therefore, it is most important for you to maintain service and also replace the items which is to be replaced at the right point of time itself. Next comes total cost of ownership. Total cost of ownership is talking about all the cost associated with the assets. So you would be thinking the cost associated with buying the asset would be the total cost. That is not the case. You should be running on the investments. You should be running on the insurance policies which you're taking care of. You should be taking care of the labor costs which you are paying for your labors to run the assets, and also on the power supply which you are utilizing in order to get the asset running. So it's not just on the investments you're making in order to acquire that particular property or particular assets. Apart from that, you need to be having the labor charges, power supply, space, maintenance, and also on other related stuffs as well. So it is actually the accumulation of all these things which would be costing you for that particular asset. And you should be having this complete total cost of ownership planned within your mind so that then only you will be able to know what is the value of the product and are you investing more on this particular item and is this the kind of investment that you need to be making on this particular equipment. So you'll be having clear clarity on the investments, on the maintenance, and on the service charges as well. Next comes poor asset visibility. Since the production process is a huge process and vast process which is being carried out by different departments, it is always hard to keep a track on the number of equipments and the number of assets which you possess. Where is it being done and how many are you having in each of the departments? Maybe one product is actually being enabled in one department and it is actually in idle condition, which is not being used. Maybe the same item is to be enabled in a completely different department where they are having emergency or urgency in using that particular equipment. By having product visibility, you will be able to accommodate the shipment from one department to another department by having these many steps. You should be having clear product visibility so that this can be implemented. Even though you're having the product within you, you are not knowing that and you're not utilizing on your investments which you had made, right? So that can be made possible by having clear visibility on your product. Then comes making asset purchase decisions. You need to be knowing when to replace your items, right? So is it the right item that you're buying? Is it of high quality? Is it actually suitable for your budget, for your resource allocated for that particular investment? So you need to be knowing when is the time to replace, when is the time to service, and when is the time to make sure that the product is actually being made possible, right? So all these things, all these necessary activities need to be maintained or need to be carried out. So in order to get that done, you need to be knowing how much are you having in your pocket to make the investments, how much are you having to make the service possible, and how much are you having to maintain or to make proper actions on the particular equipment when needed. So all these things need to be known and you need to be having clear clarity on making the purchase decisions, whether you need to be purchasing the equipment or you need to be outsourcing this particular task to any outside vendor. So that is all the various challenges that you will be facing while managing your asset, which I have put forward for you in this course on asset management. By now, we have come to the end of this course on asset management. So what all did we learn by now in this course on asset management? We started off by understanding what is an asset. What is an asset? Assets is something what you possess which has the opportunity or which has the potential to create wealth for you. So by owning the product or by owning the asset, you'll be able to create your wealth. So all such items can be classified as an asset. And next, we understood about asset management and its importance. So, why do we need to have an asset management? And what is asset management? Nothing but managing the asset in the proper way so that wealth is being added to you by owning that. If you're not managing it, you won't be able to add value to the product, right? So, how to manage and how to maintain that particular asset? That is what we actually saw regarding that. And next, we went on to understand what is the need for asset management. We'll be able to manage risk, we'll be able to play safely, we'll be able to take informed decision. And these are the various needs for you to follow asset management. Then we went on to understand what are the tasks involved in order to follow asset management. What are the tasks involved? You need to be doing the research, you need to be doing the legalities, you should be following the approvals, you should be following what the authorities are saying, you need to be filing taxes, and many more tasks are associated with asset management. That is also something that you need to be knowing on asset management. Then we went on to understand what are the various types of asset management which are present. We saw about 6 types of asset management, which are digital asset management, IT asset management, infrastructural asset management, enterprise asset management, financial asset management, and many more. So these are the 6 various asset managements or types of asset management which we saw regarding or irrespective to the type of assets which we are owning. So with respect to the type of asset you're owning, you'll be able to follow which type of asset management which you want to follow. Right. Next, we went on to understand what are the various challenges which you will be facing by following asset management. So, anyways, asset management or to own an asset, you need to be making investments. And since money is playing a huge role in asset, you would be facing a lot of challenges. You should be managing the risk. You should be overcoming the hurdles. You should be following the legalities and getting the approvals, sanction, and all those things, right? So you're facing a lot of challenges as well. And we saw regarding that as well. So these are the various topics that we covered in this particular course in asset management, and hope you had a fun session with me on asset management.
Hi, welcome to this video on working capital management. I think so. You have heard this word so many times, okay, while your academic backgrounds or in the companies, you have heard this term called working capital. This working capital is like a blood for the organization or to the business. The blood, how it is important for the human being, like that, the working capital is very, very important for the business, for their day-to-day expenses, and how the companies are going to managing this working capital effectively and efficiently. Okay, that we are going to discuss in this session. So first we'll look at the agenda. Introduction to working capital. We will discuss the meaning and definition of working capital and the working capital management. We will discuss objectives of working capital. So what are the main objectives or major objective of this working capital in an organization? Next, importance of working capital management. So what is the importance or scope of working capital management in an organization? That we will discuss. Next, aspects of working capital management. What are the different aspects of working capital management or working capitals are there, that we will discuss. Types of working capital. So in this type working capital also we have different types. So we will discuss what are the different types of working capital. Factors determining or influencing for working capital. So what are the internal factor, external factor which affects or it influence for the organization to get the working capital, that we will discuss. Next, operating cycle. So this working capital is depending on the operating cycle. So what are the different stages are there in that operating cycle? All those things we will discuss. Formula for calculation of this working capital management or working capital. So what is the formula to calculate that working capital? That we will discuss. Sources of working capital. So for the companies, what are the varieties or what are the various sources are available for the working capital requirements, that we can see. Next, and the last is how to manage working capital. So how the companies will manage the working capital in the organization or in their day-to-day operations, that we will see. Okay, let's begin with the introduction to working capital. So in simple words, the working capital is nothing but, in general terms, what are the money required for day-to-day expenses or for the operating activities the company required, that we call it as working capital. Correct? So Working capital is described as the capital which is not fixed, but the more common uses of the working capital is to consider it as the difference between the book value of current assets and current liability. So this working capital, it is not a fixed capital. If you look at the whatever the other capitals, that is share capital or whatever the own capital is there or borrowed fund, that will be fixed, correct? But this working capital is not fixed in nature. According to the company's requirement or day-to-day activities requirement, they are going to take this working capital. It is not fixed. It is fluctuation in nature. Okay, it will not remain same for all the 30 days in a month, or it is not same for all the 12 months in a year. So it is fluctuating depending on the activities of the organization. And it is very easy to calculate what is the working capital. That is the book value of the current assets minus current liabilities. Whatever the current assets are there, we need to deduct with the current liability. Then we will get the working capital. Working capital is another part of the capital which is needed for meeting day-to-day requirements of the business concern. I have already told you the day-to-day activities or operational activities or for day-to-day expenses, the company requires some money. That we call it as working capital. For example, payment to creditors. So the suppliers, they are going to give goods on the credit basis, correct? So after 35 days or after 40 days or after 45 days, we need to repay the money for the suppliers or vendors, correct? So we need to repay that money. For that, we require working capital. Salary paid to the workers. So some companies, what they are going to do, they are going to have the weekly wage. Weekly wise, they are going to pay the wages. Or some companies, what they are going to do, per month, they are going to pay the salary. Monthly wise, they are going to pay, correct? So according to that, they require this working capital. And some creditors, they are not going to allow credit period. They need to pay cash and they need to purchase the raw material. For example, the ancillary service products, not the main raw material. Only for ancillary service products or service raw materials, what they are going to do, they are going to purchase in a small quantities. So what they are going to do, they are going to pay cash and they are going to purchase that raw material. So for that also, they require this working capital and etc. It's like for printing and stationery or for any petty cash or for any refreshments. Okay, for that, they require this working capital. Normally, it consists of recurring in nature. In the organization, it is day to day, it is required only in one or the other way. For example, every 30th or every month end, we require money for paying the salary and we need to pay the rent. And if it is purchased any assets on the basis of hire purchase, so we need to pay the EMI, electricity bill, water charges, printing and stationery. For other, so many other expenses will be there in the organization. So to meet that expenses, they require this working capital and it is recurring in nature. It can be easily converted into cash. Hence, it is also known as short-term capital. So they can easily convert into cash. That is, all your current assets easily and quickly we can convert into cash. That is the near to cash, correct? So that is the introduction to your working capital or brief introduction about your working capital. So next, we'll see what is the meaning and definition of working capital. So working capital management is an act of planning, organizing, and controlling the components of working capital like cash, bank balance, inventory, receivables, payables, overdraft, and short-term loans. So it is an act of recording. That is, first we need to plan the working capital. How much we require per month based on the previous year or based on the previous months, how much working capital the company taken or they have consumed, correct? Based on that, they need to take the estimation or they need to forecast and then they need to plan for this month or for this quarter how much working capital is required. That is the first one we need to plan. Second one, we need to organize the money. So once we done the planning, next we need to organizing. So we need to organize the funds. So how much is required? That is, we have already planned, correct? So how much is required? That we have one estimation amount. So that amount, whichever the sources are available, so from that source, the company needs to organize, or they need to pool the money for this working capital requirement. And controlling. So once they planned and organize the money, after that they have to control that money. Otherwise, it will be underutilized or it may be overutilized. So they need to control over the funds. So components of working capital like cash, bank balance, and inventory, receivables. So these are the current assets, and payables, overdraft, and short-term loans are the current liability. So current assets minus current liability, you are going to get the working capital, correct? So we need to maintain or we need to manage these current assets and current liability. That is the working capital. Next, according to the Weston and Brigham, working capital refers to a firm investment in short-term assets, cash, short-term securities, accounts receivables, and inventories. So in a simple manner, they are given that all about your working capital is your current assets and the current liability. Managing effectively and efficiently in the organization. Whatever the current assets are there, current liabilities are there. That is the working capital. If we manage in a proper way, means we can easily or smoothly they can go with this working capital. Next, we will see what is the meaning and definition of working capital management. So first we have discussed about what is the working capital and what is the meaning and definition of working capital. Next, we will see how to manage this working capital in an organization. So if we use or if effectively or efficiently use the working capital in an organization, then only all the activities will go smoothly, correct? So we'll see what is the definition and meaning of this working capital management. Working capital management is concerned with the problems that arises in attempting to manage the current assets, current liabilities, and the interrelations that exist between them. Yes, it is very, very difficult. So with our notice or without our notice also, sometimes the current assets and current liabilities, the requirement will arises due to overproduction. Okay, we have get this working capital requirement, or due to some other reasons, due to this pandemic or whatever the reasons. Okay, the current assets and current liabilities will be arises. So on that time, working capital is also decreases because the difference between the current assets and current liability, that is called as working capital, correct? If we get the positive difference, yes, we have the fund. If it is negative, then it is deficit, correct? So on that time, the managing these assets, that is current assets and current liabilities, that is very, very difficult and challenging job in the organization. Working capital management is a business strategy designed to ensure that a company operates efficiently by monitoring and using its current assets and current liabilities to their most effective use. So using the current assets and current liability, sometimes seasonable products will be there or seasonable raw materials will be available. So on that time, yes, the company needs to invest more money on the raw material, because in that season only they are going to get the raw material. After that season, okay, once it is a off season, they are not going to get the raw material. So on that time, they need to invest huge money on the raw material, purchasing the raw material, transportation, and bearing the whatever the other expenses included in that. Okay, so working capital management is a business strategy designed to ensure that a company operates efficiently by monitoring and using its current assets and liabilities to their most effective use. So that is effectively and efficiently, if they use these current assets and liabilities, then only they can easily manage the working capital in the organization. Otherwise, it is very, very difficult. So they need to monitor each and every stage or each and every activity they need to follow, and then only they need to get this control over this working capital, and they can easily manage in the organization. So that is the meaning and definition of working capital management. Next topic, objectives of working capital management. So what are the major or main objectives of this working capital management? We'll see one by one. So first one, balance of working capital. So managing or balancing the current assets and current liability in a stable manner. Okay. So for example, first month in a financial year. So if it is the current assets and current liability, it is 1:1. Okay. So next we need to maintain at a 2:1. So in that balancing of that working capital or balancing of current assets and current liabilities, that is the most important objective of this working capital. So if they manage the current assets and current liability or balanced the assets and liabilities means that will be the clear for the working capital management. So that is the first objective of this working capital management. So as per the current ratio, the standard ratio is 2:1. If the current assets is 2 means the current liabilities should be 1. Then only the ideal ratio or standard ratio or soundness of the company is good. Okay. So they need to balance this working capital throughout the year. Next, that is second point, expansion of company's investment. So if they maintain in a very good manner or in a systematic manner in the working capital means that whatever the surplus fund will be there. For example, they are maintaining 10,000 rupees every day for the working capital. So if they manage properly, then whatever the other investments or other extra funds will be there, that they can expansion of their business. So addition to that, they can start a new product line, or they can expand, or they can start a new branch, or they can start a new plant and machinery, or they can install new equipments to the organization. Like that, they need to do some expansion activities. Okay, that is the objective of this working capital management. Next, third point, healthy relation with supplier. What do you mean by this healthy relation? Healthy relation is nothing but they have some good relationship or good rapport with the suppliers. For example, the company is going to purchase goods on the credit basis means the supplier is going to allow at least minimum of 15 to 30 days of credit repayment period. So within that period only they need to repay, or on that day only. 15 days if they allow means on that 15th only we need to repay the money. If you are not going to repay, then next time, if you are going to purchase the same raw material from the same supplier, they are not going to allow 15 days. They are going to decrease, or they are going to increase the whatever the discount rates they are going to give, that they are going to increase, or in the raw material price they are going to change. Why? Because you are not going to pay on time. If you are paying on time regularly means they are also going to give some discounts, cash discounts or trade discount, other things will be there. So they are going to allow for the organization. So if we manage the working capital properly means then we can easily maintain this healthy relation with the suppliers also. The suppliers also called as a creditors, one who given goods on the basis of credit to the organization. We call it as creditors. Okay, so we can maintain very good rapport with the creditors or with the suppliers. Next point, optimization of working capital management. So optimization is nothing but, so we need to minimize the working capital. Whatever the required money for the organizational day-to-day expenses, as much as possible, we need to minimize the expenses. Either it may be on printing and stationery, or towards the purchase of raw material, or towards the transportation, any other thing. Okay, as much as possible, we need to optimize, and then we need to manage the working capital in a organization. Next point, that is fifth one, minimize the cost of capital. You know the meaning of cost of capital, I think so. Okay, cost of capital is nothing but what is the return on their capital. If for example equity share, how much is the cost of capital for the equity share? How much is the cost of capital on the debts, preference share? retained earnings. Okay, so what is the return on the investment? That is the cost of capital. So how to minimize this cost of capital? So with the proper managing the working capital in an organization, so we can minimize the cost of capital also. So if you minimize the cost of capital, so whatever the money you are going to pay for the shareholders or for the debenture holders, that money you can save and you can use it for the expansion of your business. Correct? So minimizing the cost of capital is also one of the objective of this working capital management. Next, assist the business to avoid over borrowing. So if company, they have the very less current assets and they have more current liabilities, so they require working capital. So on that time, what they are going to do, they need to go and borrow the money from the other, whatever the sources are there, whether it may be from bank or financial institution or from any other. Okay, they need to borrow the money. Correct? So if they are not managing properly the working capital means, then they have to go for this borrowing. So if they maintain properly, then they can over borrowing, they can avoid in the organization. So and the last point, optimal return on current assets. So whatever the current assets are there, how much you are going to invest on that, you are going to get the optimal return. That is maximum return you are going to get from the current assets also. So whether it may be on bank balance or inventory or accounts receivable or bills receivable, all the other things, whatever the current assets are there, on that you can expect a good return on your current assets. So these are the few objectives of working capital management. Next, importance of working capital management. So is there any importance, the working capital management in the organization? Yes, it is very, very important in the organization to manage this working capital. So we'll see one by one what are the major importance of this working capital management. So first one, higher return on capital. So if we effectively utilize the working capital in the organization means, in return we can get the more return on our investment. So all the business or all the activities, they are going to do for the purpose of making money or earn a profit. Correct? So here also, if we manage the working capital in a good manner or in a systematic manner means, yes, we can get the more profit also. So gross profit, net profit, surplus, all those things we can increase only with the managing the good working capital in the organization or managing properly the working capital in an organization, so that we can get the more profit or we can get the more return on our investment. Next, improved credit and solvency. What do you mean by this credit and solvency position? Credit is nothing but the whatever the money we are going to borrow and we have the capable or we are able to repay that money, that is credit repayment capacity, we can increase. When it comes to individual, how we are going to measure the credit repayment capacity of an individual means the CIBIL rating. So what is the individual CIBIL rating? For example, my CIBIL rating. Okay, how much I can borrow and how much I can repay, that CIBIL will give the number. Okay, according to that we have the CIBIL ratings or whatever my past records are there, on that calculation the CIBIL is going to give the CIBIL rating. Like that, companies, they will get the credit rating from the credit rating agencies on the particular instruments, on the shares, debenture or any other things. Okay, so how much they have the credit repayment capacity, okay, that we can improve. Next, solvency position. Solvency is nothing but the company can easily convert that money into cash. Okay, that is also we can improve. Next, third point, higher profitability. So we already discussed higher return on capital, correct? So how we are going to get the higher return on capital? with the improvement in the profitability. Correct? So if you manage good or effective managing working capital in an organization, in return we can get the good profit in the organization. Next, better liquidity. Liquidity is nothing but easily we can convert into cash. For example, inventory or stock that we can easily sold and we can get the money. Next, accounts receivable or bills receivable. We also call it as a bills receivable, correct? So how much the debtors they need to repay the money, that we can give it to the financial institution and then also we can get the money. Correct? Like that, for the managing this working capital, so that we can get the better liquidity also. So uninterrupted production. So if you don't have the working capital, or if it is negative working capital is there, then it leads to the interrupt the production process also. Because for each and every production stage, we require this working capital. Because we need to pay wages, we need to pay rent, electricity, water, coal, fuel, gas, ancillary service products, so many. Okay, so for that we require this working capital. If we are not properly managed in the organization, yes, it may leads to the interrupt the production process also. So this is also very important. So if something happens to the working capital means, then it will affect our production activities also. So we need to manage properly in the organization. Next, 6.1, competitive advantage. So how we can get the competitive advantage? For example, if we have the good or proper utilization of working capital means, we can go ahead with the good number of units production, or we can increase the production capacity also. Correct? So if we get the more production, so what we are going to get? We can easily sell our goods in the market, or we can supply our goods to the customers, or wherever the demand is there on that particular segment we can send the goods. So on that time the competitive advantage we will get, and more number of goods you are going to produce at a same fixed cost, then your cost of production will be lesser, so that we can reduce the MRP price also. Okay, so last one, that is 7th point, appreciation of business value. So with all these 6 points, the company can achieve this appreciation in the business value, or they can increase the net worth of the organization. Okay, higher return on capital, so that all the shareholders or all the public also, they have interested to invest in our company. Why? Because we are going to pay higher return on capital, so they are ready to invest their money. Improved credit and solvency. If we have very good credit and solvency position means, we can easily get the raw materials on the basis of credit, or all the financial institution, they are ready to lend the money to our organization. Higher profitability, it leads to good increment, hike to the employees, or other activities also. Better liquidity, uninterrupted production, so competitive advantage. So all these 6 points will gives very good return on our business value, or that is net worth of our organization, that is also can be increased. Next topic, aspects of working capital management. So these are the 3 very important aspects of this working capital management. This is also called as main elements of working capital management. So if we manage these 3 properly or in a systematic manner in the organization, so we can easily achieve all the other things. So first one, your accounts receivable. It is also called as bills receivable. Accounts payable is also known as bills payable, and inventory management. So accounts receivable, so one who purchase goods from us on the credit basis, and they need to pay the money to our organization. The debtors, okay, they need to repay the money, so that we need to manage properly. And second one, accounts payable, that is what we need to repay for the others, that is for our creditors or suppliers, or to the loan. Okay, we need to repay, correct? So that we need to manage. And the last one, inventory management. So all the production activities or sales or marketing, everything will be depending on this inventory management. So how good the company is managing the inventory in the organization, so easily they can reach all the other activities in an organization. So these three are the aspects or elements of this working capital management. So next one, types of working capital. So here we have only three types or three categories of working capital are there. So we'll see one by one. So working capital, in that we have permanent working capital, second one temporary working capital, and third one is semi-variable working capital. So these are the three types of working capital are there. So we'll see one by one. What do you mean by this permanent capital or permanent working capital? What do you mean by this temporary working capital and when it is required, and semi-variable working capital? Okay. So first one, permanent working capital. It is also known as fixed working capital. So the word only indicates permanent. So that working capital or whatever the fixed money is maintained for the working capital requirement, that will be the permanent. So for 1 year, if the company wants to spend 1 lakh rupees on his working capital, means that will be permanent. They are going to manage the same 1 lakh rupees all over the year or throughout the year. That is permanent working capital, or it is called as fixed working capital. So it is the capital the business concern must maintain certain amount of capital at minimum level at all the times. So I've given the example, right? So 1 lakh rupees, the company minimum they need to maintain this working capital throughout the year. So financial year start from 1st April, correct? So from 1st April to next year 31st March, they need to maintain this 1 lakh rupees as it is. So how much is required they are going to take, and they are going to load that money for that particular thing. 1 lakh rupees they need to maintain as a working capital. So that is the permanent working capital at all the levels. Okay. The level of permanent capital depends upon the nature of the business. So permanent or fixed working capital will not change irrespective of time or volume of sales. If, for example, for that also we have some criteria. Okay. So per month the company is going to produce 10,000 number of units. So all the throughout the year, so throughout the 12 months they need to produce 10,000 only. So if they increase the number of production or number of units production, then it may be vary, correct? So the same amount of products they need to produce continuously, then only it will be applicable. Or volume of sales, or irrespective of the time. So due to the time constraints, so due to this pandemic situation, all the companies, okay, they are under loss. Why? Because they have not do any operational activities, correct? So this COVID also affects organizational working capital. Second one, temporary working capital. So the word only indicates temporary. So whenever they require this temporary working capital or working capital requirement arises, then they are going to use this temporary working capital. So it is also known as variable working capital. Okay. It is going to vary from the month to month or quarter to quarter or for year to year, depending on the whatever the number of products they are going to produce or whatever the activities they are going to do. Depending on that, it is going to vary. It is the amount of capital which is required to meet the seasonal demands. So some companies will be there or some manufacturing units will be there only in the season. Okay. If the raw material is available only in that particular season, means in that season only they are going to run the organization. For example, only in a year, 6 months, the production activity is going to run. So other 6 months, they are not going to do any operational activity. So on that time, they require this temporary working capital. Okay. Seasonal demands and some special purposes. Okay. Only seasonal demand is there or any some other purpose will be there. On that time only, they are going to take this temporary working capital. So it can be further classified into seasonal working capital and special working capital. So seasonal, I've already explained you. So only in the season, wherever the or whenever the raw material is available for the organization, so on that time they are going to do this, or they are going to use this temporary working capital. Or for special working capital, special, due to this pandemic situation, all the medical companies, they are going to use this special working capital. Why? Because they have to produce more number of mask, sanitization or sanitizer or any other medicines, correct? So for that purpose they can use this temporary working capital. Okay, under temporary capital we have two categories, that is seasonal working capital and special working capital. And the last one, semi variable working capital. So in this semi variable, certain amount of working capital is in the field level up to a certain stage, and after that it will increase depending upon the change of sales or time. So semi variable working capital is, it is not going to fixed. Okay, so depending on the quarterly wise or depending on the monthly wise, okay, they are going to change this working capital. So that is called semi variable, depending on the time or sales or whatever the other activities are going to do in the organization, so it is going to depend on the time. So next topic, factors determining or influencing for working capital requirement. So what are the factors or whatever the determining factors or influencing factor for this working capital? We'll see. First one, nature of business. So the nature of business is nothing but whatever the activities in the organization or what kind of raw material they are going to use and what is the process they are adopted. Okay, all those will be comes under the nature of business. So depending on the nature of the organization, okay, so if they required huge number of raw material, okay, take the example of producing the cloth, okay, textile industry. So they required jute or cotton. For that they required coloring or whatever the machinery they required and other ancillary products they required for producing the cloth, correct? So the textile industry, they required huge raw material. So if they want to purchase this huge raw material, yes, they require the working capital also. So it will affect or it will influence for the working capital for the organization. Second one, production cycle. In this production cycle, what is the turnaround time or how much is required for one cycle? Okay, starting from raw materials to finished into finished goods, or we are going to get the output. So for that, how much the cycle or how much the time is required or duration is required, depending on that also it will affect the working capital requirement. So the processing stage, okay, they need to pay electricity charges, water, fuel, coal, gas, wages, okay, and other required goods or required services also they need to take, correct? So on that time this production cycle will also affect the working capital, and after that cycle again they need to repurchase the raw material, correct? So if they want to purchase the raw material, they need to clear all the other whatever the debts are there, okay, they need to repay. For that they require working capital. So next, business cycle. So business cycle is nothing but the company, it's in an introduction stage or it is in a growth, maturity, decline. In which stage the company business cycle is there, okay, that is also affects the or that is also influence the working capital requirement. So if it is in the introduction or in the growth stage, so on that time they required huge working capital. For example, they need to purchase raw material and they need to first they need to produce the goods and services and they need to distribute as a free sample and they need to collect the feedback on the goods and services. That is, they need to do the survey and they need to spend so much of money on the promotional activities. So all those things they required this working capital. So depending on the business cycle also, it will influence the working capital requirement. For example, it is in the maturity stage. So in the maturity stage, we have huge demand for our products and services. So for that huge products and services, we need to produce. We need to meet the demand means we have to supply, correct? So for that supply, we need to produce the goods and services. So that required working capital. Okay. Next, production policy. So the company production policy is also affects or it is also influence the working capital requirement. So what is the production policies are there? So they have this much of goods we need to produce per day, or whatever the cycle is there. Depending on that also, they need to decide this working capital requirements. Credit policy. So you already known credit policy is nothing but how much the credit is allowed by the creditors or our suppliers. So and how much we are allowing for our customers, that is our debtors, because we need to sell goods on the credit. Then only the customer will purchase. No one or all who are going to purchase, they are not going to purchase for cash. Some people or few customers will purchase on the credit also. So we need to allow credit period also. Next, growth and expansion. So if they want to growth or if they want to expand the business means, yes, they require huge working capital because they need to start new product line or they need to start a new plant or new branches. Okay, for all those things, yes, they require this working capital requirements. Next, seventh point, availability of raw material. Depending on the availability of the raw materials is also influence the working capital. So if for example the raw material hugely available, okay, or the supply is heavily is there in the market, so on that time, yes, we can easily get the raw materials with a cheaper price with a good quality, correct? But if the demand is there for that raw material, yes, then they need to spend huge money on the raw material only. Why? Because the huge demand is there and supply of that raw material is very less. So on that time, they need to pay more money. So they required working capital. And the last one, earning capacity. So the company's total earning capacity, it is also influence the working capital, because if they want to increase the more profit or if they want to earn more money means they need to spend more working capital on the day-to-day activities. Then only they can get the more profit. So these are the 8 factors are influencing for the working capital requirement. Operating cycle. So this is very, very important for all the business, okay, or all the organization for the managing the working capital or working capital balancing in their organization. It is very, very important. So these are the few process are there in the operating cycle. So this one turn we call it as one cycle. Okay. So first, raw material. So raw material is nothing but we are going to purchase the raw material from our suppliers on the basis of cash or on the basis of credit. We are going to purchase, and if we purchase for cash, yes, definitely on that time only we are going to repay. If it is credit period, yes, whatever the creditors or suppliers allow for us to repay the money on that particular time, we need to repay the raw material cost. That is the first process or first step. So second one, once we purchase the raw material, what we are going to do? We are going to start processing that raw material. Okay. So once it is in the process, we call it as work in progress. The raw materials are converted into finished goods. So in that particular stage, we call it as work in progress. After this work in progress, we will get the finished goods. Okay. In the finished goods stage also, the working capital is required. Why? Because once we get the finished goods, again we need to sell it to our customer and we need to give some promotional activities or we need to give the advertisement, free samples. For all those things, yes, we require working capital and we are going to give it to the debtors. So if it is sold to the customer, yes, we are going to get the on spot cash. If given for debtors means we are going to sell goods on the basis of credit. So we are going to allow some number of days for this debtors to repay the money for the organization. The debtors is going to repay the cash on that particular day. Okay, whatever the due date is there, after the due date he is going to pay the cash. again we are going to purchase raw material. Same cycle will be repeat. For example, first day we are going to purchase the raw material, correct? So once we send the raw materials for the work in progress stage, it is required 2 days. Okay, so from this work in progress to finished goods, we are going to get in the 1 day, so total 3 days, correct? So after getting the finished goods, we need to sell it to our customers. So for selling that goods, we require 10 days. So 3 plus 10, 13 days. So these debtors, they are going to purchase goods on the basis of credit. So company allowing 15 days of credit repayment period. So 15 plus 13, 28 days. After 28 days, we are going to get the cash. Whatever we have invested here, we are going to get after 28 days. Correct? So this is the operating cycle. Based on this, the companies will maintain the working capital. Formula for calculation of working capital management. So for calculating this working capital management, formula is equal to R plus W plus F plus D minus C. So we'll see one by one. R is equal to, that is raw material, is equal to average stock of raw material divided by average raw material consumption per day. Okay, per day information, we are going to calculate R. So we are going to get one number, plus W is nothing but work in progress. So average work in process or progress inventory divided by average cost of production per day. So we will get one number for work in progress, plus for finished goods, average finished stock inventory divided by average cost of goods sold per day. So per day, how much sales they are going to sell, or how much goods they are going to sold per day, that information. So we are going to get the finished goods. So next, debtors. So average book debts divided by average credit sales per day. So per day, how much credit sales they are going to make, and what is the total debt. So in that, we are going to get D, that is debtors. And the last one, we are going to deduct C, that is average trade creditors divided by average credit purchase per day. So the company is going to purchase on the basis of credit from the supplier, correct? So that they need to repay, that we need to deduct. Okay, in the operating cycle also I've given the example. For raw material, 1 day, we work in progress for 2 days, finished goods it is 3, and debtors it is 15, and whatever the credit repayment period is there, that we need to deduct. This is the formula for calculation of working capital management. Okay, next topic, sources of working capital. So sources of working capital, we are going to broadly classify it into 2 categories, that is internal sources and external sources. So we require money for the day-to-day activity, that we can get through the internal source or to the external source. So we'll see which are all comes under the internal source and which are all the available for external sources. So in the internal, first one, retained earnings. So retained earnings is nothing but the company is going to retain some amount of profit for every year. For example, the company from the last 10 years, they are making good profit. So what they are going to do, in that last 10 years, they are going to keep some percentage of amount as a retained earning. So that can be used as a working capital without going for a borrowing money from the other financial institution or from the bankers. Okay, they can go with this retained earnings. That is the one internal sources of the working capital. Second one, reserves and surplus. So the companies will maintain reserves for the future. Okay, whatever the uncertainty will be there or uncertain activities will be there. For that, they are going to maintain some reserves in the organization. That reserves they can utilize. Or the last year profit, that we call it as surplus. So if the surplus is there, that surplus money they can utilize as a working capital. And the depreciation fund. So the companies, what they are going to do, they are going to deduct the fund from the balance sheet, from the concerned assets, depreciation. But they are going to keep that money as a depreciation fund, and that amount will be utilized to purchase the new assets to the organization. So what they are going to do, that money also they are going to keep it as a reserves, correct? So that depreciation fund also can be utilized as the working capital. So these are the three internal sources are there. Next, external sources. So in the external sources, first one, debentures and public deposits. If they require the money, so they can go with the issuing the debentures, or they can go with the public deposits, and they can collect the money for the working capital requirements. Next, loans from banks and financial institution. So if they required money, they are going for this loan, or they are going to borrow the money from the banks or commercial banks, or with the financial institution, they are going to get the working capital requirements money. Advances and credit. So advances, they are going to take the advances from the customers or from the other stakeholders. They are going to collect the advances, or they are going to collect the credit, or they are going to take the credit from the other people like family members or friends or any other person. They are going to take the credit. And the last one, financial arrangements like factoring. So factoring is nothing but it is an agent, or it is a act as a agent between the company and the banker. Whatever the vouchers or bills receivables are there, we are going to submit, and we can get the money from the organization or from the financial institution. They are going to cut, or they are going to deduct some percentage of commission, and they are going to repay the money. That is the factoring. So these are the few sources of working capital. So next, how to manage working capital. We have so many points are there, but it is very important. These 5 points are there, how to manage this working capital. So first one, being proactive. So if first stage is we need to plan, correct? Once we get the plan, or once we get the estimation, yes, we need to proactive with the getting the money, or we need to arranging the money. That is the being the proactive. Next, not mixing personal and business expenses. So as per the accounting concepts and conventions, yes, we are not going to, or we are not eligible to mix the personal expenses and the business expenses. Personal expenses is nothing but the proprietor's personal expenses. It cannot merge with the business. The personal, that is proprietor personal, is different, proprietor organization is different. So we need to maintain separate expenses. Next, making payments on time. For a creditors or for any bankers. If we repay on the particular whatever the due date is there, if we pay regularly, then they are going to allow number of days, extra number of days, or they are going to give discounts. So for that purpose, yes, we need to make sure that all the payments will be done on time. Next, proper invoicing. So we need to maintain all the proper invoicing for the day-to-day wise. And the last point, choosing the appropriate source of funding. So we have internal and external funds are there. We need to select which is better, or which is optimization, or which will be the optimum, or it is suitable for our organization. We need to select that one only. So in this session, we have discussed about introduction to working capital. That is like working capital is a blood for all the business activities. How the blood will work for human bodies, like that the working capital will work in the organizations also. In a simple, all your current assets minus current liabilities, that is your working capital. Definition is, that is also, the working capital refers to firms' investment in short-term assets, cash, short-term securities, accounts, receivables, and inventories. So all about your current assets and current liabilities. Next, the meaning and definition of working capital management. So attempting to manage the current assets and current liabilities and the interrelations that exist between them. So the managing the current assets and current liabilities in the organization, that is called as working capital management. Next, objectives of working capital management, that is balance of working capital expansion, healthy relation with the suppliers, optimization of working capital management, minimization of cost of capital, assist the business to avoid over borrowing, optimal return on current assets. Importance of working capital management: higher return on capital, improved credit and solvency position, higher profitability, better liquidity, uninterrupted production activities or production process, competitive advantage, appreciation of business value. Aspects of working capital: the three elements of working capital, that is accounts receivable, accounts payable and inventory management. So types of working capital: permanent working capital, temporary. In this temporary, we have two categories, that is seasonal and special working capital, and the semi-variable working capital. Factors determining or influencing for working capital requirement that we have discussed: operating cycle, that is raw material, work in progress, finished goods, debtors and cash. So these are the operation cycle or turnover cycle is there. Formula for calculating the working capital management, that is raw material plus work in progress plus finished goods plus debtors collection period minus creditors repayment period. Okay, that is your working capital management formula. Sources of working capital, that is internal sources and external sources are there. How to manage the working capital in an effective and efficient manner. Thank you.
Capital budgeting techniques used by the corporates. But these capital budgeting techniques are not limited to these four, but these four are traditional and most popular methods used by the corporates. Payback period method. Okay. Net present value, NPV. Internal rate of return, IRR. Break even analysis. Okay, so break even analysis, this is also called as BEP analysis, break even point analysis. So these are the four important methods used by corporates, and these are the traditional yet the most demanded, most popular capital budgeting techniques used by the corporates. So let's have a look at each one of this. Let's understand how these methods work. Payback period. Okay, so what is the payback period, payback method? This capital budgeting largely discusses about how quickly the business is able to recover the initial investment. It's all simple. So how quickly the business is able to generate the cash flows and how quickly the business is able to recover the initial investment. Okay, so to calculate the payback period, we use this equation. Okay, so payback period is equal to initial investment divided by net annual cash inflow. Let's have a look at some of the examples so that it is very clear to you. Yeah, so a business has got 4 projects. Okay, so there are 4 projects available for a business. Each project requires an initial investment of 1 lakh. Okay, so 1 lakh minus means this is the initial investment, cash outflow. Okay, so cash outflow. Cash outflow. Project A yields 30,000 in year 1, 40,000 in year 2, 10,000 in year 3, 20,000 in year 4. Okay. Project B, 40,000 year 1, 40,000 year 1, 30,000 year 2, 30,000 year 3, 40,000 year 4. Project C yields 1 lakh in year 1, 50,000 in year 2, 30,000 in year 3, 50,000 in year 4. Okay, so just focus on the cash flows. Project D yields 50,000 in year 1, 50,000 in year 2, 20,000 in year 3, 10,000 in year 4. Okay, so now let us look at this part, the payback period. Okay, so this part. Now, if you see project A, the initial investment was 1 lakh. Okay, so how much time the project took to recover the initial investment? 30,000 plus 40,000 plus 10,000 plus 20,000. Okay, so 30, 40, 70 plus 10, 80, 80 plus 20, 1 lakh. So it took 4 years. Okay, so this requires 4 years to recover the initial investment. That means how quickly the business is recovering the initial investment? Project A is requiring 4 years to recover the initial investment. Now let's see project B. Project B is recovering 40,000, 30,000, 30,000, 40,000. So 40,000 plus 30,000 plus 30,000. So third year, okay, 40,000 plus 30,000, 70,000, 70,000 plus 30,000, 1 lakh. So in third year, project B is recovering the initial investment. Okay. Now, project C, initial investment was 1 lakh, and the first year itself, the project C is recovering 1 lakh. Second year, 50,000, third year, 30,000, and third year, fourth year, 50,000. So first year itself, it is recovering the initial investment. So the payback period was 1 lakh. Sorry, 1 year. Now, project D. Project D, initial investment was 1 lakh, year 1, 50,000, 50,000, 20,000, 10,000. So in 2 years, the project is recovering 1 lakh. Okay, so it requires 2 years. Now, what we need to understand is how quickly the project is, the business is able to recover the initial cost is what we need to understand from payback period. If you look at this example carefully, project C has taken a least time, that is 1 year, to recover the initial investment. Okay, and if you see project A, it has taken 4 years to recover the initial investment. In this case, which project is more safer and which project is more riskier? Right? Project C is more safer and project A is more riskier. Okay, so project C yields recovers initial investment in 1 year. Project A recovers in 4 years. So when it comes to the priority, business should invest in project C and should ignore project A. Okay, so that is called payback period. That's a payback calculation. Now let's understand the advantages of using payback period method. It is simple to understand. Okay, so it is straightforward because payback period calculation does not involve any complicated mathematics. It is just simple how quickly the business is able to recover the initial investment. So simple to understand, easy to calculate. It is just addition of cash flows until the complete initial investment is recovered. Payback period method allows for the ranking of business projects. So based on the payback period, the time taken to recover the initial cost, so we can rank the business projects and we can prioritize. Payback period stresses more on the cash flows, not on the accounting aspect of the profit. Okay, so what is important? How much cash is required, right? How much of cash is recovered is calculated, and accounting profit is not taken into account. So cash flows are given the importance. Less time consuming. Calculation of payback period is very quicker because there is no complications involved in the calculation of cash flows. You just keep adding cash flows until you recover the initial investment is all we do in project payback period. That's why it is less time consuming. Let's quickly have a look at a simple example in payback calculation so that it will be more clear to you. Raghav Limited is interested in a project requiring an initial investment of 50 lakhs and is anticipating generating of rupees 5 lakhs in year 1, 7 lakhs in year 2, 10 lakhs in year 3 and 14 lakhs in year 4 and 25 lakhs in year 5. From the details given above, calculate the payback period for the project and recommend which project is more feasible for from investment point of view. So we will first, when we need to calculate the payback period, we first need to list the cash flows received for the business. Okay, so let's say for how many years? This is for 5 years. For 5 years, the business is going to generate the cash flow. So first year 0, 1, 2, 3, 4, 5. Why 0? This is the starting of the business. So that is why it is 50 lakhs is minus, it is in the bracket. Okay, so 50 lakhs is in bracket because this is the initial investment. Okay, so now, so initial investment is 50 lakhs and year 1 onwards, year 1 there is no cash flow because this is only cash outflow. Okay, so cash outflow on initial investment. So cash inflow starts from year 1. So 5 lakhs, 7 lakhs, 10 lakhs and 14 lakhs and 25 lakhs. So now to calculate payback period, what we have to do, we have to calculate cumulative cash flows. Okay, so we just keep adding the cash flows. Okay, so we need to add cash flows. So initial investment was 50 lakhs. It was initial investment to do minus. Now year 1, how much is recovered? What is the amount we cash flow? It was 5 lakhs, right? It was 5 lakhs. So 5 lakhs received, recovered. So 50 lakhs was initial investment, 5 lakh recovered first year. So what is the remaining amount? 45 lakhs. So 45 lakhs to be recovered in the remaining cash flows. Now, second year, how much is the cash flow? 7 lakhs. So 45 lakhs minus 7 lakhs, it is going to be 38 lakhs. So 38 lakhs to be recovered from the remaining cash flows. Now, third year, there is another cash flow, 10 lakhs. So 38 lakhs minus 10 lakhs, 28 lakhs. So 28 lakhs to be recovered from the remaining cash flows. From 28 lakhs, fourth year, there is a cash flow of 14 lakhs. Okay, so 14 lakhs to be, recovered. And from 28 lakhs, if you recovered 14 lakhs, what is remaining? 14 lakhs. So 14 lakhs to be recovered from the remaining cash flow. Now, what is the amount to be recovered? What is the balance to be recovered? 14 lakhs. What is the cash flow on fifth year? It is 25 lakhs. Okay, so we need just 14 lakhs to completely recover the initial investment of 50 lakhs. Okay, so we need 14 lakhs, but we have the cash flow of 25 lakhs. So here is the calculation which we need to be very careful. We have to calculate this using the equation which I showed you just now. What is the equation? So payback period, okay, is equal to initial investment divided by net annual cash inflow. Okay, so what we do, first 4 years we have taken because it is already recovered, 4 years plus. So what is the initial investment to be recovered now? It is just 14 lakhs. Okay, so the 14 lakhs divided by net annual cash inflow. What is the cash inflow on fifth year? 25 lakhs. So 25 lakhs. Okay, yeah, so 25 lakhs. So if you just divide 14 lakhs by 25 lakhs, it is going to be 0.56. Okay, so 4 years plus 0.56 is 4.56 years. This is the payback period. Okay, so this project has a payback period of 4.5 years. Considering these cash flows, the project will recover the initial investment in 4.5 years. I hope it is clear to you. Now let us see the limitations of payback period. Okay, so no capital budgeting technique is free from the limitation. Neither any technique nor any method is free from the limitations, right? So every system will have its own benefits or plus and minus. One of the most important limitation of payback period is this ignores the time value of money, right? So time value of money, one of the most important topic in financial management is time value of money, and payback period eliminates time value of money. Okay, because it stresses more on the cash flows, not on the opportunity cost. Okay, so opportunity cost is one of the most important topic discussed in corporate finance. Okay, so time value of money, the rupee earned today is worth more than the rupee that would be earned tomorrow, right? The rupee invested today is worth more than the rupee that would be invested tomorrow, right? So that aspect, payback period ignores or eliminates that consideration. The second limitation of payback period is it ignores cash flows after the payback period. Okay, so just to quickly show you this, it actually ignores the cash flows after the payback period. If you see the previous example, we have taken only up to when it was just like it was 4 years plus what was the amount to be recovered from 25 lakhs, right? So after that the cash flows are ignored. Only 4.56 years is what we wanted, actually nothing beyond that. Okay, so if you see the another example which I showed you just now here, so if you see project C recovers initial investment in year 1 itself, but what happens after year 2, year 3, year 4? This is completely right, it's completely ignored. Okay, this part is completely ignored. Okay, so that is the limitation of payback period. But we need to understand the cash flow. Every cash flow is important because whether it is now or tomorrow, it is yielding cash flows. Okay, just considering 1 lakh and forgetting the project is not a viable or a feasible thought. Okay, it is not a practical thought in the investment management. So that is the serious limitation of payback period. Okay, and no risk consideration, there is no discussion of risk in this. Okay, so there is no risk discussed, there is no risk element discussed in this payback period. It is just the cash flow we discussed. There is no discount rate discussed, there is no interest rate discussed, there is no opportunity cost discussed, there is no the percentage of loss or the compound effect of cash flows is discussed. So no risk consideration. So scope for personal bias. Okay, so when two projects yield the same cash flows, for example, in the previous case, you can see project A and B both yield the same cash flows. Okay, so 3 lakh, 1 lakh, 3 lakh, 1 lakh, year 1, year 2, right? So the person who is actually calculating the payback period they may be biased. Okay, he can exhibit his bias. He may choose one among these two projects, though both are similar. He may choose project A against project B or project B against project A. So there is a scope for personal bias. Which one to choose? The person who is actually deciding, the project manager who can choose this against this, or project B against project A. So that is the limitation of payback period method. Now let's understand the second important capital budgeting technique, that is net present value. Net present value is the difference between the present value of cash outflow and the present value of cash inflow during the period. And the NPV is the present value of an initial investment expected. The net present value is the present value of an investment's expected cash inflow minus the costs of acquiring an investment. One of the beauty of net present value method is it considers the time value of money and it gives due weightage for the cash flows, the discounted cash flows, the discounted cash inflows, and the discounted cash outflows. The net present value for a given project is calculated by using the equation NPV is equal to summation t is equal to 0, cash flow t divided by 1 plus r power t. So here this is t is equal to 0, this is t is time, so this is discount rate, okay, this is the duration, and NPV is equal to cash flow plus cash flow 1 divided by 1 plus r power 1 plus cash flow divided by 1 plus r power 2 plus cash flow t divided by 1 plus r power t, right? So this is minus because remember initial investment will always be shown in minus or in bracket, right? So initial investment, this is the cash going out and this is coming in, okay, this cash is coming in. So these are the discounted cash flows, okay, so this is the one, this is discounted cash flow for first year and this is the discounted cash flow for second year, okay. So these are the cash coming in and this cash is going out, okay, this is cash is going out. So this is the equation we use to calculate the net present value. So there is a decision criteria based on NPV, how to decide projects based on NPV. If NPV is greater than 0, accept the project. The net present value is greater than 0, accept the project. If the NPV is less than 0, reject the project. If the NPV is equal to 0, accept the project. Okay, so when the present value of cash inflow is greater than present value of cash outflow, NPV is positive and hence the project is acceptable. The present value of cash inflow is equal to the present value of cash outflow. In that case, NPV is 0. That is the reason project is still acceptable. Though this is a decision to be taken based on the circumstances because the present value of cash inflow is equal to the present value of cash outflow. So still the project is accepted because the project is yielding the NPV 0, right? So NPV is 0, so still it can be accepted. The third category, the third criteria, the present value of cash inflow is less than the present value of cash outflow, right? If the NPV is less than 0, right? So if the present value of cash inflow is equal less than present value of cash outflow, that means the cash coming in is lesser than the cash is actually going out. Generally NPV is negative and the criteria to consider this project is to be rejected because the cash outflow is more than the cash inflow. The discounted value of cash outflow is more than the value of discounted cash inflow. So let's understand the advantages of net present value. It is easy to understand, simple, and it considers the time value of money, considers all cash flows, unlike payback period. In payback period, you have seen we consider only those cash flows which are required to recover the initial investment. But in this case, in time value of money, the consideration for time value of money, and we consider all the cash flows during the entire length of the project. And there is a consideration for the risk factor. Now let's have a look at an example how to calculate NPV so that it will give you a clear picture of how to calculate NPV and how it is useful. Hercules Limited is planning to acquire an asset that expects to yield positive cash flows for the next 5 years. Its cost of capital is 10%, which it uses as the discount rate to construct the net present value of the project. The following table shows the cash flows for the period. Okay, so initial investment 0 is 60 lakhs. The project requires an initial investment of 60 lakhs. Year 1 onwards, the project start yielding the cash flows 15 lakhs every year for the next 5 years. Okay, so every year it is yielding 15 lakhs for the next 5 years. Let's calculate NPV, the net present value. So these are the years, year 1, 2, 3, 4, 5. For this is for 5 years. The project is going to be receiving cash flow for the 5 years, and the initial investment is 60 lakhs. Every year there is a cash flow of 15 lakhs. Okay, this is just the cash flow, not a discounted cash flow. Remember this. Okay, so these are just the cash flows. So 15 lakhs, these are just the cash flows. Now, what is the discount rate? It is 10%. There is an equation to calculate the present value of money. Okay, so in this case, we are going to use the table to calculate the discounted cash flows. You can use either method. You can either go for time and present value equation, or you can go to the table values. Okay, so table values are readily available. You can just directly calculate discount values, these values by using the table. Okay, so you can directly take these values from the table. So one for 10% first year, table value is 0.909, 826, 751, 683. I'll show you this 0.620. Okay, these are the table values. I'll show you this. Okay, so this is the table. Okay, this is called time value of money, the present value table, the present value and future value table. Since we are discounting, remember this, there are two concepts. Okay, one is compounding and discounting. Okay, the one is compounding and discounting. In discounting, we are trying to convert the future value of cash flows into present value. In compounding, what we do, we try to convert the present value of cash flows into the future values. So that is compounding. So discounting and compounding. So in this case, in net present value, when we are calculating net present value, we apply the discounting principle. Discounting is nothing but the present value. We are calculating the present value of all future cash flows. So that's the reason we have to see the present value table. Here it is. Okay, so this is for present value for 10% discount rate for first year. What is the table value? 0.909. Okay, so 909, 826, 751, 683 and 620. So all these values are taken. Okay, so 10%, and this is for 5 years. For each year we have to take. So we have taken those values. I hope it is clear. So we have taken table values, and next what we will do, we will simply multiply the cash flows with the discount factors. For example, 60 lakhs into 1. Why it is 1? Because this is an initial investment. It will be default 1. Okay, so minus 60 lakhs. 15 lakhs into 0.909, 13.63, 650. 8 to 6, 15 lakhs. So 15 lakhs, 0.751, 11, 26 to 500. Okay, 15 lakhs into 683, 10 lakhs, 24,500, and 15 lakhs into 0.620, 9 lakhs, 30,000. So 9 lakh 30,000. Now what we have to do, we have to add all these cash flows. Okay, so all these cash flows have to be added. Just add this. Okay, so you will get 3,16,350. Why it is 3,16,350? That means from 60 lakhs, if you reduce all these cash flows, you're going to get 3,16,350 minus value. Okay, so first what you have to do, first you have to add all these cash flows. Okay, once you add, you have to compare these cash flows with the initial investment. What was the initial investment? 60 lakhs. So 60 lakhs was the initial investment. What was the amount recovered? These are the amount, and then the difference was minus 3,16,350. That means the present value of all the cash inflows is lesser than the present value of all the cash outflows. Okay, this is the present value of cash outflow, and these are the present value of cash inflow. So the present value of cash inflow is lesser than the present value of cash outflow. What is the NPV decision criteria? If NPV is greater than 0, accept it. If NPV is less than 0, reject it. So in this case, NPV is less than 0, straight away we reject this project, because the NPV, the net present value of all the cash inflows, is negative. So we reject it. This project will be rejected. I hope you are clear about why this project is rejected. Now let's have a look at the limitations of net present value. In fact, we have chosen net present value since it has some of the advantages against big payback period, but now NPV method itself has got limitations. So what are the limitations? Discount rates are not stable. Okay, so these discount rates are not stable. If you see this example, we have taken 10%. Okay, this is one of the most complicated decisions in corporate finance, because on what basis we have chosen 10%? On what basis? Generally these discount rates will be based on the risk-free rates. Okay, so there is something called risk-free rate. Okay, so this is a risk-free rate. This is the rate at which we generally wish to invest our money. For example, let us say I have 10,000 rupees. I expect minimum of 7% or 6% of return every year. Let us say if I need to invest that money in a bank, if I need to deposit that money in a bank, I expect 6 to 7% of return. That means every year I need to get 6% or 7% of return, so that I can protect the value of my money. Because technically, what it indicates, every year your money will lose value. Okay, how much? 6 to 7%, for example. Okay, so that much of value has been depreciated in your money, so you have to protect the value of your money. How? By investing your money at minimum of risk-free rate. So that's why we keep our money in banks we keep our money in banks, we keep our money in chits, we keep our money in investments, we keep our money in shares. So we do all that. So based on our risk appetite, we invest our money in financial instruments. So the risk-free rate. So this 10%, how this 10% is chosen is the complicated decision, and that is a multifaceted problem to be solved in corporate finance. So consideration of 10% is a questionable item. Okay, so on what basis 10% is taken into account? Assumptions of future interest rate may be subject to personal bias. Okay, and subject to personal bias means this discount rate is dependent on who is valuing the project. Okay, the person who is valuing the project may assign 8%. Okay, 8% or 10% or 9% or 7% or whatever. So that is based on his personal bias. Suitable only ideal capital market. Okay, so this method is suitable only in ideal capital markets where the discount rates are standard. Okay, which will remain the same for at least for a definite period of time. But in reality, it is very difficult to imagine that the discount rates will remain stable. IRR of project is ignored. The internal rate of return of project is ignored, which we are going to discuss now. Internal rate of return is the rate at which the present value of cash is equal to the present value of cash inflow. Okay, so this is a simple definition of internal rate of return. The rate at which the present value of cash inflow is equal to the present value of cash outflow. You need to be careful when you're calculating IRR, because most of the time, we see this confusion between IRR and NPVs. Most of the time, though they look little similar. Okay, so in NPV, what we do, we calculate the cash flows, the discounted cash flows, the present value of all the discounted cash flows and the present value of all the discounted cash outflows. the cash inflows and the cash outflows. So we calculate the cash flows. We see the difference. If the NPV is 0, if the NPV is more than 0, accept. If NPV is less than 0, reject. But here in internal rate of return, what we are doing, we are trying to calculate the discount rate. Okay, so we are not calculating the cash flow. We are calculating the discount rate at which the present value of cash inflow and the present value of cash outflow is equal. So that is the reason we call this is most of the time this is also called as hurdle rate. Okay, so the discount rate is also called as hurdle rate or discount rate or whatever. So we generally call these two terms, so hurdle rate or discount rate. So this rate, so we are calculating the rate here. Okay, so we are calculating the discount rate. Okay, we are calculating the discount rate. So generally in internal rate of return, in this method we use trial and error method. Okay, so when it comes to the manual process, we use trial and error method. Trial and error method to calculate internal rate of return. So these are the steps you can see on the screen. Select two discount rates of calculation of NPV. Calculate net present value using discount rates chosen. Determine IRR and interpret. I'll show you one example how trial and error is done using two discount rates. Let's take an example. Let us assume that your friend suggests you to invest on project Alpha, in which you can deploy 10 lakhs today, and from next year onwards the project would start yielding rewards without additional investments. Below is the summary of investments made and cash flows expected in future. So this project, you can see the initial investment is 10 lakhs. Year 1 onwards there is a cash flows, right? There is a cash flow. Year 1 2 lakhs, year 2 3 lakhs, year 3 3 lakhs, year 4 3.5 lakhs, year 5 3.5 lakhs. Total cash flows are 15 lakhs. So it is given in a matter of 5 years the business is generating 15 lakhs cash flows, and the initial investment is 10 lakhs. Okay, so it is already given, so there is no need to calculate NPV. Okay, so NPV is already there. Okay, so discounted, the cash flows are already given. Now what we are going to calculate is very simple. So this is 10 lakhs. Okay, this is the initial investment, right? Initial investment, and this is the total of cash flows. At what rate? Okay, at what rate the present value of cash inflow is equal to the present value of cash outflow. Okay, so we are trying to calculate the rate at which this is going to be equal. Okay, so 10 lakhs initial investment, 15 lakh cash flows. Okay, at what rate this will become equal? So that is what we are going to calculate. So generally we assume two discount rates to arrive at internal rate of return, because we don't know what is the discount rate. That is what we are actually trying to calculate now. So when we don't know the discount rate at which these cash flows, the cash flow, the today's initial investment and the total cash flows of the project are going to be equal, we don't know the discount rate. So what we do, based on the average discount rate, we take two discount rates. Okay, so we try two discount rates. We take two discount rates which are on average. Okay, so which will come on average, so generally that are used in the industry. So let's say we will first try at 10% and then we will try for 12%, or we will try for first at 8% and then we will try at 12%. So we do that in this method. Okay, so you can see first we will try at 8%. Okay, so first we try at 8% discount rate. Okay, so what we do, we apply the same principle. Okay, initial investment 10 lakhs. Okay, year 1 onwards there is a cash flow, right? 2 lakhs, 3 lakhs, 3 lakhs, 3.5 lakhs, 3.5 lakhs. So every year we apply 8% discount rate. You can do one thing, you can apply this equation, present value is equal to future value divided by 1 plus r power n, or you can straight away go to the table values and you can find out. Okay, so the table values, you can just take it and you can just populate it here and simply multiply these discount rates with the cash flows. That's all. Okay, you will get these results. Okay, so 10 lakhs. So for first year, if you apply 8% discount rate, if you bring the table value, it will be 1,85,185. Second year, it will be 2,257,202, and third year onwards, so on and so forth. Okay, so just calculate this, and the total cash flows will be 11,76,001. Now we need to question ourselves, is this equal to the initial investment? What was the initial investment? It was 10 lakhs. What is that we have got? The total cash flows at 8%. Okay, it is 11,76,001 rupee, right? So now the total cash flows are not equal to the initial investment. Now you see, this is very important. When you have 8%, when you are 8%, you're taking 8%, your NPV is 11,76,001 rupee. Now you need to be very careful. If you increase this discount rate, remember this will come down. Okay, so if you increase 8% to 10% or 12% or 13%, this will come down. Technically, we need to bring this down because our initial investment was 10 lakhs. Now we are getting NPV of 11,76,001 rupees. So it has to be 10 lakhs. So if I need to make it 10 lakh, what I can do? I can simply increase the discount rate. That's a logic. Okay, that's a logic we need to apply. So if you increase the discount rate, let's say if you will try with 12% or 13%, this will come down. How much it should come down? Only when you calculate, you will be able to understand this part. Okay, so let's see, let's try this with 13.92%, or if you want to refer table, so you can try 14%. Okay, so if you try 14%, what will, you can just populate this 14% discount rates for 5 years, then multiply, then you will get 10 lakhs. Okay, if you try with precise 14%, this would go up, okay, little more, maybe 10 lakh, 20,000 or 30,000. We don't want that amount, we want exact amount, right? So that's why 10 lakhs. So we will try with 13.92%. So this is what you need to understand. 13.92% is the rate at which the present value of cash inflow is equal to the present value of cash outflow. This is what we wanted. Okay, so the present value of cash outflow, the cash inflow is equal to 10 lakhs now. You see this. Okay, so now what is the discount rate? This is the discount rate at which the present value of cash inflow is equal to the present value of cash outflow. So this looks very hard method because this is a manual method. Thankfully, there are a lot of online calculators available. You can just try internal rate of return calculator, even for NPV, even for payback period. So you can use online calculators. If you really want to understand the method, you have to try this manual method. If you don't want to go through this lengthy process, you can straight away go to the online calculators for NPV and IRR, and for payback period, you can just derive these values. Okay, so that is internal rate of return. Now let's understand the last method in capital budgeting technique in this session is break-even analysis. Okay, so one of the most popular popular method in capital budgeting technique is break-even analysis. So most of the business firms will be interested in calculating break-even point because this is the point at which the business neither makes profit nor the loss. Generally, when the business is started, the break-even point, calculating the reaching break-even point will be one of the dreams of a business, because only when they reach break-even point, they can, enjoy the next zone, that is making profits. Okay, so that is the reason, businesses generally are interested in calculating break-even point. So there are some of the important terminologies that are used in break-even analysis: fixed cost, variable cost, revenue, contribution margin, right? So these are the terms commonly used in break-even analysis. So fixed cost is a cost or an expense that does not change with change in the level of output. So this fixed cost will remains the same for the business irrespective of the level of output or the quantity produced. Variable cost is nothing but the cost that are incurred in proportion to the volume of output. Okay, this will keep changing. This cost would vary. It would go up or it will go down. The revenue is the total amount of business that a business generates during the period. The contribution margin is nothing but it is the sales and sales minus variable cost. So this is a very important diagram. So you need to understand this diagram because this is how the break-even point is calculated. Okay, so this is OX axis, this is OY axis. OX axis exhibits the units sold during a period, and OY is representing cost, the cost incurred by the business. Okay, so yes, this is the fixed cost. Okay, SF is the fixed cost line. So this cost will remain the same irrespective of the level of output. Okay, so this business will have this cost irrespective of the level of output, whether the the company is performing or not performing or whatever. So this cost will remains the same for the business. So S and F will be the same. Now you see there is a line going from O onwards, right? So OV, this OV is nothing but this is the variable cost line. Okay, so the variable cost line is beginning from 0 because the variable cost will change based on the number of quantity, the quantity produced. So that will keep changing. So this will keep raising because this will, since the units sold will be raising, so variable cost will keep raising, but fixed cost remains the same irrespective of the level of output. Now you can see there is one more red line which starts from S. Okay, so ST, this is the total cost line. How this is arrived? Total fixed cost, okay, and total variable cost. Okay, if you put together, this will be the total cost line. Okay, sorry, this is the red line is total cost line. So S and T is the total cost line. Now you see an important line which is starting from 0, OS, right? OS. This is the sales line. Why it is starting from 0? Because the sales will begin from the day 1. So from the day 1, the sales has been started. So it is started and it is raising. Now you see there is a point at which the total cost line is intersecting with the total sales line. Okay, so this is the point at which the total revenue of the business is equal to the total cost incurred by the business. So this is the point at which there will be no profit, no loss for business. Okay, up to this point, whatever the business incurs will be the loss. This will be the loss zone. You can see this is the loss zone, and beyond this point is the profit. Okay, so the profit, and you can carefully observe this, the profit proportion will keep increasing. Okay, this will be go increasing to certain levels. Okay, this will be the profit zone. So this is the point that every company dream for, because this is the point at which they break the loss zone and they enter the profit levels. So this is the calculation of break even point. No profit, no loss zone. Now let's have a look at an example to understand this topic better. Vijay Limited is a producer of electronic chips for laptops. The cost of the company includes the cost of rent for building, salaries, taxes, which adds up to 12 lakhs. The variable cost associated with the production of each electronic chip is 10 per unit. The chips are sold with a premium price of 60. Determine the break-even point or the no profit, no loss zone for the company. Simple yet straightforward. So now we have fixed cost given 12 lakhs. Variable cost per unit is 10. Selling price is 60. So now how we calculate the break-even point? We calculate break-even quantity now in this case, because this is the quantity that we need to identify for no profit, no loss zone in this example. So break-even quantity is equal to fixed cost divided by sales price per unit minus variable cost per unit. This is the equation. We use this. So this is the equation. So 12 lakhs is the fixed cost and sales price per unit is 60 and variable cost per unit is 10. So break even quantity is 24,000 units. Okay, what it means? 24,000 units to be produced to reach break even quantity. That is a quantity at which there will be no profit, no loss.
Now let us very quickly summarize today's video. In today's video, we started by learning about the basics terminologies used in financial world. Then we moved on to knowing about the various financial markets. Furthermore, we discussed about asset management and its different types. And in the end, we learned about working capital management and capital budgeting technique in detail. If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notification bell so that you don't miss out on any new update or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video for any query or suggestions and I will respond to your comments.